Joint Committee on Corporations and Financial Services into Small Business Insurance. I begin today by acknowledging the traditional owners of the land on which we meet, and I pay my respects to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearing in person and via teleconference. These are public proceedings being audio streamed live via the Parliament's website, and a Hansard transcript is being made. I remind all witnesses that in giving evidence to the committee, they're protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses also have a right to request to be heard in camera. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind any committee members and witnesses who are appearing via teleconference to mute their microphones when they are not speaking. I now welcome representatives from QBE Insurance. We have Miss Madonna Jarrett,
Member for Brisbane.
I'm Senator Deborah O'Neill, Senator for New South Wales. We have Mr Scott Buchholz online, and he'll be here with us very shortly. And I believe we also have Mr Garth Hamilton has come in to provide quorum. And we have Miss Lawrence online as well.
Thank you.
In Western Australia. And pretty soon after that, we will be joined by Senator Dave Sharma in person. I understand that information on parliamentary privilege and the protection of all witnesses giving evidence to Senate committees has been provided to you all. For the Hansard record, will you please state your full names and the capacities in which you appear today?
Sue Horton. I'm the Chief Executive Officer of QBE Australia Pacific.
And I'm Pat Priest. I am the Chief Underwriting and Transformation Officer for QBE.
Thank you. I now invite you to make a short opening statement, and at the conclusion of any remarks, I will invite members of the committee to ask questions.
Thank you, Chair, and good morning to you and the senators and members of the committee. And thank you for the opportunity to appear here today. We welcome the committee's focus on the small businesses insurance market and appreciate the opportunity to contribute to this inquiry. QBE is a homegrown Australian insurer, proudly established in Queensland 140 years ago. With a strong global presence, we remain headquartered locally and have supported Australian businesses, industries and communities for generations. Business insurance is at the heart of what we do, making up more than 90% of our portfolio. With expertise spanning across many sectors of the economy, from commercial property, agriculture and education, to specialist areas such as marine and aviation, QBE supports businesses of all sizes to manage risk, recover from disruption and invest with confidence. This is particularly relevant for small businesses, which often have less capacity to absorb unexpected shocks. Our customers have access to specialist advice and support and tailored insurance solutions through our strong regional footprint. With the many insurance products available and the ever-changing risk environment for businesses, insurance intermediaries also play an important role in helping small businesses. Over 90% of our small business and farm insurance packages are sold through these intermediated channels. We recognise that small businesses are operating in an increasingly challenging environment. Rising operating costs, inflationary pressures, labour constraints and supply chain disruptions are all placing strain on business owners. At the same time, exposure to natural peril risk has increased due to factors such as more frequent and severe weather events and increased development in higher risk locations. In much the same way, liability risks have also evolved alongside societal expectations and the legal environment. Today, these risks are often less about isolated incidents and more about systemic, higher severity risks that are harder to predict and manage. For some small businesses, particularly those operating in higher risk sectors or regions, these issues are affecting insurance affordability and availability. Addressing these challenges is dependent on continued collaboration between insurers, governments, businesses and other stakeholders. We support sustainable solutions, continued investment in resilience and mitigation, improved land use planning and strengthened building codes. These measures are important to support more resilient communities, ensuring underlying risk issues are not exacerbated over time, and to help lower premiums over the long term. We believe there are opportunities to work together to strengthen small business understanding of insurance and risk management, and to develop national standards and tools for industry sectors to increase their resilience. While risk management and mitigation underpin a strong and viable insurance market, legal and regulatory settings also play an important role. Together with the insurance industry, we support a review and reform of civil liability settings in ways that will help to lower risk and claims costs, and importantly, support timely return of injured people to work, health and life. At QBE, we support small businesses by helping them better understand, manage and reduce the risks that can disrupt their operations. For example, our risk solutions capability works alongside our underwriting teams and brokers, helping business customers improve their resilience with practical risk assessments, training, education and loss prevention initiatives tailored to their specific exposures and industries. We also believe the most effective and immediate way to reduce insurance premiums is to remove taxes, duties and levies on insurance products. These state taxes add between 9 and 40% to the cost of a premium in addition to GST. Numerous reviews have found these inequitable and inefficient. In addition, reducing the regulatory burden on the insurance industry would help to reduce cost pressures. Maintaining the soundness of the regulatory system, financial stability and consumer protection clearly remains key. However, striking a balance between resilience and efficiency is necessary. We support the government's focus on creating a stronger, fairer and more productive and resilient economy and better regulation initiatives being taken by regulators. QBE is committed to working constructively with governments and industry to support Australian small businesses and to ensure that insurance continues to play a vital role in enabling economic activity and recovery. We welcome the committee's questions and further discussion, and thank you again for the opportunity to appear today.
Thank you very much, Ms Horton. And I'll go straight to Ms Jarrett for some questions.
Good morning. Thank you for being here today. We've heard a lot of evidence yesterday, so some of my questions may relate to that. You're talking, given the breadth of coverage that you have and the various insurance products, do you provide insurance across the board? So I'm talking liability, indemnity, building, like everything that the business might want, or are you focused in one area?
No, we do it right across the board. We're in every state and every region, and we cover every sector.
Okay, so based on your experience, where are you seeing the most significant increases, or how much have insurance premiums changed for small businesses in particular, say, over the last 5-10 years? Because we heard yesterday, for instance, tort reform back in the early 2000s, so we're a quarter of a century ago, made some differences. So can you just give us an indication of where you're seeing premiums go up and down in what parts of your insurance?
Yes. I might just stand back because insurance is cyclical, so this might help put the context around it.
Yep.
Between soft and hard markets.
Yep.
Certainly over the last 10 years and the last 5 years, we've seen hard markets in many different parts. It's not uniform, so we might see a hard market in, for instance, property, and then it might move to liability.
Yep.
Over the last couple of years, a number of classes, including liability, have started to soften, which tends to mean premium rate is coming down, and it's because there is more capacity in the market. Premium might have reached an area which is more attractive to other insurers, and money comes into the market, and it tends to bring premiums down. If we look at some of the key areas that have been particularly...
Before you go on, can I just ask a question there? How can the general public see these trends? Where is the data in terms of detailed data that's not aggregated across the sector or embedded with international reporting?
Yes.
Because it seems to be, based on the evidence we heard yesterday, even with APRA, there seems to be many blind spots for public observation and testing of what's actually happening in these hard and soft markets as there's movement.
Where you can get data is at a higher level. So if I look at liability overall, the APRA stats show a 30% increase in in claims costs over about a 10-year period, and that's a report that we would use as an industry. But there are a lot of sectors within that, so they wouldn't experience it uniformly. If you're in a higher risk sector, that might have been higher increase than in lower risk sectors. It's not uniform right the way across the industry.
So I understand that, and thank you for making that very clear. That is exactly what we heard yesterday. But where is the detailed data for public policymakers to deal with the challenges of thin markets in particular areas that are vital still for the proper functioning of good business practice in the country? To whom do you report any of this data, and where can the public observe this and interrogate it?
Yeah. So the data that we report is to APRA. That's the primary.
So there's okay. So it's not sufficiently robust for us to actually interrogate different parts of the market to reflect the concerns that are being raised with us by different sectors at different times.
It's collected at a higher level than if we wanted to go into one very smaller subsector, that would be a lot harder to see in the APRA data. It's divided between components like liability or property, but diving into that would be harder to see as an industry as a whole. It definitely would be.
But as an insurer, you see that data, correct?
We see our part of the portfolio.
Yeah.
So there may be risks that we're not insuring.
Yeah. Okay.
Yeah.
And so back to then my question, where are you seeing, so you're talking about soft and hard markets, where are you seeing the most increases? So what sectors and in what part of your insurance? Is it liability? Is it professional indemnity? Is it building? Yeah.
So probably the two key areas that I would talk to, I'd start first on the property side. Yeah. The increase in weather events, in urbanisation in high-risk areas, which is where we come back to planning, where you might have floods, you might have bushfires, and resilience in building meant that increased severity and frequency of events in areas where we've continued to build has made that really expensive. If you add to that inflationary pressures that builders and supply chains have had post-COVID, there has definitely been pressure in that market, and it particularly hits high-risk areas within Australia. So that might be flood zone areas, cyclone, storm-prone areas. They are particularly impacted. The second area I would go to is around liability. What we have seen in liability, and I think you referenced it's 25 years since reforms were looked at, is we have seen an increase in that area of legal costs, psychological injury type of claims, related things like areas like PSA, dangerous recreational activities have come through in higher numbers, and worker-to-worker claims. So there are probably three areas where any sectors that are exposed to psychological industries or dangerous recreational activities, worker-to-worker, children, they have had increased cost coming through over recent years. Now, there are other drivers, but they would be two areas that I would really call out strongly.
And the increase in data in the liability space, is that collected by APRA?
Yes, but the level of granularity is probably different to what you're looking for, but yes, APRA collects data.
APRA collects that data, okay. Just on the risk mitigation, some of the evidence that we heard yesterday, there were a couple of stories, and I don't want to steal Scotty's thunder here, but there are areas in regional Queensland, Charleville and Roma, where there has been significant risk mitigation undertaken to protect those the homes in those areas. And we heard also from the tattooists yesterday that there are a lot of historical risks in their sector. For both of those examples, what we heard was they're not influencing the price that insurers are paying. So, for instance, in Roma or Charleville, a lot of businesses in those towns, even though there's risk mitigation in the last big flood, there was no damage to property. The flood before, they built the weir, there was damage to property, but those changes in the risk mitigation have not been reflected in their insurance premiums. And similarly with the tattooists, what they're telling us is that the basis of the risk assessment in their sector is based on historical issues, and the insurers are not taking into consideration all the requirements that they've had to follow, particularly over the last 10 years in terms of their reporting to police, their security clearances, all of this which they've undertaken to effectively clean up the industry. So how do you look at those, as an insurer, how do you look at those issues and how do you weigh up that risk reduction in terms of, and how does it factor into the pricing? Because we've heard it from a couple already, so yeah.
So maybe if we talk a little bit about how we underwrite risk and how we price for it,
Yep.
because we look at it on a risk-by-risk basis. So while we might start with what does a sector look like, it then becomes very important how do we look at the individual risk within that sector and what mitigation may they have undertaken. I'll pass to Pat in a moment, because one of the most important things for us is how the underwriter works with our risk solutions capability and with industries and the broker to be able to assess a risk adequately. So I might just talk about some examples around where mitigation then flows through to a reduction in premium once we have those conversations.
Thanks, Sue. I would say when we're looking at pricing, we really look at three key factors. We look at the nature of the risk. So what are the operations that we're being asked to insure? We look at the exposure, which is obviously then at that stage kind of what is the quantum of the risk that we're being asked to take on board. And then we look at all of the mitigation activity that is happening to address those risks. And we do that at individual client level. That's how our pricing models are set up. And I think as Sue was kind of flagged in her opening statement, and I guess just based on some of the testimony we heard yesterday, I thought it was really important for us just to bring flavor in terms of how we invest in terms of making sure that we are having and supporting our customers through that mitigation discussion. We have, as Sue has articulated, we have a QB risk solutions team. And what they do...
Can we just go back to the pricing first?
Please.
Yeah, go back to how does that risk relate to your pricing? Like, because if you're a small business and you've done certain things to mitigate and your premiums aren't reflecting that, so that's what I'm trying to understand.
Maybe if we give a direct example in relation to sprinklers.
Yeah, agreed. So if we think about, for example, rating that we would use, we would adjust our rating in a situation, for example, when we look at a property, particularly a property that could be exposed to fire. If that property has taken the measure of actually putting in place a sprinkler system that is effective in controlling the event of a fire, then we would recognize that in the premiums. And on average, we would, just to give you a number, although it would be very specific per client, but on average it would be 20% cheaper if you've taken that step in terms of putting that mitigation action in that space.
And is that a general practice across the industry that you're aware of? Because if you do that in that instance, we're obviously hearing examples where that's not happening. It may not be your clients, I admit that.
We probably can't speak for the industry as a whole because everybody will have their own versions of what would reduce the risk.
Yeah, fair enough. Fair enough. I do want to just quickly jump on the regulatory burden that you were referring to. What are you referring to? You said we need to reduce the regulatory burden.
Yeah, so if we look over the past sort of 10 years, there have been a lot of changes to regulation that have come through for the insurance industry. What that means is that
state level and federal level?
Federal, yes. A lot of change came off the back of the Royal Commission into Banking and Financial Services, and a lot were conduct related and were needed across the sector. But it's probably time to have a review and not be additive to that, because what it creates is a regulatory impost of review by regulators, data collection by regulators, and this tends to slow down investment in innovation and change because we are responsive rather than thinking forward. And I think a lot of these would be good to have a review and go, how many of these are actually delivering the outcome that we expected when they were initially put in?
Okay. Thank you. I've got lots of questions, but I'll let you go.
Thank you very much. Could I just go to your announcements of your full year results in 2025? QBA today announced its full year 2025 financial results, reporting a statutory net profit after tax of 1,157 million, which increased from 1,779 million in financial year 24. Adjusted net profit after tax increased to 2.132 million from 1,729 million in the prior year, resulting in an adjusted return on equity of 19.8%. Is that Australian figures or international figures?
That's our group positions. We at QBE, the
What does that mean? Our group, Australia's
QBE
group, international? Yes.
QBE group, which includes the 26 countries that we operate in.
Great. And what is the benefit to Australian consumers of insurance products by having an international provider of insurance in our market?
If the key thing about insurance is how can you diversify your portfolio? If we're global, we can diversify it more. It means that our reinsurance program can be a global program and we will get the benefit from that. But also we're able to leverage and benefit on things we might do globally. An example I would give is around cyber product. A couple of years ago, we invested in a global cyber product that we will be able to bring here to Australia. And we can roll that out across the community here. So being able to leverage each other's capabilities is also important.
So if I go to page 2 of the announcement, and this is dated 20th of February 2026, the code is light blue, North America, dark blue, international, and then Australia Pacific is indicated in orange. It goes into some detail about gross written premiums, ex-cat claims ratios, prior accident year claims development, and then it talks about the investment portfolio performance. How's QBE going in terms of its profitability, and how is the Australian part of that going?
Yeah. So we would always look at profitability through a cycle because of that cyclical nature.
How long is your cycle?
We would generally look about 10 years, maybe longer than that in some classes. But if I look at 10 years overall, then as a group, our average return on equity over then 10 years has been around 6%.
In Australia?
No, that's for the group.
Okay. And in Australia, what's it mean?
In Australia, I can't give you a return on equity, but what I can give you is the underwriting result, which talks to the actual business of underwriting and paying claims. If I look across Australia, over 10 years, that result has been between 7 and 10%. But it's also important to look at sectors within that. So if I look at the small business community, that's been around 4% since about 2020. It's a bit of a shorter term scale there. In the last 3 years, the underwriting profit for the small business community in Australia, as measured through our business packages, has been between 1% and 2% margin.
Okay. And that 1% to 2% margin in the small business sector is not meeting your average of 7 to 10 years. So you're offsetting that against other parts of the business that are more profitable.
It does mean that larger businesses would be more profitable than the smaller business.
Okay. So small businesses are telling us that their premiums are increasing at an extraordinary rate. So what's going on?
I think it comes back to, excuse me, I think it comes back to how we underwrite risk. At the end of the day, what we do is we have to charge a premium for the cost of the underlying risks that those businesses face. And if we're in an environment where, for instance, increasing weather events, where we've got increasing liability costs because of the changes that go through some of the society expectations that come through, then we have to.
What do you mean by that?
So if I think about in liability, some of the key areas that have shifted have been around psychological claims in recent times, anything involving children where there's a risk of physical and sexual abuse, anything around standards in relation to physical activities, which could be adventure tourism type of things or activities that schools may undertake. All of the costs of these have increased significantly over recent years. Worker-to-worker claims would be another example. So what we did as an industry was we commissioned the ICA to look at liability in particular. As you know, we've prosecuted a lot on the side of natural perils events. but actually to go in and look at what are the underlying causes here that are causing costs to go up, which then results in an increased premium. As you can see, we've not turned that into profits. We're really just trying to cover the costs that have risen over that period of time.
Okay. And we kind of have to take your word for that as evidence here today, but we have nowhere that we can actually see any of this data. It's just not available to us through APRA. We asked questions yesterday, so there is no reporting of this. So essentially, I think it's day 2 of the inquiry, but what is becoming more apparent to me is that social policy is being made and business policy, economic policy is being determined on anecdotal evidence without access for the public to critical data to interrogate claims that are made. So there's probably a trust deficit there in terms of information availability about what's happening. Can I just ask what these words mean? With regard to underwriting performance, the statement to the ASX, the announcement on the 20th of February said underwriting profitability tracked ahead of our plan for the year, following a similar outcome in 2024. Does that indicate the softening of the market or hardening of the market?
Well, the market hardened in some places and softened in others.
Right.
It really comes back to did we charge the right premium for the risks that we underwrote? As an insurer, we underwrite that premium and charge that premium before we know the full result of the claims.
Yep.
It also depends, was it a year where we had major natural perils events globally? And 2025 was not as didn't have as big events globally as 24.
So the combined operating ratio improved to 91.9 from 93.1% the prior year, and that was, as you've just said, supported by favourable catastrophe experiences, so fewer critical climate-related events. But in terms of gross written premium, it says here solid momentum continued in the period with a lower strain from exited lines. What's an exited line?
So that may be an area of business or a particular channel that we've decided not to go through. So if I give you an example, in Australia, it may be a broking channel or a banking channel where we decide not to sell the product through that channel anymore. If I look over the last couple of years, we've exited some channels where we've had a relationship through a bank and decided not to continue that for whatever reason at the time.
Okay, so exited lines means removal of product offerings through particular parties.
It could be through, it's likely to be through particular parties.
Okay, but what about
Occasionally
the
it's
product
through a
itself?
sector. Yes, so a sector that we exited in 2024 in Australia was tobacconists. And we made that decision on the back of malicious damage claims.
Which is very similar to the challenges that I think were described by the tattooists yesterday that was relevant to them in 2012, which they assert is no longer relevant to them 14 years later, but still being applied, that there haven't been any arson attacks or any problems like that with tattooing, but this is the problem that you're describing with tobacconists. So they've got no insurance option with QBE, is that correct?
A tobacconist doesn't, that's right.
Okay, so this is the thing, that there's a movement in and out of the market to protect your viability and your compliance with APRA requirements for liquidity to be able to pay out what's required if there's an event.
Yeah, there's two things happening there. Firstly, we do have to be a viable insurer for the longer term. So we're regulated by APRA, who do look at what does that profitability look like, what's our pricing adequacy.
How sustainable are you?
How sustainable, exactly. But the other side of it, it does come back to when you think about the whole system, a business either accepts their risk, mitigates their risks, or transfers it, in this case, to an insurer. If there isn't a randomness and it almost becomes a certainty, there comes a point where the insurer goes, mitigation has to be done before we can accept the transfer of that risk. And that has been the case with tobacconists over recent times. Now, what will happen, it will take time to work that through, and then insurers may come back into it or they may not. And that's really a choice on where do you deploy your capital and where do you think the most important next step is. If I look at that in QBE's case, right now, a lot of our investment is going, how can we offer new and different cyber products.
Yes,
because we're seeing
everybody's
that
seeing that
broad.
as a growth thing.
Yes,
But
yeah.
we have to look after all Australians and understand what's happening for small business. And the thing is, when people have no insurance or they're underinsured, the consequences flow onto the public purse quite predominantly. And that is another cost centre that we are concerned about that has nothing to do with the profit of QBE and has little to do with the small business itself as it's seeking product. But it operates in an ecosystem. So if I can just go to market hotspots that were identified for us by Finity yesterday, worker to worker, what's your definition of what worker to worker means?
I might let Pat talk about this in a little bit more detail, but worker to worker is where a worker has gone through the workers' compensation system and then makes a liability claim. Pat, maybe can-
And it really is a situation where what we can demonstrate or what the worker is able to demonstrate is that there was some negligence in terms of why that injury occurred. So they generally tend to go through the workers' compensation, obviously through their employer, and then what the scheme then has an opportunity is to reclaim through to the public liability.
Thank you. Also, other market hotspots that were identified were US exposures, PFAS, music venues, which we heard evidence from the music publishers yesterday about that ecosystem being impacted by the removal of insurance. So that's one of those exited areas.
So at QBE, we do cover the music industry. I think it's probably heard yesterday, it's a very broad industry, which means that we look at that sort of risk by risk. And it comes back to how much alcohol served, the size of the venue, the number of people, is it late night? That will impact the risk. So we have a facility which we call a hard to place facility, where people can come to that and we can assess it individually, and we try to offer cover. But there are some times where that's just outside of appetite because it needs mitigation in some way, whatever that might be.
Yeah.
Yeah.
And where do we see these sort of discussions happening? Because we have community members who are talking to us about being unable to access music venues and opportunities. This conversation is clearly going on between providers of music festivals and the insurance sector. But people who want these things to happen, they contact us, and they're very disappointed that they can't do that. And nobody's getting any no one's getting any oversight or visibility of what's happening in terms of these negotiations. What are the mitigation things that are being asked? How reasonable or unreasonable are they? How many requests for this kind of business is being made? What are the costs that are associated with all of that? And the flow-on effects affect all of our creatives. They affect, the mental health and well-being of people who can't go and enjoy music as well. So it's not just a pure numbers decision that is embedded in this challenge that we face as a nation right now with regard to insurance.
I'd completely agree with you. We would like to be able to offer insurance. One of the important recommendations that we've made is how do we collaborate across government, industry, and individual industries to go, what are the pieces that we can educate them in relation to mitigation that could help the affordability of insurance, and doing that more on a national basis rather than the conversations that we have with brokers who are representing industry and small businesses.
So would
How
that
do we
be a
make that more
recommendation that
visible?
you'd make, Ms Horton,
Yes.
that there needs to be some site at which facilitation of sector-based conversations could occur rather than the practice of individually pricing all of these matters?
Absolutely.
And who would do that?
I think there's a role here for the insurance industry bodies, so it might be a guild or whoever that might be, and government together to look at what should be standards, what would be strong mitigating factors by sector. Because some of these sectors are so broad, we need that kind of individuality around what's important.
And I would just add that from our perspective, would be very keen to bring the expertise that we have from a claims perspective and really bring that to fore so that when there are standards that are being developed, they really are the ones that are going to be addressing the risk.
I think Ms Lawrence has some questions, and I certainly have more, but I'll go to Ms Lawrence now for a line of questioning.
Thank you. My apologies I'm not there today, but thank you for your time and your submission. What level of transparency is provided to policyholders where there is a premium increase at renewal?
So 90% of our products, the vast majority, is sold through a broker or an agent, and that broker or agent works on behalf of the customer, spends time with the customer, and would have conversations with us around what might be increasing the premium or changing the premium. So there is visibility of what the underlying risks might be and how we might be thinking about those. But that conversation then happens between the broker and agent and the customer, not between us as the insurer.
And the only thing I would add is that I think for us, it's a lot of our brokers and agents live and work in the communities, obviously, that they're serving, which means they're able to bring specialist knowledge, which helps really support the conversation that then they might have with the customer and the conversation that then they have to us at those crucial moments when there's a new business or a renewal policy.
So does the broker then have access to how what the pricing methodology is? Like, is it algorithmic? Is it an automated review? Is it to what extent is it informed by national or sector-wide risk profile versus that local business in a little street, in a little industrial area? So what access does the broker then have to your pricing methodologies?
To be honest, we would have a very good conversation with the broker in terms of, for us as an insurer, to really understand that risk. So therefore, it would be they would understand how we price, i.e., the rating factors that we need to look at. They would be collating that information to really put it together to be a submission for us to enable us to assess that risk. And one of the discussions that we have kind of through that transaction is really reflect that mitigation, and really have a discussion about what are those steps that that customer has taken to mitigate their particular risks, or in addition, what can we do as an industry, or as in jointly between the broker and ourselves, to leverage some of the risk expertise that we have to support that customer. And I think one of the conversations that we were having was in terms of using risk solutions, which enables us to have a risk engineer go to that particular client and assess their risks and what they're seeing. And then what we have as a result of that is we propose to that client very clear risk recommendations of how they can help improve their particular risk trajectory. But in addition to that, because we don't think it's just enough to say, here are some recommendations that you can take, the other thing we do is we also have a panel of suppliers that we make available so that if they choose to make any of those risk recommendations and invest in those, they have a mechanism to actually enact those risk changes.
Right. Appreciate about the panel comment. But just getting back to the pricing methodology, does a business have a means to have it independently verified, or a means to be able to speak directly the evidence of any change? I appreciate you're going through a broker, and the broker is there to be that interface. But I'm just trying to understand what agency a business has to be able to have the assessment and any change in risk profile independently verified, or a means to be able to challenge or seek a review of the pricing methodology.
If I can answer that, I don't think it's as much the pricing methodology as the risks that trigger the pricing methodology, because the action that a business can take is to say, okay, I can see that this risk is a driver of price. Is there any mitigation that I can take? And that results in a reduction, and that's the conversation that happens between the broker and the customer.
Are you confident that those
Does it
conversations
result in a reduction consistently, though, or is it just a case that the price doesn't go up as high as was expected?
I mean, what I would add is to say that a broker, through their licensing requirements, has obviously a a duty to perform the service of acquiring insurance for that particular client. So we would expect in a situation where they look at our premiums, we have a discussion about why that's happened, that they would look at alternatives for that client and say, we operate in a competitive market, so we would expect that they would go, we would have a discussion about what we think is driving that risk, and they would look at for alternatives.
And how
to
is
support
then the
that client.
broker, sorry to cut you off, just a little short for time, but how is the broker's fees determined? Is it a percentage of whatever the settled premium is? Is it based on the product mix? How are they paid?
So it can vary. The broker can charge a fee to the customer, or they can get a commission from the insurer. And those commissions vary depending on the complexity of the product that's being sold and the complexity of that business's operations.
And so for the 90% of business that you do through brokers, what percentage would be done as commission-based versus a fee directly charged to the business?
We may not always know about the fee because that's between the broker and the customer. We would generally pay a commission.
And is that for just as a one-off, or is it a monthly percentage of whatever premium the business is paying?
So we pay a commission for new business. So the inception, because there's more work being done then, it would be a different commission rate for a renewal because work is done at renewal. If you can imagine you go out to a farm, you're still going to assess, have they bought new machinery, what crops are they planting, what's changed for a small business year on year. So there is still work at renewal for the broker.
I just want to ask a question there, Ms. Lawrence. So what is
Yeah,
the
sure, thank
percentage of the initial commission?
That can vary
From what to what?
from maybe around 10 to maybe around 30%. Yeah.
Okay. And what's the reason for the variation?
The complexity of the cover being offered.
Okay. And how transparent is that to the purchaser of the insurance product?
That is transparent. Yeah.
Because that was one of the requirements out of the Royal Commission, which is one of the regulatory reforms that was implemented. Okay. And we certainly don't want to lose that one because transparency is kind of important to most people.
We would agree.
Okay. So then the trailing commission, what percentages are we talking there?
Typically that's around 10%. Yeah, typically around that.
Okay. Back to you for one more question, Ms. Lawrence.
Thank you. Do we have any data on the health of the broker market? Like, we've obviously got a big focus for your earlier questions around the viability and profitability of insurance. How is the broker sector faring? Is it like financial advisors where there was a bit of a shift in some stresses, or is the broker sector quite healthy?
No, I would say it's not like financial advisors. The general insurance broker market is healthy, as are the agencies. They're right the way across Australia. Yeah.
And I would just echo there is strong competition in that market as well. Just like there is in the insurance market, you would expect to see continual competition in that space as many brokers are looking to grow their books. That would continue.
So we'll get some brokers in this afternoon. If I can just close out with a couple of questions and indicate that I have questions on notice. And these are preliminary hearings really to kind of get the shape of what's happening. So we may need to call you back a little further in the process. There is a very significant narrative that's being reported over and over that the cost of claims is driving the cost of premiums. I have not been able to identify any evidence that gives me confidence that that is the case. It's oft asserted, but where is the evidence? Do you have any?
We do within our portfolios because that's how we look at the risk. I think a piece of evidence is, as we put in our submission, in our business packages, our profit margin is 1%. So if premiums have gone up and it's remained around that sub 4% for 5 years, it's because the underlying costs have gone up, not that we've made more profit.
Where do I see the different elements of the costs rising? So it's being asserted that the claims are the problem, but there's also state taxes that are being blamed. what's the proportionality of that? Where is the data for us to interrogate about these claims that are being made?
Yeah. So I think I would come back to APRA
They don't have it. They don't have it at sufficient data level.
They might not have it at the granular. So I think you can see it at a high level, like liability. You can see what's increased. Has it been commission costs? Has it been reinsurance costs? So the breakdown of a P&L is something that APRA has, but they wouldn't have it at, for instance, live music venues. That would be with each individual insurer.
And where the market is thin or non-existent, we've got no idea about what's going on there because there's no data being provided for the products being removed.
You only have it at a class level for the industry. You don't have it by subsectors. I don't believe that APRA collects that data.
Okay.
So it's only with individual insurers.
So if you could provide on notice a response to the Conrad Liveris submission to the committee, which makes some recommendations and offers some key insights into what's happening with the civil claims and the legal profession. It also notes that there's a poverty of data and observability for people who want to make policy or people who want to interrogate their options across the sector. There's a lot of darkness in terms of information access for the public to make informed decisions. So I would ask you to have a look at that and give us as much detail as you can, sector by sector, for where claims have been made that you believe are critical to the driving of costs that are relevant, particularly to small businesses, right? Particularly to small businesses. The other point, if you can, I don't know if you can give me a quick response now on this. It's a common practice for witnesses in the private sector to ask for tax and duties and levies at states to be removed. The argument is it's inefficient. Okay, but the businesses that operate in those states need roads to drive cars on. They need, they need all of the things that the public access to enable them to do business properly. What's the quantum of what you're asking this committee to consider removing, state by state?
So we have it state by state. It does vary. The highest would be Tasmania and New South Wales because they have emergency service levies in the order of the high 20%, so they vary slightly year by year. Stamp duty by state varies between about 8% and about 11% on top of that. And then there is the GST, which is standard. I agree with you that everything that goes towards has to be funded.
Correct.
It's whether this is the most efficient and equitable way of doing it.
So New South Wales is the only state that remains with the emergency services, but they are actually undertaking a review of that currently.
Yeah.
I think Ms Lawrence asked a very good question yesterday, and I'll put it to you too. Where the emergency services levy has been removed in the other states, what evidence do we have of a reduction in costs to insurance in those states?
Again, the APRA, from memory, I think the APRA data looks at things by state, so you would be able to see the levy coming out of insurance premiums in those states.
Yep. So the levies come out. What's the cost transfer though? Like, has there been profit taking at that point, or has there been a reduction in premiums?
No, because we charge a premium. The levy's then a percentage of that premium is on top of that.
Right. Okay. So as soon as that's gone, it's gone.
Yeah.
Okay.
It doesn't impact us at all, really.
And increases that follow would be just your reckoning of what you need to make that a continuing proposition as a product in the market.
That's right. Nothing changes on how we do it. We're essentially a tax collector that collects it and passes it on.
Okay.
Yeah.
All right. Thank you very much. As I said, there'll be further questions on notice, including, if you could provide me a proportion of the premium increases faced by small businesses that are attributable to claims experience as opposed to capital reinsurance and regulatory costs, for example. So I think a lot of this is fact-finding about desegregated information for us to be able to figure out what's happening in what spaces. Okay, thank you.
Thanks, Chair.
Thanks for that. And we appreciate you appearing today If you have been asked, you have been asked questions on notice, if you could provide those to the Secretary by the 29th of May 2026, that would be appreciated. And I now call members from the Business Council, Cooperatives and Mutuals to come forward. Thank you.
Thank you.
Thank you.
We've got Mr. Taylor on the phone for this group.
Oh, okay, great.
He's logged in.
Okay. How are you? Good. Have you got questions for the expert? I'll come to you guys first. So, yeah. One of the insurance companies to give us response to this submission. Conrad Lewis.
To respond to his recommendations, or just a general response to the submission?
Detailed response to the recommendations, and then respond to the thing that overall is good. But yeah, thanks. Thank you for joining us, Ms Morrison. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. And I understand also that you're joined by Mr Taylor by teleconference. Can we just confirm that you're there, Mr Taylor?
Yes, I am.
Excellent. Thank you very much. For the Hansard record, will you both please state your names, your full names, and the capacity in which you appear today? We'll start with you, Mr Taylor.
Anthony Taylor, Policy and Government Affairs Manager at the Business Council of Cooperatives and Mutuals.
Sorry, we can't understand what you're saying. That sounded like some other language. So can you just...
I'll try again. Can you hear me now?
Yes. Are you speaking directly into your phone?
Yes.
Yes, that makes a difference. So try again, Mr Taylor. It's not a hard question. It's your full name.
Anthony Taylor, the Policy and Government Affairs Manager at the Business Council of Cooperatives and Mutuals.
Thank you very much. And
thank you, Madam Chair. Melina Morrison, I'm the CEO of the Business Council of Cooperatives and Mutuals.
thank you. I now invite you to make a short opening statement, at the conclusion of which I will invite members of the committee to ask questions.
Thank you very much. Thank you again, Madam Chair and Committee, for the opportunity to appear today. I'm from the Business Council of Cooperatives and Mutuals. We're the national peak body representing the cooperative and mutual enterprise movement across all industries, including insurance and risk protection. We commend this inquiry. It is very obvious from the submissions that underinsurance is both a social and an economic problem, and the impact of business and community organisations retreating from markets is in many cases catastrophic. So we come here as a sector that provides solutions in some circumstances. We also noted from reading the other submissions that there's not a one-size-fits-all solution, it would seem. Other submissions have mentioned the important role of governments, regulatory frameworks, risk mitigation and industry collaboration. And it's around industry collaboration that I'd like to focus my few comments at the beginning. I represent a sector that is a vehicle for industry collaboration, and many of the inquiries that we get at the Council from community groups, from small businesses, are desperately seeking a solution to markets that have typically failed completely for them. So many of the inquiries around markets in which there's no insurance available at all. So there are more than 1,800 cooperatives and mutuals in Australia. Hundreds of these are owned by small businesses or not-for-profits, not only farmers and fishers, but independent retailers, plumbers, mechanics, doctors, faith-based organisations, community housing providers, independent social care providers, and many more. And what these producer-owned cooperatives and mutuals across these different sectors share in common is the objective of building economies of scale and purchasing power for their members. So as an example, at the moment, the BCCM is running a Care Together program on behalf of the Commonwealth, and one of the focus areas for this program is supporting smaller regional aged care providers to come together to share back office and regulatory costs, including potentially the purchasing of group insurance or perhaps even pooling their risk. Another long-standing and proven model of small business cooperation is insurance and risk protection. In fact, it's probably the oldest way of organisations coming back together to do this, back to Roman and Babylonian times. And this includes a few different models in Australia. So mutual insurers like EML, discretionary mutual funds like Capricorn Mutual, and cooperative insurance buying groups like Archie Team, which is a group of architects across Victoria that pool their insurance costs. Of these risk pooling models, the discretionary mutual fund model is the one that's been growing notably over the last decade, particularly in small business and not-for-profit sectors. And this is because it is flexible and can facilitate innovative solutions, but it must be well structured, and that's what we would like to emphasise today. It must be backed by a real business case, and it's not a panacea for every risk. We've been working closely with members through our Discretionary Risk Mutuals Forum and have produced industry research, which is called the Pulse Check Report, and we promote good practices in the industry through principles and a code of conduct and good practices guide, as recommended by ASBEFIO in a discretionary mutual fund review a couple of years ago. This can aid policymakers and industry understanding of this model. So just in conclusion, the forthcoming second edition of the Pulse Check report confirms that the discretionary mutual model is continuing to grow. In 2025, there were at least 28 mutual funds active, that's conservatively, of which 18 were formed less than 10 years ago. So new mutuals have been forming to serve groups such as faith-based organisations, motor dealerships, housing providers and hospitality businesses, and they conservatively have 150,000 members, including tens of thousands of businesses and not-for-profits. Importantly, one of the enabling factors in the growth of discretionary mutual funds over this period was the introduction of a definition of a mutual company in 2019 into the Corporations Act, along with the ability for such companies to raise a special type of share, a capital through a special type of share called a mutual capital instrument. And we estimate that around $10 million in start-up capital has been raised in this way specifically for discretionary mutuals serving the small business and community organisation sector. So it's just in conclusion, it's most important that further reform could support the solidifying of the mutual model and encourage its long-term sustainability through the provision of a permanent asset lock framework in the Corporations Act. This means protecting the corpus assets from privatisation, and this would be an opt-in framework, voluntary, drawing on best practice in other jurisdictions where it's a common feature, including the United Kingdom. Where policymakers were considering whether to support a mutual risk solution, potentially even additional capitalisation, this would provide an additional safeguard for any allocation of public resources. I'll just conclude my comments there and welcome any questions from the panel.
Thank you very much, Ms Morrison, and I'll go to Mr Sharma first.
Can you just tell me a little bit about your membership?
But more broadly,
yeah.
So we are a cross-sector industry body.
Yes.
Possibly the best way to think of us is we are the Business Council of Australia for mutually owned businesses.
Okay.
So what this means is that all of those cooperatively and mutually owned businesses across the Australian economy have a voice in terms of the underlying model, which is a member-owned structure. There are variations of that structure, but they all are mutually governed and member-owned organisations. We're talking about credit unions, building societies, mutual banks, roadside assistance mutuals, these general insurers and discretionary risk mutuals, community housing groups, aged care cooperatives, the traditional forms of cooperatives we often think about, such as agriculture and retail sectors. And a very long tail to do with community organisations that often come together around a shared problem or need.
Okay. And then I believe in your submission you made the point that the legislative and regulatory framework for mutuals is still not fully adequate. So what are you seeking there exactly?
Well, we do want to...
What are your recommendations?
Well, thank you very much, Senator. We like to thank again bipartisan support that was granted for the solidification of the business model in the Corporations Act back in 2019. In fact, the coalition government was very important, supported by the other parties. So what that did is identified mutual companies as being one of the forms of private companies that are utilised by Australians and small businesses, and have done since the founding of our great nation. It introduced, very importantly, access to capital that equalised the sort of start-up funding you need for where you're taking on risk, or capital deep, and there's a capital-intensive period for growth. And this has definitely spurred some growth in discretionary risk mutuals. However, what it hasn't introduced is another important part of protecting this business model from raids, I guess, on the corpus, the legacy assets that are built up by members for a very specific purpose, which is to bring together pool capital and need to be able to address an issue. So this legacy asset protection is ubiquitous across other parts of the world, particularly Westminster jurisdictions like Canada and the UK, and it's a safeguard against demutualisation, where it's promoted as a way to unlock those legacy assets which were built up for another purpose. So it doesn't prevent corporatisation, but it just prevents the raid on the legacy assets.
So your recommendation is an amendment to the Corporations Act?
Yes. It's voluntary, of course. This shouldn't be enforced. This is just part of the general uplift of the model across many different sectors. But as we're looking at increasingly difficult environments for smaller businesses to thrive and sustain themselves, then the mutual model, which is a self-help model, it becomes ever more important again. Probably, back to the future in many ways, that communities have come together historically throughout time to be able to address a need together through a commercial business model. So now more than ever, we need to recognise and support the business model. Those caveats being around, they must be very well governed, well capitalised, have strong business cases.
Okay. Can I just ask, you make an example of, I think it's Hospitality Insurance, Industry Insurance Limited in your submission, and you make the assertion that HII provides policyholders with a 15% savings on premiums up front, and over 10 years has reduced upfront premiums by 24%. Is that reduction relative to the commercial market? What are you measuring that against? Where's the 15% and the 24% figure measured against?
Thank you very much for the question. I might ask my colleague Anthony Taylor to just provide some commentary around how discretionary risk mutuals can lower their operating costs and therefore their costs back to members.
Thank you. Just on that specific question, can we take that one on notice?
Okay. So as I said, you make the claim that it's a 15% saving on premiums up front and 10 years has reduced premiums by 24%. So I just want to know, what's that savings in relation to? Is it what they paid previously or whatnot? Yeah, so if you don't have that answer, if you could take it on notice. But is there something in the cost structure or cost base of mutual insurers that allows you to offer products at a lower price than commercial insurers? And if so, what are some of those features?
Anthony, do you want to answer that?
Yes. So more broadly, on first principles, one of the strengths of the mutual model is it doesn't have outside shareholders. It only has the group of consumers, small businesses or individuals pulling risk together. So if you have a viable business, you can reinvest the surplus into risk management, into lower premiums, better coverage, all those things. You have a margin there that sort of you could call like a mutual dividend.
Because you don't need to
a successful mutual can
make a profit
can reinvest.
or provide
That's
a
right.
return to shareholders or a return on capital.
You have to make a surplus, a profit, in order to reinvest in the mutual, reinvest often in mitigation strategies, because the mutual is incentivised to try, it's in everyone's best interest to try and lower the ongoing exposure to risk. And sometimes those surpluses that are made are specifically, and the members agree, specifically reinvested back in mitigation practices. But you haven't got the 15% going out, typically for shareholders, and you're only motivated to do one thing, which is to try and lower the risk, the overall. The mutual is set up for one reason only, which is to transfer risk from the members, individual members, onto the mutual and then create a sustainable ongoing solution. It should be noted, however, that all risk protection vehicles exist in the same risk market. So the idea that it's a panacea in all cases, they all have to go to the market for reinsurance. The actuarial studies in any market are going to price reinsurance at the same, at the same level. So it's not, the cost savings are really through what is essentially a sort of not-for-profit model running and managing the risk on behalf of the members. But it's very hard as risk, the underlying risk increases.
Okay.
Yeah.
And how, just conscious of time, I want to share the call with my colleagues, but how prevalent is mutual insurance or this form of insurance currently in Australia, and where are the sectors or industries where it's, I guess, in best health?
So I'll just start with globally. The International Cooperative and Mutual Insurance Federation, which is the global peak body, estimates that 30% of all insurance operating globally is mutually or cooperatively owned. Mm-hmm. So it's a very, scaled sector. In Australia, we have a diminishing market in the insurance market, primarily because of either demutualisation events historically or currently, so the market share has actually shrunk. Discretionary's mutual market share is growing. My colleague has some from the Pulse Check report, which is just being finalised at the moment, has some more up-to-date figures on the mutual insurance market. Can you share those, Anthony?
Yeah. So our estimate at the moment is that there's 14 general insurance mutuals active in Australia.
14.
And they have around 4 million members. And then I think, as Melina mentioned in the opening remarks, our estimate is there's around 28 discretionary mutual funds active in Australia. That's conservative because it is a little difficult. We do the data collection. There isn't anyone else doing the data collection. It's probably on the lower end that estimate. And in the discretionary mutual fund sector, the premium contributions written from those 28 that we estimate is around $450 million. And in the general insurance sector, the gross premiums will be in the billions of dollars. But as Melina said, probably the overall picture is the market share in Australia is smaller than sort of a global comparison of where mutuals would sit typically in other developed countries, but it's still a not insignificant market share.
So you'd say it's less than 30%, but what, above 15%, or?
We might have to take...
I think we should take the specific number on notice, but yeah, it's certainly lower than the 30%.
Okay. And just you mentioned the discretionary mutual fund share is growing. Why is that, and what's the difference between a discretionary mutual fund and just a general mutual fund?
Anthony, do you want to describe the difference between...
I think I understand it, but it'd be good to get it on the record.
Thank you.
Yeah, so the key difference is a discretionary fund it's not an insurance vehicle. It provides a different type of product, which is a discretionary product where the member has the right to have the claim considered by the mutual rather than a right to indemnity. That's the key difference.
Yeah.
And that means it's a different option, it's a different model, and so it can serve different needs for communities or small businesses where potentially the existing options in the market are not working, or they feel that they can get a better deal by pooling their own risk and having a shared risk and reward through that model. So it's just a different way of pooling the risk.
But do the members of the discretionary mutual fund, do they pay a premium? Do they pay?
They pay a contribution into the fund that is, I guess, analogous to a premium.
But it doesn't give them a right to be paid in the event of a incident. It gives them a right to have their claim assessed. Is that right?
That's correct.
Okay.
And they don't get an annual return on their investment.
No, but nor would you if you're in a mutual fund either, right?
No, and the members set it up as well. It's an intergenerational model, but the members are coming together because they've agreed that it's economically rational way for them to try and transfer some of the risk. Madam Chair, you talked about, for example, music venues. If there's no solution otherwise available, this is when groups typically come together and say, what can we actually do if we pool our risk and our needs? So, yes.
Question though, like when you're trying to set up a business and run a business, and perhaps you have a broker who deals with insurance, or you just rely on direct insurance, there's a degree of financial literacy that you might not have around insurance. That doesn't mean you're not great at doing business, what you're good at, right? And I'm just thinking about scaffolding, right? There are a lot of hardworking people who are willing to use their muscle to set up scaffolding businesses and do what they need to do and help build Australia, literally. How long does it take, perhaps, for the scaffolders to say, okay, we've got a problem, we're going to get together and now get a mutual? Like, how do they reach you? Do you reach out to where there's a thin market or a non-existent market as insurers exit? Like, where's the connectivity for people who, I would hazard a guess, often don't even know that this model exists and is an option for their sector?
Thank you, Chair. The issue is education awareness. It's a systemic issue when the visibility of different business models is, variable. This is in the ecosystem around mutuals as well. So we exist as an industry body, and we try and do what we can with education and outreach. When we are funded to deliver a cooperative development program such as Care Together, then we can be very focused and specific around reaching out to markets, if you like, or groups of people where we can see there might be a reason for them to explore a business model.
So can I ask...
Accountants, financial advisors,
Yes,
lawyers, these are the people who typically you might go to as a group of entrepreneurs and seek advice. And if they're not educated and trained in mutual models, then that solution is not going to be put in front of them.
yeah.
To explore. There are some very good practitioners in Australia, but it's not ubiquitous.
I'll come back to you, Senator Sharma, but can I just ask you to give us an example of the aged care in regional that you've just named? What was the name that you used for them?
So the whole program is called Care Together.
Care Together. Okay. So
yep.
how did that come about?
The intervention of our program found this community, this group of aged care providers at a time when they were already starting to come together around a shared need. So in this case, across Murrumbidgee, there are 7 to 9 what you would call subscale or smaller aged care providers, critically important to the towns of Burrawa, etc.
Yep.
But they have a number of beds where it's not the business case as we go on with aged care delivery is not providing them the scale that they need to be able to continue to have sustainability. It makes so much sense for this group of 9 aged care providers co-located across a region to pool their resources and share the back office. solutions, that they need one payroll officer. They could do group buying of insurance, for example. They can do their regulatory work together. So they're now looking at a horizon of sustainability and keeping their doors open. How did it happen? We were able to provide advisory education and access to good legal and accounting informed services at a time when they wanted to do their own exploration. It's very important that people are not...
So is it incidental connectivity there?
Yes.
Right.
Yeah.
Which is not a systemic response. And
Yeah. I guess...
so it seems very chancy.
It is chancy until you have a recognition, both on the policy and the legislative and the regulatory side, that there is a compelling reason for diversity of corporate forms. And in some markets and in some circumstances, some models such as co-ops and mutuals might be preferred or more attainable. So we do need a legislative and regulatory environment which creates a sense of parity with cooperatives and mutuals, and a lot of other things will flow from that. Identification of the business model in various sort of policy scenarios. But we also do need, on the systemic side, we need an uplift around education and training, around the advisory community, around business formation.
So could I ask you if you've had any approaches from any of the sectors that have been named for us by Finity? I'm just thinking about how big the agricultural chemicals insurance issue must be for this amazingly productive agricultural nation. And that is a hotspot in terms of a lack of provision. How would you access that? Are you aware of that? How would they access you? Have there been any conversations? You know, like, I'm just trying to get the sense of, is there something that we could recommend around the identification of this risk and an assessment process? I'll leave you to think about that.
Yes.
Give us any insights that you have. Back to you, Senator Sharma. Thank you.
I just had one question. I just wanted to pull up on one example. So I think, is it Capricorn Mutual's an example of a discretionary, what's the right?
Risk mutual is...
DRM,
yes,
discretionary
DRM. Yeah.
So, and Capricorn Mutual operates in the sort of mechanic auto repair?
It's aftermarket repair, smash repairers, mum and dad. Auto repairers is the best way to think of them. 30,000 of them come together. They started with 17.
Okay.
So they were, Golden Fleece servo operators who ran mechanic businesses and needed to do some group pooling. So what's interesting about mutuals is often they will start doing one thing collaboratively. What emerged from their risk protection side was that their members were able to use the collaboration vehicle to say, we're really finding it difficult to find affordable insurance solutions for us as small businesses. So this is 30 or so years ago, they were already talking about how to collaborate. And because they already had scale, they capitalised the business themselves off their own balance sheet. So they were able to...
So they're self-insurers.
Yeah.
We've got to be careful with risk protection.
They do a bit of underwriting.
Risk protection is not insurance because of the discretionary nature. It's
be paid, yeah.
Yeah, but it is a form of it is a form of providing yourself with protection and cover in the event of a catastrophic, event to your business. So you're still getting a type of, cover and risk protection for your business.
But it's not insurance because it's not reinsurable.
Oh no, they have to be reinsured. Yes, they are. Anthony, but before I, it's insurers are regulated.
Keep track of this.
Stand the
If
bright
I can add,
lines,
Melina,
please.
in terms of reinsurance, sorry, just to add on that nearly every mutual have take out reinsurance. It's a business decision for all of them, but nearly every discretionary mutual would have reinsurance. And what we're seeing at the moment, the trend is more of them are having multiple lines of reinsurance. They're innovating in that area at the moment.
Who's the provider of reinsurance predominantly?
So that's where they're increasingly going out to overseas and using a whole different range of mechanisms in Australia or overseas to manage their reinsurance. So it can be through the big international reinsurers that everyone else would go to.
Yep. Can you name them for us?
More innovative.
Mr. Taylor, can you name some of these for us?
I can give that to you on notice.
Thank you. That would be helpful.
Yeah, thank you. I got the call again. What's the level of coverage of Capricorn Mutual like across the sector? I mean,
Of their members?
yeah, what's the market share in that particular industry they operate in?
Exceedingly good question, which we'll take on notice.
Okay, I mean, you might not be able to provide it precisely, but is it an indicative figure? Is it 1 in 5? Is it 1 in 4? 1 in 3?
It's a great question. I'll take that on notice.
Okay.
Later.
Thank you. That was all from me, Chair.
Thank you. Ms. Jarrett.
Thank you. I just need to clarify how this works. So a group of people get together, they have a shared interest, they put money into a pool, that pool then gets invested by the mutual, I guess.
Yep.
Certain elements of that attract a reinsurance.
It's part of their sustainability that they have reinsurance to be able to provide the response that's required in a when
Whatever
their
their
members need
rules
it.
say.
Yeah.
And so what happens when, like you said earlier, that you get the right to have an assessment? What happens if you don't get the right, and what happens? So if you get assessed, I'm assuming then the mutual says, okay, you've been assessed this amount of damage, we agree that we will pay for risk mitigation and risk and cleaning up what's happened.
So I'll give an
I'm just trying to really understand how it works.
No, it's a great question, and I'll give an example with a real life situation. So in Carnarvon in Western Australia, there are banana growers, and they're a wonderful bunch of family-owned farms. They have a lot of cyclones there. They have decided to keep farming there. They formed a risk pool where they put in. Over many years, when they have a risk event, they look at what the pool is, they look at what the need is, and they try and spread. They're only incentivised to do this. They have the discretion to work out what does the pool need to remain sustainable, so not to wipe it out, and what can we do to the maximum of our capacity to serve our members to be able to try and provide them back the financial support they need to re-establish their businesses.
Yeah.
So that's the best way to explain it, but it's different to an insurance contract. So often the discretion is in the mutual can have the discretion to extend cover or extend financial support to a member if it's in the spirit of the policy, even if it wasn't the specific thing they got the risk protection cover for. So it can often go in the member's benefit, but it will never, or it shouldn't, affect the underlying sustainability of the risk pool, because everyone's trying to make sure they're covered for the next risk event.
And because you're a risk cover, which I still find is not dissimilar to insurance, but be that as it may, there are certain professions that require insurance. Does that mean because of what you offer, because it's not insurance, you're excluded?
In some cases, there are some regulatory requirements that state insurance. Sometimes it's insurance or insurance-like products, or insurance and risk protection products. Where it specifically says insurance products, discretionary risk products would be excluded.
And do you know, and you might have to take this on notice, did any of those correlate to our high-risk sectors that we were talking about earlier, live music, etc.?
Anthony, are you, or is that something we'll take on notice?
I think we can come back with a more detailed response, but yes, there'd be sectors like building would have statutory requirements that probably restrict the products that you restricted to insurance, as an example.
Or maybe then if you could take on notice and let us know what industries, particularly in that high risk area, those high risk areas, where your products would be excluded.
Yes.
Or your arrangements, let's put it that way, your groups. Thank you, Chair.
You draw a clear distinction between mutual insurers, discretionary risk mutuals and cooperative group policies. How well do you think small businesses understand these differences when they're making decisions about risk protection?
I would say there's a low level of awareness of the nuances. Typically, though, with a discretionary risk mutual, the impetus for even the sort of seeking of a solution through that model has to emanate from the group in the first place. So I think business owners, community groups should seek the lowest cost insurance or risk protection, solution that's comprehensive, it meets their needs as possible from the market. So, whilst discretionary risk mutuals are another solution, they're not a panacea in all cases. But no, I would say that there's a growing awareness that there is this other type of potential solution, but it's still a low awareness.
So in this circumstance, necessity is the mother of adaptation rather than invention, and seeking a different kind of product.
Yes.
Are there circumstances where the lack of a guaranteed right to claim under a DRM could leave a small business worse off than under traditional insurance?
I can't give a specific example. Theoretically, in the case that a discretionary risk mutual was, if there was insurance available and it was going to be more responsive, it's economically rational for a member to leave that discretionary risk mutual and seek a better solution. So it should be, there's nothing compelling a member to stay a member. You're seeking the best solution. So the incentives and the purpose of the business should provide that solution is works in the interest of the member, or the member will take they'll vote with their wallet. So the overall sustainability of the organisation would be undermined.
It's on the competition in the marketplace provided by others. So
and we favour competition and diversity. So we're not here to say that everything should be discretionary.
Pure and perfect, no. So if the insurance market continues to soften overall, do you expect the case for new DRMs to weaken, or do you see them as a permanent alternative to the commercial market?
Anthony, do you have a response?
Sorry, I just missed that.
How about I put it on notice because we're running out of time. The last question I want to put on, and I think Ms Lawrence would like to ask a question as well. We are hearing assertions that state fees, levies, taxes are a very, very big problem. We're also hearing, without clear data, I think, at this point of time to get the proportionality of that, we also have many claims that the insurance costs and litigation impacts are driving price increases in the insurance sector. Do you have a view about either of those claims that are being put to the committee?
I think we'll take that on notice.
Okay. Ms Lawrence.
So can I just ask one? Do you need to...
Thank you.
Oh, hang on, you got Ms
Sorry, I
Lawrence.
just cut off somebody.
Come back to you.
I do
Mr.
want one
Sharma.
more thing before we finish.
Ms Lawrence, you have the call.
Sorry, Chair.
Lovely, thanks. I'm just interested as to whether you want to just speak at all to the prudential framework and what changes you would see necessary to sort of improve people's access to mutuals, whether it's easier capital rules or just ensuring that the prudential framework's not entrenching sort of the more traditional insurance market as opposed to mutuals?
Thank you for the question. Discretionary mutuals are regulated by ASIC. They're not prudentially regulated. There has been historically a barrier to entry for mutuals through lack of parity around access to capital. So I think some of the reforms since 2019 have really changed the environment, so it's more entrepreneurial. We do put a lot of focus on this need for the legacy asset protection, the uplift in the Corporations Act to bring it on par with other Westminster jurisdictions. So that is going to help solidify the business model. The greatest barrier to entry is really, again, this ecosystem of business development and education and awareness. The ability for either advisors to be able to knowledgeably advise people on the setting up of a business, to manage their risk, or for groups of businesses to come together. I do also note what the Madam Chair said about the difficulty of small businesses, for example, having the time, knowledge or resources to be able to set up a risk protection business. So the development of our industry body as a supportive mechanism to try and create some environment for templating, replication, knowledge sharing, and importantly, industry standards is absolutely critical.
Thanks.
Thank you.
Mr. Sharma, last one.
Just quickly, because on the tax issue which you raised, Chair, I think it's important to understand. My understanding, and I just want to have this confirmed, is that a contribution to a DMF does not attract stamp duty.
Anthony, are you able to answer
because
that?
Because it's not a premium.
Yes, I believe that's correct.
And you also don't pay, the DMF doesn't have to pay the emergency services levy either in New South Wales, as I understand it, because again, that's collected from insurance premiums. And this is you're making it.
I'll take that one on notice.
Okay. Yeah, if you could just take both of those on notice, because as I said, my understanding is a DMF, you don't exempt from stamp duty, you also don't pay the ESL, which means your policy, at least in New South Wales, the costs, you suddenly lost 25% of your cost base there. But if you could take that on notice and answer it, because that would obviously explain at least part of my first question, which is how you're able to offer cheaper products. Well, if you're paying 25% less tax, there's part of the answer. That was all, Chair. Thank you.
Great. Thanks very much. Thanks, Ms Morrison. The committee will now suspend for a break and return at, let's say, 11.
Coffee's Let's roll.
We will recommence with representatives from IAG. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names, the capacities in which you appear today?
Jared Hill, CEO for CGU and WFI.
And my name's Julie Batch. I'm the CEO of Retail Insurance in Australia for IAG.
Thank you very much. I now invite you to make a short opening statement. At the conclusion of any remarks, I'll invite members of the committee to ask questions. And just so you know, we have Miss Tanya Lawrence online. I don't believe we have Mr. Garth Hamilton anymore.
Donna Jarrett, Federal Member for Brisbane.
Dave Sharma, Senator for New South Wales.
Scotty Buchholz from Queensland.
And Senator Deborah O'Neill, Chair of the committee from the great state of New South Wales. Okay, over to you, Mr. Hill.
Good morning, Chair and committee members. May I begin by acknowledging the traditional owners of the lands we meet on today, the Gadigal people of the Eora Nation. We pay our respects to Aboriginal and Torres Strait Islanders culture and their elders, past and present. Thank you for the opportunity to appear today before the inquiry into small business insurance. My name is Jared Hill. I'm the CEO of CGU and WFI, the intermediated business of IAG. I'm here today with Julie Batch, who is CEO of NRMA Insurance and IAG's retail business. We appear on behalf of Insurance Australia Group, or IAG. We were pleased to make a submission to this inquiry, and we appreciate the committee's engagement and interest. Through its brands, IAG can trace its origins back more than 160 years in Australia. From now to then to now, IAG, including NRMA Insurance, CGU and WFI, has worked to support thousands of homegrown businesses of all shapes and sizes, industries to face the challenges unique to them. Today, we are proud to support around 400,000 small business customers across Australia. These businesses are supported through our retail and intermediated channels, so customers may choose to purchase our products directly through a website or a call centre, or via a broker or authorised representative. Insurance is critical in enabling business to operate with confidence. We see our role as an enabler, allowing small business to remain viable, protect livelihoods, meet regulatory requirements, and absorb shocks from severe weather and unexpected loss. IAG's purpose is, we make your world a safer place. When there is a severe weather event, we're on the front line as the first to arrive and the last to leave. Outside of times of crisis, we conduct research and help small business understand their exposure. As we set out in our submission, small businesses are facing changing threats. Natural disasters are occurring more frequently and with greater severity. Technology risks like cyber attacks are increasing. These pressures sit alongside broader economic headwinds. These include construction and supply chain challenges, persistent inflation, and increasing regulatory complexity. We recognise the challenges this creates in understanding risk and maintaining cover that meets contemporary needs. In our submission, we have set out 5 recommendations informed by research and insights that we believe will support stronger, more sustainable outcomes for small business. First, resilience. We are calling for continued investment in risk mitigation, particularly in areas of high risk of natural perils. Second, regulation. Simplifying regulatory obligations will reduce complexity and duplication, while maintaining strong consumer and small business protections. Thirdly, rates. Addressing taxes and charges that increase the cost of premiums will contribute directly to making insurance more affordable. Fourth, reform. Reviewing tort reform and civil liability settings is required, and this will have the most meaningful impact on small business affordability. And fifth, readiness. We need further measures to improve insurance awareness for small business. We welcome the committee's focus on the provision, regulation and pricing of modern insurance products, and we share the objective of ensuring small business can access cover that is fit for purpose and sustainable in this changing risk environment. Consistent with the committee's terms of reference, we are unable to discuss individual matters. However, the experience of small business owners are important to us. Ultimately, our aim is to help small business manage risk, recover faster when the unexpected happens, and continue to contribute to their communities and the economy. Thank you, and we welcome your questions.
Thank you very much. I might just kick off with a couple, and I'm sure that colleagues have questions. IAG points to taxes and levies as a factor in the price of insurance. However, does this account for the fact that there has been a rise in insurance premiums?
When we look at the taxes and levies component of the cost of insurance, they sit clearly on top of premium being charged. So we think about that in two very different stages. The cost of insurance, the increase in claims costs and the like, is represented in the premium, and then the charges, taxes and levies sit on top of that premium being charged.
And what's your estimate of how much of the cost of insurance you can sheet home to taxes, levies and charges?
That does vary by state, Chair. There's two states, New South Wales and Tasmania, that allocate a emergency services levy. That's roughly between 25 and 30%.
We know that the New South Wales situation is under review and it's been removed in other states. What's the situation in Tasmania?
Similar, the mid-20s emergency services levy charge sits on top of the premium.
And is there any proposal in Tasmania for its removal?
Not that I'm aware of.
Okay. And the quantum of that, you say, is
25 to 30% of the property component of the property premium. It doesn't apply to liability. There is a apportionment on motor, but it's a much lower level.
Okay.
I think there's an additional charge that comes through stamp duty that's a further 8 to 10%. So I think in total we'd be suggesting that around 30% of all premiums go to various governments in the form of taxes.
Yep.
I think, of course, we understand that those things need to be collected. I think there is an opportunity for us to consider whether there are other mechanisms to do that.
So what's the quantum of money that we're talking about here?
Across the entire industry?
Yep.
Insurance Council of Australia produced some estimates of around $5 billion, representing around 4 to 6% of all gross written premium collected across all insurance classes, not just small business.
Okay. And that money goes into the general revenue of all of the different states, and it's apportioned to a wide range of things that actually support the businesses that acquire insurance from you, including training, provision of education services, provision of road access, provision of policing, all of the sorts of things that are necessary for the proper functioning of a sophisticated economy like us. Where is the proposal for the replacement of these $5 billion?
So perhaps I might respond to that. Yeah. I think if we take a look at some of the other states' activities, particularly around the emergency services levy, which of course is a critical piece of revenue that needs to be collected for the reasons that you've stated. What we've observed, and again, these are some of the opportunities there, is that those costs have been attributed perhaps to rates for particular individual households and policyholders. It could be there is a mechanism that is similar in consideration of emergency services levy collection for small businesses, whether that is at the time of licensing those business or annual licence costs, things like that, or other ways of distributing that.
So the effectiveness of having the emergency services charge further distributed across the community to property owners is a concept I understand. How do all the businesses being charged licensing fees reduce the costs to those businesses? Because
I think there are a number of recommendations that we would put forward. So it could be around charging them to property owners. There could be a smaller contribution on licensing fees than necessarily levies charged on insurance. So I think when those
reduce the quantum from 5 to 4 or 3,
or just distributed differently. So obviously we'd be happy to explore that with you. I think our sort of
can you take that on notice?
Absolutely.
Because I don't want you to have to make up
on
the spot. But the reality is, it's one thing to recommend that those charges be reviewed. The community's expectations are that the provision of the services that they need for the effective functioning of their businesses and the community still has to be met.
Of course.
And met in a way that doesn't disproportionately, impact particular communities. And I know that there are communities where a rise in rates is absolutely not an option, right?
I think we understand that.
And it's different from region to region and from state to state. So
course.
if you could lend your policy thinking to that, that would be helpful.
Absolutely.
And also, could you indicate if the taxes and levies that you referred to have changed since 2020, and give me the sense of, state jurisdiction by jurisdiction, what you've observed there. One of the concerns I have is, despite the 10-year cycle of softening and hardening of markets, that it appears to me there's been a shrinking of providers. There's been a proliferation of market product, but a shrinking of providers. Is that a fair description of what's happened in the sector? And what has been the impact of that? And is there any hope for further competition?
I'll try and look at over the extended period and sort of frame that up. And what we're seeing most recently, there was quite a challenging period where there was a reduction in competition, and that was probably through when we refer to as the hard market, where capacity is getting shrunk, there's appetites reducing, and that then drives some price up in line with the response to what initiated that hard market. But what we've seen in the last 2 years is significant capacity come back into the market. So in the SME and the small business area, if I break it down into APRA-regulated insurers, there'd be 15 to 20 insurers you would say were highly active in the small business space with a real appetite that are participating in small business. Outside of that, and this is unique to commercial insurance, international capital can flow into and out of markets quite efficiently. So what we see at the moment is there's circa 300 underwriting agencies that operate in Australia. So that's a mechanism that people can, on their behalf, they'll support with capital. Those underwriting agencies will underwrite on behalf of an insurer. About 2/3 of those are supported by Lloyd's of London underwriting syndicates. So about 200 of those, and there's quite a lot of capacity that has come in via those vehicles, particularly, say, in professional indemnity. There was quite tight capacity, say 5 years ago. From an underwriting agency perspective, there's 60 plus underwriting agencies now that have the capacity and authority to quote professional indemnity business. So we do see quite a flex in capital and available markets to quote business in the commercial space.
One of the points that is being made with very little visibility to the facts of the situation is that the cost of litigation is impacting premiums. Professional indemnity is one of the areas where those sorts of claims are being advanced, but you've just indicated that there's been an increase in professional interest in providing insurance into the professional indemnity area. So how do we reconcile that, and on what evidence are you basing the assertion that there is an overly litigious element operating in Australia that's driving price increases for premiums?
I think there's two aspects on the tort reform recommendation that we put forward in our submission that are certainly worth considering. So if I could break it down, say if I look at our liability business, which is largely around bodily injury, a lot of those claims are settled over a large number of years. So we all settle claims could be 10 plus years from the injury. So we have reserves. Every year we set aside reserves to support our future liabilities to pay those claims. If I was to break down that cohort of reserves, about 60% is for the indemnity payment, so the payment that goes to the injured party to help to support them. The 40% is frictional costs. Our view is that 40%, that is too high a weighting of the reserves and then the overall claims costs. There's an opportunity to create a more efficient overall legal framework, and part of that would be tort reform. to create efficiency in broadly across liability insurance. And I think, Julie, you've seen examples where reform has driven to more efficient.
Just before you go to that, frictional costs at 40%, litigation and payouts in litigation would only be one part of that frictional cost. There would be other elements to that as well. So if you could take on notice what they are, and could I ask you on notice to respond to the submission from Conrad Liveris, in particular the recommendations that are made there, and provide evidence to back up counterclaims that you would make, as well as more broadly their submission around their part in what you've described as part of the frictional cost on notice, and then Ms Batch, and then I'm going to go to Mr Buchholz.
So I'll just respond briefly to Jared's points. I think there are two areas that we would recommend the committee takes a look at as part of your deliberations and considerations. The first one is really looking back to HIH. That was a very significant supplier of liability protection and so on. And what happened through that period of time was that there was increased legal costs come through, and there was a considerable amount of review subsequent to that and tort reform that made insurance, particularly for some of the areas that you've explored over the last couple of days, more affordable.
Yes.
The second piece then is there are a number of schemes that provide bodily injury and liability cover. For example, CTP in New South Wales. They have quite a lot of literature that articulates the 45 cents in every dollar was going to the injured party, and the rest was in areas like the frictional costs that Jared spoke to, legal costs, fraud, and so on. And there was a considerable amount of scheme reform brought through there that has brought down the cost of insurance for compulsory third-party bodily injury. Again, we can provide you with some additional information on that in response to those matters that you've asked us to take on notice.
Thank you. And you prompt me to ask another question with regard to data. Yesterday we found it quite difficult to actually get the details of data inside the sector. If there's time, I'd like to ask some questions about your profitability and how you manage risk across different areas, but we'll see how we go. There may be some questions I notice with regard to that from me. Over to you, Mr Buchholz.
Thanks, Chair. Thank you. And thank you for your opening comments. And I want to just tease out some of the 5 points that you highlighted in your opening comments. First, can I just make a general observation that the area of insurance that you work in, the closer I get to it, the more I understand how complex it is, and it's just not something that you can look at one-dimensionally. But some of my questions may be one-dimensional, so forgive me. But one of the things I am starting to understand with absolute clarity is that the industry has become exceptionally sophisticated in the way it values its own risk. And then because the greater risk profile you've got, from what I've seen, the more robust the conversation you're having with your underwriter or your reinsurer to get that part of your cost in business down. Yesterday, so that's a compliment to the industry as a whole. Yesterday we heard from another provider where they said in the business sector their profitability was in that 1 or 2% range in around business insurance. Not that I'm looking for a deep dive into your business personally, but across the industry, are there other areas of the business that have a higher margin of return?
What we do see, if I was to sort of give a broad view, within the small business space, there's more consistency of performance, maybe at a lower profit margin consistently than sort of the larger multinational end. We see a lot more volatility in performance at the larger account space. So in a hard market, there'll be considerable profitability there. It has more volatility in price and the like. But we see a more consistent in performance, but in a tighter range of profit in small business. It tends to be the characteristic we see demonstrated. Less volatility in pricing in small business. I know you've heard different from particular small businesses that are finding it really difficult. But from across the board, if I look at the entire portfolio performance, That tends to be what we see. Level of consistency there, and the mid-market, when I talked about it's more 50 to 250 million in asset. Above that, in the major and corporate and global space, quite a bit of volatility in performance.
Are there areas below that in the red where you take hits that you try to price yourself out of the markets?
I wouldn't say it's not about pricing ourselves out of the markets. We're really conscious. I talked our liability position. We've got to be here in a decade. We're paying claims 2 decades. So, we've got to be sustainable. We've got to be disciplined around having the right capital to support our business and getting a return to keep that capital there. So it's not necessarily pricing ourselves, purposefully pricing out of the business, but charging what we think is to deliver a reasonable return against that capital to ensure that we're sustainable to support all the businesses we're looking to support.
Thank you. Your 5 dot points, your first one was resilience, and you spoke about high risk. Can you just tease that out about the resilience of the industry?
Yeah, I think I'll pass to Julie and she can update.
And I think when we look at small businesses, the ones that we're sort of here to talk about today, still a very large part of the cost of insurance goes to the cost of insuring the property risk and its exposure to natural perils in particular. Very large components of the premium. Of course, we have the liability conversation, but large components of the premium really relate to natural perils exposure. And so when we are pricing, and insurance is not a primary product, it is a product that builds its price from input costs of other, materials, location, legal costs and so on. One of the areas that we're very focused on, and we have been working closely with the Insurance Council of Australia, other insurers and across government, is really looking at how we might embed more resilience into the natural perils risk across the country to kind of try to bring those costs down. That's a few things. It's making small businesses more aware of the risks to which they're exposed. It's helping them understand what steps they can take to build resilience into their businesses from natural perils, and it's also working closely across all sectors to agree where investments might be made that build better protection to remove some of that natural perils exposure from communities.
Can I offer an example I gave yesterday to some people, communities in regional Australia that had been inundated with flooding, peril, who took the advice of the insurance bodies, build your levies around the town, safeguard yourself. They've done that. Since 2010, no house has been inundated as a result of the mitigation that the council asked for. One of the mayors sent me a text last night of one of the locals' reinsurance policy for a standard house in the community, and it was $35,000, north of $35,000 for a yearly premium. And I went back to him and said, mate, did the house get wet? Is it in a flood area? He said, no house has got wet since 2010. So how do you, and that's not a client of yours for sure, but how does the industry say, go and mitigate, make the investment, partner with government, do it under the proviso that we're going to reevaluate risk, but the reevaluation never comes. In fact, it continues to traject north.
Yeah, and so I thank you for that example, and maybe we take on, I think that we listened obviously yesterday, so we understand the community you're talking about. I think that we need to continue to work together in a multi-sector way.
I'm not trying to single out any insurance company.
No, I understand. Of course, understand. That particular region, there was no coverage available, and I think those defences that were built around that location brought insurance back to the market. There's a lot happened in the last few years that have driven the cost of insurance around those frequency of floods, so I accept that that's a challenging situation. I don't think we should take a step back, though, from trying to solve those really difficult problems. Again, we're working closely with the Insurance Council of Australia, the Hazards Insurance Partnership, which is a federal government initiative, around trying to make sure that we work together to make sure that some of those defences are put in the right place in the right way that brings that sort of sustained insurance price advantage.
The only thing I would suggest or add to that is that if the insurance response doesn't move in line with the mitigation work, what does that signal to other communities that are being encouraged to mitigate when there's cases? It's not worth it. It's just not worth it. These guys are not.
Add to that, and you can respond to them both together. We hear that insurance risk is determined on the individual case, right? And in the case that Mr. Buchholz has just put, where this property has had no flooding events since 2012, the only reason I can explain why it's as high as it is that there's a general risk spread across the pool,
Postcode or
right?
something.
Or the country. And at this point of time, I have no idea, whereas public policy makers, we go to see the information about what the practice really is.
And again, it's difficult to comment on that individual example, but we accept that there are
I'm not
those
looking to go down the rabbit hole other than-
circumstances. We really just encourage that the work we're doing together with government, so the Hazards Insurance Partnership, which postdates those mitigation investments in that particular location that you're referring to, is done in a really informed way, working together with business and insurers, using combined information that we're now sharing in a way that makes sure that those investments do provide that sustained advantage. And we should be challenged on that as well, making sure that we can continue to do that when the right investments in mitigation are made.
So do you price on individuals, an assessment on individual properties, or do you price generally, or is it some mysterious combination of both?
Well, it is a combination of both, and that is important. So we have a view of the individual risk of every property, but we also make sure that, we are able to provide, and our organisation will provide insurance broadly across the country. And so therefore it is at times important that we're able to balance those risks so that, examples like that 30,000 example, we're able to balance that across the country. So it is a combination of both.
It doesn't buy that insurance.
That's right.
So it's not coming in either by individual mitigation risk assessment or by collective risk assessment. They're just going, I'm out.
And that's why these mechanisms, the Hazards Insurance Partnership and other collaborative work that we are doing are so important, because insurance availability reflects the risk exposure of those properties. There are life safety risks for those customers as well, and it's really important that we keep working together to solve those multi-decadal, really wicked problems so that we can keep Australians safe.
Back to you, Mr. Buchholz.
Thanks for showing that. Thank you. 2, duplicated red tape. Where do you see the great advances forward with a reduction in red tape?
So we would observe, and we've called a little bit of it out. So we would observe that there are overlapping requests for data that are significant and material, and we've called those out in our submission that add frictional cost to our policy. We see other examples across our business where we will look at legislation that is there for good reason. For example, we call out anti-hawking legislation. That also has the effect of limiting our ability to provide advice around the types of covers that small businesses and, in fact, homeowners and so on should be purchasing, on the view that we may be premium forcing. And I think that's really important to make sure that we retain the intent of those, which we're not trying to cross-sell product to customers, but we can provide them with the right advice around the types of insurances they should buy and better inform them about their risks.
I think another good example we've got that's very practical, there were certain rules and regulation brought in around cash settlements on claims. And that can make sense, particularly when there's a large cash settlement. But, they're actually they're put aside when we have a major event to ensure we can get cash moving quickly through the community. And it's really clear our NPS goes up. Our Net Promoter Score, like the service we have is far more efficient in those times. So
is that like when there's a flooding event and you just say, I'll give everyone $500 or something for their freezer that went down? Or...
No, because the way it works is, so someone, let's say a storekeeper has a broken window.
Yep.
They get someone out to fix it. The sign writer's done. They'll send us in the invoice, the description, the 2 invoices For us to pay a cash settlement of that, though, we have to ring up, confirm the offer, come back, send out an offer in writing, receive that back in writing, and then forward a cheque. Now, the intention of that was good. If you're paying out $500,000 for...
Is that a government regulatory condition?
Yes, yeah. And the intention was right, but how do we frame that where we say claims under X, we don't need that for a cash settlement, so we can speed up that, get that back, that business owner's back, doing what they need to do, and their claim settle. So just a couple of things like that with good intention, but how do we make sure they're efficient?
That was a fraud prevention attempt, because one of the costs to insurance is fraud. So was that the reason that regulation was established? No. What was it for?
It was more so to ensure that if it was to reinstate and it was more personal lines. So if there was a large significant loss, a cash settlement was made, that person ensured that they were clear about reinstating the property. They had a place to live, and the cash wasn't spent elsewhere. Is to ensure that they were clear about the costs associated with that. The response. So
backwards and forwards, this money is for you to rebuild your house. Let's be clear about what it has to do.
Yeah.
Right. Which is sensible,
it
but
is.
Not if it's a window.
Correct. And that's
right,
what.
Okay.
So good intention. Let's opportunity to refine it, make it
There's
efficient.
a scale difference there. Yep. Okay. Thank you.
I know you touched on tax, and the chair, in her opening question, touched on tax. So I think I'll just leave that to tease out with the Insurance Council when they come here, and if no doubt they'll get a similar line of questioning around the example I've raised to you, because, like I said, my intent was not to single out anyone other than to get an understanding of the macro settings of how this profitability sets. But your number 4 does tie into your duplicated red tapes about reform. Now, in reform, we've heard from a number of people giving evidence around the growing, commonality of litigation, cyber, personal hardship. Are there any other jurisdictions around the world that have a capped amount that you can make a claim on? Would that mitigate?
I don't necessarily think that was where we were coming from.
Okay.
Caps. I think, the focus was the piece I meant. How do we take that frictional cost out? Because I think that's a direct. But also, I think in some of the examples where people are really finding it challenging, small business finding it challenging to obtain the liability insurance, where they're higher risk activities, outdoor activities and the like, where people are going into an activity knowing there's a risk associated, and then there's an injury and the provider is held liable. Are the settings right there? Because that's making it really difficult for those because of the cost and the uncertainty. Therefore, that puts an uncertainty when underwriters are assessing risk. How much should I be charging for a potential large loss? What is the frequency of claims coming through? That's what then makes some of those sectors challenging. So, what is the right setting? Has it gone over the 25 years? Has it expanded too far? So now we're getting to a point where small businesses finding it difficult to operate some of those and offer some of those activities.
I agree. The risk associated with a high ropes, outdoor activity, the risk associated with outdoor events was highlighted by some other witnesses. Alcohol's involved. Night events, security having to be available. How sophisticated is the industry? Because we also heard from some of the Artists Association who sit in a room and behind laptops, design music and write songs. Their risk profile is paper cut on a bad day, but they're bundled in because of the nature of their industry with the high risk alcohol consuming. They were asking to be treated in a different category. What flexibility does the industry have to decide for whether or not, and the tattoo guys, the same. They were making the point that their risk, was accurate 10 years ago, over a decade ago, but through regulatory reform, barriers to entry, tidying up of the industry, much less profitability, it's no longer attractive to organised crime, and we've seen a massive decrease in risk The only thing we haven't seen is the insurance industry, time and time again on different examples, not shift their risk weighting. And my opening comments was I was complimentary to the industry. You do understand how to value risk.
Can I just, in regard, like the tattooist one is actually a reasonable example.
I only heard about that yesterday.
No, we actually had an involvement, and I think there was the broker scheme that was named. We actually were the underwriter for that scheme for a few years back. But we'd made that assessment. The industry had changed. We supported the facility that was put in place. But over the years, more competition came in, maybe saw that we were underwriting, had a belief that, yes, this risk has changed, and our pricing, where we set our pricing assumption, the market had moved and was actually cheaper than that. Now, we haven't had an involvement for a few years, so I can't comment exactly, but I think that's an example. It's around data, though, and how can we evidence the data? And we do get small cohorts of the example, maybe the musicians that do get dragged into a bigger risk profile. So that can happen.
Do you have flexibility to do a reassessment of that cohort?
We're always reassessing it. Like every 6 months on our commercial, we do a deep dive into our portfolio, track how everything's performing, and then adjust our settings to fit our risk profile across our broad portfolio. That's a core discipline of what a good underwriting firm should do. So yes, we are constantly monitoring that. We may not have the data on some of the areas though to do that. That's where we can have a challenge where the data's not available. We can't find the data to evidence that.
I think in that example, he was complimentary of a broker that had found a pathway for him. I think where he was making the point that being a tenant in a strata titled complex, the insurance that the landlord was taking was exponentially spiked as a result of his tenancy, and so he was attributing that part of the percentage increase to him. So it was something that he couldn't negotiate. It was just something that was handed to him. I think there's room for us, and I might tease that out with the Insurance Council when they arrive. And the last point you made was a sense of readiness, and for the benefit of the other committee members, I'll make this my last question. Readiness. Tease out what the industry would like to see, a state of readiness.
I think, Julie, I may pass to you. You do so much work in that readiness space with communities.
And so a lot of the work that we're doing from a sort of readiness perspective is really around focusing insurance on giving better understanding of the types of coverage that are available, activities in community that help small businesses and householders better understand their risk. And we think those things, again, when we look back at things like anti-hawking legislation, we would generally encourage much more of that, being able to build awareness and readiness for small businesses so that we can be better informed about that data and information and make better risk decisions.
I think in the commercial space, particularly through the CGU business, we deal through insurance brokers. So we're constantly working with those brokers, taking feedback from them around what customers are saying, pushing out information that we have so they can better inform the customer around risk. We've just released a new cyber product that's really targeted at SMEs, and one of the biggest risks we see with SMEs in the cyber space is awareness of the risk and what is their cyber stance, where are their exposures. So a big piece of that product is actually we do a review of their cyber stance and their vulnerabilities and provide that to them and give them example of how they can mitigate those risks. We've been disappointed in the take-up of that product. We see it's a highly, and we raise that within our submission. We see cyber as an emerging risk for SMEs, and we need to accelerate the take-up there. And that's an education piece. How do we broadly educate SMEs? Because it's often, if it hasn't happened to me, I don't have that risk. So how do we get that education up? I think is really important.
I suppose it's coming from a business background, it's a commercial decision. Do I give my the couple of bucks that I've got left at the end of the week to an insurance company, or do I give it to a security expert to come in and upgrade my system. Yeah, which it's chicken or the egg. Thanks, Chair.
Thank you. Ms Lawrence is online and has a question from Western Australia, so I'll go to you, Ms Lawrence.
Thanks very much. I'm just interested in just two fronts. One around underwriting diversity. So I appreciate you've got a number of different brands, and I think within Australia there is a lot of brand competition, but not, to my understanding, much underwriting competition and even less reinsurance. Just whether you have any remarks on the extent to which a lack of underwriting competition in Australia relative to UK or European markets affects pricing on premiums.
Thank you for the question. I think I'd like to frame that when I mentioned there's 15 to 20 APRA regulated insurers, that's at the APRA regulation level. That's not brands within holding companies. So, there's in my mind there's a considerable amount of capacity available and competition available, and various underwriters that have a different view of risk available for small business. And then with commercial as well, commercial insurance being small business, we see those inflows of global capacity that are able to come in and support small business. In regards to reinsurance, it doesn't have a significant impact on small business pricing, except for the overall price of perils insurance, where that reinsurance. So I don't necessarily think the reinsurance sector has a significant impact on pricing for small businesses. I do see it's more as like the risk profile, the claims experience, the inflation we hit, the challenges that we're seeing there, the increasing number of weather events and the severity of those events. They're the things that are really driving the pricing for SME and small business.
Thank you. And just on another line of questioning around brokering, what percentage of your brands businesses would do their the writing of policies through brokers?
So we underwrite. We've got about 400,000 small business customers, and it's not 100% accurate because there's different definitions of small business, but small business. So in Julie's space, retail. So that's a direct to consumer largely under the NRMA brand. There's about 185,000. We have a WFI business, which is almost an agent authorised rep business that it's a non-advice model. There's probably circa around 30,000, 40,000 there, which is mainly through rural Australia. And so about half, so just under 200,000 of ours, so about half goes via our broker business, which is all via our CGU brand.
And so do you follow a similar model to what we heard earlier this morning, where they get a one-off fee for signing on a new client and then a trailing commission?
We have a different view of. Our practice is different. So brokers are independent; they're acting on behalf of the insured. So they don't work for us. They provide advice, and they're responsible for getting the best insurance and meeting the insurance requirements, risk requirements of the insured. We pay a commission that's more based by product, and that's consistent. We see that's generally a practice across the industry, and that's consistent at new business and renewal. It's probably just worth, and maybe you can delve into this with.
Could I just ask you for the cost then? The pay per product. What's the amount that you allocate?
So if we look at the most common small business product would be a business package product.
Which includes what?
Which includes primarily it's property and liability. So they're the two products that make that up. That ranges between 15 and 25%, depending on the model, what's done and the like. So that's the range. You know, then transparency is the important thing there. The client has to know what they're paying for, what's component is premium charges, and what they are paying their broker for the service that they are providing.
And have you got data on the extent to which the business price walks? So to what extent do you find customers sort of stay with either the broker and then by extension yourselves, or whether they are flipping insurance insurance companies each year when it comes time for renewal? Like, do you have a sense of what level of stability there is with your customers, or are they actively seeking out competitive alternative pricing and shifting their product?
In the broker space, it is quite an active remarketing of insurance services. Now, I don't have the exact percentage of the customer that goes out every year, but some brokers will test the market every year. And in small business, there's the two major brokers in that space are the Australian listed companies, Steadfast and AUB Group, or Austbrokers are the broking arm there. And they have a large share of the small business market. So they do consolidate a lot of data. They provide that to each of their individual broker companies or members. So brokers are fully informed. They've also provided highly efficient quote capabilities for them. So brokers can access a number of insurers with a single quote request. So it makes it highly efficient to get multiple options. So from that perspective, you are as an underwriter, as the holding underwriter who has the insured, you are tested by your broker on a regular basis.
And Ms. Lawrence, I might build on that from a direct insurance perspective. So the NRMA business, as Jared said, underwrites more than 100,000, between 100 and 200,000 individual small businesses. They generally do that directly. They generally do that online and digitally, and they do it for convenience. We have a much smaller risk appetite than Mr. Hill's business does. We only insure micro small businesses. They don't have any broker cost associated, and we insure specific occupations like tradespeople, so very specific, that are looking for convenient purchasing. We would observe.
Thank you. Yeah, I'm just trying to get a sense of how it compares with, say, people taking out mortgages where they end up paying a loyalty interest rates, where they're just not shifting their mortgages around because it's difficult, it's a lot of time and effort. I'm just trying to get a sense of how much flexibility there is for business to shift around to try to make sure they're getting the most competitive premium relative to the risk of their business. But it doesn't seem like we've got any sort of real data that looks at the loyalty of a customer.
I think we can provide you with some of that insight from the direct business. So perhaps we take that on notice and we come back to you.
Okay.
Because that is less.
If it's possible, that'd be interesting.
Sure.
Thank you.
Wonderful.
Thanks, Chair.
Thank you. I'm going to go to Ms. Jarrett for some questions, and I've got one at the end. Thanks.
Thank you. I just wanted to touch on the reinsurance market. We haven't actually spoken much about that, but you do raise it in your submission. And you said that sometimes the cost of reinsurance can be prohibitive. So help us understand, what is the nature of the reinsurance market? Like, who are our big reinsurers? I'm assuming, we've got Lloyd's, but there's a number of other global players in Australia. What's your sense of that market to start off with? Help us understand, and then I've got some follow-ups.
So we have, like all insurers in Australia, we access the global reinsurance market. That includes global, all reinsurers are global, but it includes global reinsurers that are domiciled here as well. So that might be Munich Re, Swiss Re, and so on.
Yep.
And we access international capacity from all around the world. When the cost of reinsurance is an input cost to the way that we design the premium for all of our insurances, including small business, that reinsurance cost will move based on two things. The first one is the claims that it is observing for the risks that it's protecting.
In Australia or globally?
Firstly in Australia.
Okay.
So that is a key driver. So if there are considerable amounts of natural perils, and it's largely natural perils related, or significant liability claims, but largely natural perils, then the reinsurance costs will move. They generally move consistently, and they generally move across all insurers. So when you have a period of natural perils that cause considerable losses, you will see fairly soon after that, the following year, reinsurance costs rise. And that, again, pushes up the price of the original insurance. It's an input cost that we pass on. From time to time, there will also be a second driver, which are global events. So because reinsurance is a global product, you will find sometimes, and it's occasional, it's not all the time, most of the time it's calibrated to the country, but sometimes you'll find a very significant event globally that causes a repricing of the whole of the reinsurance industry globally.
What sort of event would that be?
An example might be a series of significant earthquakes occurring around the world that costs reinsurance a lot of capital, or it might be a very material US-based event like the World Trade Center or Hurricane Katrina, Rita Wilma occurring simultaneously that really changes the cost of global capital. That is rarer, but it's not inconceivable that those costs are also passed on.
And what percentage of the insurance costs to the consumer would be reinsurance?
It's difficult to respond to that question, and we can take it on notice. I think across the industry, it's probably a good question for the ICA. I think that is something that depends on the insurance company. But if you look at the property costs of a policy, which include the cost to pay the claims and the cost of the reinsurance, they would be, 50, 60% sometimes in high-risk areas of the total premium.
The reinsurance would be 50%.
A combination of the costs of claims that we keep and the costs that we would pass to reinsurers in the form of a reinsurance premium might be 50 to 60% of the premium.
Can you separate them out?
We can take that question on notice and provide that with confidentiality back to the committee.
Thank you. And
last one.
Yeah. So, if are there areas where you've seen reinsurance pull out and not being available because if it becomes prohibitive, I'm assuming therefore the insurance isn't offered to the consumer. And if so, is that coming from like a small cohort of reinsurers, or are you seeing that across the board? You might have to be on notice.
I think we'll take that on notice. I understand the question, and we'll respond to you.
Thank you
very much. Mr. Wilcox has got a question?
Just one last one. I've just did a quick Google search and Insurance Australia Group's past earnings performance. Insurance Australia, and this is from Wall Street, Simply Wall Street, and I just want to check it with you guys. Insurance Australia Group has been growing earnings at an average annual rate of 46.9%, while the insurance industry saw earnings growth at around 12.4% annually. So you're at 46, the industry's at 12.4. Revenues have been growing at an average rate of 20.6% per year. Insurance Australia Group's return on equity is 15.4%. And then it speaks about earnings growth rate at 46.87%. What is earnings growth rate?
I understand. I believe the way they're referring to there is that the profit or the profit after tax would be the earnings growth rate. I believe.
Okay.
That would be referring to there. That terminology.
What number?
Earnings growth rate 46.87%, and the earnings growth for the industry was 12.4. So, Insurance Australia Group, and there's nothing wrong with making a profit, is nearly 4 times stronger than the industry average. What are you guys doing differently?
I think we could. I mean, that depends the base that it's coming from. We had
Sure, and I'll put
like,
this.
poor earnings years that were very problematic for us. There's some other anomalies that go into that number as well that may not reflect.
Is it all right if I flick this to you and I just give you? It wasn't an ambush, just to flick it to you.
We could take it on notice.
Yep, that'd be wonderful.
Baseline that so you've got a clearer picture over a period.
Yep.
Because if I look at the business that serves the majority of small business here, the business I'm responsible for, over the past 5 years, our earnings range has been between 3.7. Sorry, from a insurance to about 11.7. So it has a different profile to that. There has been
Your net margin's 5.9%.
on the IIA business.
Yeah. Well, this is referring to this document and has a net margin of 5.9.
Yep.
I'll forward you this. Thank you. It wasn't a gotcha moment or anything. I just wanted to understand when I hear evidence coming at 1 or 2% profitability and I'm seeing these earnings growth, it's quite a contrast when we're trying to control or do a deep dive into why insurance costs are now sneaking into 1, 2, 3, 4 of small businesses' large costs. I also had a quick look at some of the underwriting profits, and none of them seem to be going backwards. But that's not a question for you. I'll ask the council of that. When I had a quick look at the global underwriters, they're doing quite well, Chair.
Well, we want them to be sustainable, but we don't want small businesses to be going out the door backwards because of super profits. So can I just ask, are there insurance classes that deliver super profits?
In the small business space? Not that we see across our portfolio.
Okay. And what about broader than the small business? Like, because you've got multiple businesses there.
What are we defining as a super profit here, Chair?
Well, I don't
It's
know.
like above, I mean...
Let's say above 10%.
Okay.
Because,
No, I just want to make sure we're talking about the same thing.
yeah, above 10%. Most small businesses are just, that I know, and particularly micro businesses, which you know particularly well, Miss Batch, they're often working on like a 1.52%, 3% margin and working for big employers, big contractors who are pushing the prices down all of the time. 10% is something I would dream about doing, right? Obviously, you're a critical part of the sustainability of the whole market, so, you know, and you've got APRA regulations, understand all of that, but are there super profit products in the mix?
I don't see that there's super profit products. We have variability. So where we have, if there's significant perils risk, for instance, and there's no perils, 1 year that can be profitable, but we play that back. Because remember, we're sort of amortising events
over time.
maybe over 10, 15, 20 years.
Yep.
So we can have that volatility in price. It's not the way we price our business. We price our business to provide a sustainable return on the capital that we need to service. We have a very robust capital model that the Prudential Regulator requires here, which is good for the strength of insurers to ensure that we're around to pay the claims. And we, you know, in the prior 12 months, we paid over $10 billion in claims. It's imperative that we have the financial wherewithal to be here to pay those claims and support Australians.
So if you can give a sense of, you know, areas of business that have traditionally been important for the sustainability of the business and what the profit margin might be on those. I know that might be confidential, but you know, we deal with confidential documents all of the time, kind of trying to get the sense of that.
I'm aware also, Chair, that profit doesn't equal profit. If we have profit going to a broker who incurred a far greater workload than profit coming from a different source, the higher profit on one is to offset some cost.
And I think this starts to bring us to the whole question that I want to ask about data. So one of the regulatory burdens that you talked about is data provision, multiple sites of data provision. And we've heard in other circumstances, report once, use often. Perhaps there's a room for some sort of good assessment of how much reporting is going on. But can I say, from our point of view, there's a data poverty problem. We, like in the public place, to make public policy, we couldn't get data from APRA yesterday that I think is pretty critical for us to actually be able to make an informed decision. We're relying on testimony from yourselves and then from other entities to blindly accept without data assumptions and assertions, and that can't possibly lead to good policy making. So, could I ask you to think about what data would better inform public policy making? And given the reform to AI that's happening and machine learning that's going on, there's an opportunity for a massive productivity lift and an improvement and an assessment in a way that we haven't been able to do until now, that could be led by the sector for moral good, for the community as a social good. So I invite you to think about that, because there is data poverty from a public policy point of view, no doubt. The other thing is, yesterday we did receive evidence from the Tattoo Guild. Could I ask you to review that submission and the evidence that was given? And there was an assertion that there's some concern about kickbacks to real estate agents and strata management, right? Most businesses are running not out of their own property, they're renting. And we're getting reports of extraordinary increases in rental. So if you can have a look at that. The tattooists are a particular problem, but I sense that this is a problem with strata insurance provision, which has been prosecuted in other jurisdictions. I think Queensland in particular have been looking at that recently. The other thing is I'd like to refer you to the, what was this? It wasn't called Flequity. What was it called yesterday? Finity. Finity, talk about market hotspots. Could you give us a sense of when you shifted out of those items, so worker to worker, US exposures, PFAS, music venues, parks and active recreation, religious and educational, agricultural, chemicals, scaffolding and trade contracting. If you're in those markets at any point of time and you've withdrawn from them because of, the hit in terms of profit or other risks, could you give us a sense of what happened, why you withdrew, and what might need to happen to make available once again to those sectors product necessary for their protection and the protection of the market and the services and goods that those particular entities provide?
Happy to do
We can do that.
Great, thank you. It's too hard to write that question, so thank you for listening. All right, thank you very much.
Appreciate it.
I thank you for being with us today, for the evidence you've given, for your submission, and can I ask you to provide the committee with responses to questions on notice and further information by Friday the 29th of May, if possible. I now welcome representatives from the Outdoor Council of Australia, Outdoors New South Wales and ACT Limited and Scouts Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacities in which you appear today? We start with Ms. Wilkinson.
Leg Wilkinson. Joanne Leg Wilkinson, Scouts Australia, ACT Branch Executive Officer.
Thank you.
And good morning. My name is Neville Tompkins. I'm the chair of the Internal Governance Subcommittee for Scouts Australia.
Thank you.
And Laurie Mode, CEO of Outdoors New South Wales ACT and also Chair of Outdoor Council of Australia.
Wonderful. Thank you for being with us today. I'm going to invite you to make a brief opening statement, after which the committee will follow with questions. perhaps we might start with you, Ms Mode.
Yes, thank you so much, Madam Chair. Good morning, and thank you for the opportunity to appear today. My name is Laurie Mode. I'm the Chair of Outdoor Council and the CEO of Outdoors New South Wales ACT, which is a member of the Outdoor Council of Australia. We represent national interests in the outdoor industry, about $11 billion worth annually to the Australian economy. It includes outdoor recreation, outdoor education, adventure tourism and nature therapy. A majority of our businesses in our sector are small and micro enterprises, many based in regional and remote Australia. These businesses don't just deliver experiences, they contribute to tourism, education, health outcomes and community wellbeing. Public liability insurance is not optional for our industry. It's a prerequisite for operating on public land, working with schools, securing licences to operate and maintaining community trust. Without it, we simply can't operate. And yet we're seeing it not as a functioning marketplace. Since 2020, operators across the country have experienced insurers withdrawing from the sector, inconsistent underwriting decisions and rapidly escalating premiums, often without change in their claims history or even safety performance. This is not a result of an unsafe industry. It is a result of markets that don't adequately understand or how to recognise the risk that's being managed in our sector. I want to be very clear about something, that the outdoor industry has not stood still and asked for help. We've actually taken responsibility because we want a safe industry first and foremost, which has then enabled better insurance outcomes for our industry. None of our members have not been able to get public liability cover since 2023.
Sorry, could you just state that because you've got two negatives in there? Can you
Yes,
be clear?
so
Thanks.
all of our members, I should say, have got public liability insurance without a problem since 2023.
All of them have?
All of them have.
Okay. Yep.
And this is because we've invested in national safety frameworks like the Australian Adventure Activity Standard and the Good Practice Guides that were released in 2019 and continually used more and more so in our industry. We've also supported national incident data collection in our industry through a system. We've built education programs, we've improved governance, and we've worked directly with specialist brokers. I'll say that again, we've worked direct with specialist brokers to better articulate and manage risk. In short, we have done what you would have expected an industry to do. We have owned the risk. But there are structural issues that no individual business and no industry can solve alone. The first is the normalisation of the 20 million public liability requirement. This figure is not evidence-based. It's not driven by risk, it is driven by risk aversion and contracting practices. It's significantly higher than international norms. For small outdoor operators, this creates a disproportionate cost burden that has very little to do with their actual level of risk. The second issue is legal uncertainty. Even without our strong safety systems and our low incident rates, insurers are priced for the worst case legal exposure and not operational reality. This drives conservative underwriting, ultimately affordability challenges for small business, and this is where tort law reform needs to be looked at. There is also another dimension into this conversation with increasingly impacting our members, and that's property insurance, which no doubt you've heard a lot about and just recently. While public liability is often the immediate need to operate, property insurance is becoming more the growing pressure on business sustainability. Premium increases in this space are not being driven by poor business practice, they're being driven by broader systemic factors. We're seeing the impacts of planning decisions that have allowed assets to be located in high-risk environments, whether that be flood-prone or bushfire-prone. We are seeing the effects of supply chain disruptions, increasing construction costs, and the rising price of materials and specialised repairs. We're also seeing insurers responding to these communicable pressures by increasing premiums across the board. For small outdoor businesses, many of whom operate in regional and nature-based settings, these are compounding. So while today's discussions are framed around liability, the reality for our sector is it's the total cost of insurance is being driven by multiple systemic factors which sit beyond their control. This is why collaboration is important. These challenges do not sit with one part of the system, they sit across planning, regulation, insurance and industry. What we're seeing is not one broken lever, it's multiple parts of the system. The opportunity here is not to shift responsibility, but to better align those parts of the system that outcomes are fair, sustainable and grounded in evidence. So what we're asking for is not a bailout, not deregulation, what we're asking for is alignment. alignment between actual risk and how that risk is priced, alignment between industry capability and how it's recognised. The alignment between government settings and the outcomes are unintentionally driving. These are practical steps that the Commonwealth can take. Number one, reviewing liability settings with the procure frameworks reducing the $20 million requirement. Two, supporting recognition of industry-led standards like our own venture activity standard and helping industry to create measure compliance. Encouraging or making a requirement for insurers that engage with sectors that can demonstrate risk maturity and utilise standards like these. And number four, improving transparency of national claims data. The outdoor industry demonstrates that businesses take ownership of risk, better outcomes are possible. But we cannot resolve structural market distortions on our own. This is an opportunity to move beyond crisis language and towards a more mature, evidence-based insurance environment, one that supports small business, community and public safety. Thank you.
Thank you very much. That's a great opening statement. Mr Tompkins or Ms Legg-Wilson, you have the call.
Thank you, Madam Chair, and good morning. And on behalf of Scouts Australia, can Joe and I thank you, firstly, for the opportunity to present a submission, and secondly, the occasion this morning where we can talk through these issues. Across Australia, organisations like Scouts are increasingly being forced to limit what they can do, not because of a lack of need or willingness, but because insurance is becoming harder to obtain and more difficult to afford. Insurance products are also less fit for purpose for Scouting. When that happens, opportunities for young people from all parts of our local communities don't just reduce, they disappear. That is why this inquiry matters so much to organisations like ours. Across Australia, Scout branches are facing severe increases in insurance premiums, with annual average increases of 25 to 35% in the 4 years from 2020 to 2024. One of our largest branches had its total premium increase 2.4 times, that is, more than doubled over the period 2020 to 2024. And one of our smaller branches, and you can hear more about this today, in 2023-24 experienced a 168% increase in its public liability insurance premiums. For us, as a youth development organisation, we see a clear market failure. There are structural issues. These increases are having a direct impact on our ability to run essential youth programs as part of the world-renowned Scout program. These programs are not just activities. They are vital for building resilience, for teamwork, for self-confidence and leadership skills amongst our young people from age 5 through to 25. And, of course, from all sections of our local communities. Programs like these provide the foundation for young Australians to grow into well-rounded, capable and confident individuals. The benefits of outdoor recreation and youth development programs are clearly demonstrated in the 2025 survey with Resilient Youth Australia. Committee members, that is the publication, and we hope that you've been provided with a copy of it. This independent survey clearly demonstrated that Scouting and members of Scouting are firstly 11% more likely to get along with different kinds of people, 10% more likely to feel good about themselves, right through to 36% more likely to read for fun. Compared with their peers, Scouts are also 20% more likely to deal positively with problems and 23% more likely to talk with others when they have issues. That is the results of that independent survey. Committee members, these are not small outcomes. They are measurable social and emotional benefits that strengthen the well-being of both young people and the broader community. This aligns well with the stated aim. This aligns well with the stated aim of the government's social media strategy for young people, being, and I quote, "give young people more time to build emotional, social and digital skills before creating social media accounts." Further, the government's objectives set out in its volunteering management strategy aim to break down barriers to volunteering for identified priority groups. These priority groups include people with disability, First Nations people, newly arrived migrants, vulnerable women, young people aged 12 to 18, and people who are unemployed. As a minimum, Scouting directly impacts at least 4 of the government's 6 identified priority groups and the remaining 2 indirectly. By removing access to the programs offered by Scouts because of a lack of affordable, accessible and fit-for-purpose insurance products, we are denying young people the opportunity to develop life skills that are crucial to their future, and we're also denying adult volunteers the opportunity to make a positive contribution within their local communities. Committee members, rapidly increasing...
We might just get you to draw it to a close because we've got questions.
Thank you. Rapidly increasing insurance premiums are impacting directly on our ability to deliver the Scout program. And the fewer insurers that we have, we are finding that we are limited in the products that we can purchase from the market. I'll finish on this point, Madam Chair, and that is that insurance is not just a financial product for organisations like Scouts. It is the foundation that allows young Australians to safely participate in community life.
Thank you very much, Mr Tompkins. I'll go straight to Senator Sharma for the first block of questions.
Thanks, Chair, and thank you, Mr Tompkins and your colleagues for that evidence. In your submission, Scouts highlights what you claim is the insurance industry's disregard of an evidence base in the Australian Adventurous Activity Standard, the AASS, and saying that you make the claim that the insurance market's failing to reward risk-mature operators, resulting in irrational pricing. Can you just outline, before we get into that particular part of it, the impact that AASS, isn't it? Australian Adventurous Activity Standard, has had on accidents and claims in the sector and how long it's been in effect for?
Would you like me to answer that? Yeah. So the Australian Adventurous Activity Standard is actually owned by the Outdoor Council of Australia.
Right.
And all of our operators have access to that, which the industry standard was created because there is no set government-endorsed Australian standard that exists. So it is our industry standard that we provide a good practice.
Okay.
Can I just say this? When I mentioned specialist brokers, that was a really key driver for us in getting them to connect with that tool and understand. understand it, and also use that as a bit of a guide to assessing businesses and quoting their insurance.
Okay.
So, to Mr. Tompkins' points there, we were able to connect them with a specialised broker only last year, which has provided...
Scouts Australia.
Correct.
Right, okay.
And Scouts ACT specifically, because they're different entities across the country, and be able to get them a good quality outcome on the basis that that specialised broker recognised those tools and recognised their risk mitigation with their activities aligned to that AAAS.
Okay. And so just what impact has the AAAS had, though, on accidents in the sector in the past 10 years and claims in the sector? Have you
That's a really good question, and I think we've got to look back and say this was only released in 2019. Timing,
the standard?
The standard.
Right.
Timing's everything, right? 2020, what did we do? We literally locked up, and unfortunately particularly our camps and our guides and anything that involved children were the last to go back to business. So we weren't back technically until October 21.
Okay.
So we had a very long hiatus at that period. So we had to fast track that endorsement of the AAAS and get them to start using it. And obviously that was beautifully paralleled with our insurance issues, because we knew that out of COVID that was our biggest challenge as underwriters started removing themselves from Australia. So we actually have a system called Uploads.
Yes, which is a sort of an incident report.
Correct, that's right. That's been in existence for 10 years, and that's been able to track trends of incidents.
Okay.
Now, what I can tell you is our incidents are very, very low. You'll be more likely to have a soccer incident than you would in any of our activities in the outdoors.
But what's happened to your incidents in your sector just compared to the historical experience in your sector?
Previous to the AAAS?
Yeah, previous to the AAAS. And so what does the Uploads data tell you has happened in the last... You've had the AAAS effectively in operation now for almost 5 years, right?
Yes, correct.
What does the post-AAAS data show versus the pre-AAAS?
Yeah, I could take that on notice for you, because literally it was only 3 years we had the Uploads data prior to the AAAS launch. So we may not find that there's enough data there to compare, but we can certainly take that on notice and share that with you. But what we can tell you is it's been very warmly accepted by all the land manager agencies, in particular National Parks and Wildlife, New South Wales and the likes. They see that as a bit of a guidance to licensing what they call the EcoPass, which is commercial operators going on to their tenure and performing these activities. They've been able to reference the AAAS as a bit of a guide to ensuring that they're not providing an EcoPass to a random, unmitigated organisation that could potentially result in injury.
Okay. Now, you make the claim that the insurance industry is, if I'm misquoting you, please correct me, but the insurance industry appears to be ignoring 10 years of national incident data provided by the Uploads system.
Yeah, we've been able to prove with some of my members that haven't gone to a specialised broker, but they've managed to get insurance and probably at a reasonable rate, but they were never asked for evidence on how they comply with the industry standard. Now, for me, that keeps me up at night, because at the end of the day, I want a safe industry, first and foremost. So if I have an organisation that hasn't been asked for that evidence, I worry about that insurance cover, because if they have a claim, all my operators that are doing the right thing will then suffer and premiums will go up.
Okay. But have you seen evidence that if you do, if your members approach insurers saying, well, we've got this data, we've got this standard, are the premiums then changed to reflect that?
They have been, yes. So again, it's going back to that specialised broker mentality and making sure we connect. I've spoken on many occasions, even in the tourism industry, where tourism businesses have gone to, say, a tourism industry council, haven't been able to get insurance, and I recommend to them to go to a specialist broker that understands their industry, understands their business, and they can provide some risk mitigation advice to that industry, the similar way that we've actually done it in the outdoor industry, and they've actually had great results from that, purely because the broker understands what they're actually insuring, and they can represent.
Your experience is that the mitigation steps you've taken, the standard and Uploads, have been reflected in lower premiums from insurance companies, provided you go through a channel that understands that, so a specialised insurance broker.
Yeah. Can I pull you up on one word, which is lower? I wouldn't say that we've been able to get significant discounts on the basis of this, but we've been able to get cover at a reasonable rate.
Okay.
So it's when we're reflecting the systemic issue of 20 million liability and some of the legal issues in tort law reform that premiums are at a rate, and they probably should be a lot lower in our opinion. But we're getting insurance, we're able to operate, and we do have a very emerging industry in the outdoor industry. To the points that Mr. Tompkins said, we've got some kids with some serious mental health challenges today, and we've got the solutions. So, trying to get our industry moving into that space is incredibly important, but we're seeing the demand increase.
Senator, may I offer a on-the-ground perspective by asking our colleague to...
Just keep it brief because I'm conscious my other colleagues have... please go ahead, but we've got...
what we have found is that by engaging directly with the insurers, talking about the training that each one of our leaders undertakes, by showing them evidence of our detailed risk assessment, and to also show the methodology that we use in outdoor adventure activities, we find greater engagement, and Scouts ACT has got real evidence, not of a decline in premium, but of a lower than what could otherwise have been the increase.
Yeah, certainly 2 years ago, Scouts ACT struggled to get public liability insurance.
Yes.
Within 24 hours of not having it. And then when it came through, I think from memory it was 168% increase in the premium, which for a small not-for-profit is just so difficult to stomach.
What's the quantum that you're talking about there?
From...
What's the cost?
The cost of it. Do you remember the exact cost of it?
Can you take that on notice?
Yeah,
Thanks.
certainly happy to provide that. We've then done, as Ms. Mota said, and have gone to that specialist broker, and certainly our premiums have come back, but they're still substantially higher than what they were even in the early 2020s. For us, not only was the higher premium, it was also the higher deductibles that they enforced on us. So for our adventurous activities, it was a deductible of $100,000. So, we're a small organisation. If we did have a claim against that, where do we find the money to just even pay?
So is that under your current policy or the one?
No, so that was the previous one.
But under your current policy, it's less.
Come
onerous.
right back again.
Okay.
Yeah, the deductibles, yeah. I think from memory, $10,000. Yeah.
Okay, which is right. I mean,
Yeah, substantially different.
yeah, it's significantly different. All right. But thank you, Chair. That's all I had.
Thank you. Ms. Jarrett.
Thank you. Just on the AAAS, did anybody from the insurance sector get involved in helping draft that?
Yeah, great question, because yes, and we're also in the review phase of the AAAS right now, and we actually currently have people from the insurance sector sitting on those review panels.
Insurers, brokers, who's on those panels?
Both, yeah. So we actually do have, we've got a great relationship with specialised brokers who we've offered to sit at the table, and they have been.
And you talk about specialised brokers for your sector. I haven't heard that term used a lot.
Yeah.
Are they specialised brokers for other sectors?
Absolutely. I'm actually working with the travel industry at the moment, to identify their own. And it literally, all that means is that the broker has an understanding of the mechanics of the industry and what the actual risks are. So they become risk advisors as well as insurers. And I think that's the key. We're in the business of risk mitigation together to secure the investments from both sides of the equation.
And therefore, to find a broker who's a specialist, is there an advertising limitation that stops them from saying that?
Not that I'm aware of, but I will give you an example. I worked with an organisation who was a tourism operator, and he rang me because I've been speaking a lot about insurance, more than I ever thought I would. And he rang me because he said, my premiums have gone up 150%. I said, well, then you haven't got the right premium, you haven't got the right business, because that's ridiculous. When we looked at it, he went through a broker who said, well, I'm not really knowledgeable of this area, so I'll go to this broker and I'll sell it, but I'll go to this broker who can get the insurance.
He's on selling?
He's on selling. What we found, there was 3 premiums on that one quote.
So on selling in that respect, from broker to broker, is
Correct.
quite allowable.
Correct.
Okay. Haven't heard this one come up before either. I do have a question. Do we have time if I have a question on torts?
And then we'll be going to the lunch break.
Just very, very quickly, you talked about the fact that your insurance is priced for legal exposure, not the risk, and therefore we need tort reform. How does that tie in?
So the understanding of the legal risks associated with an incident, in my opinion, and my advice that I've got from people in the insurance industry, is the underwriter's relationship is saying, right, if this goes to court, we expect this sort of litigation to occur. That is brought about by the tort law boundaries, from what I understand.
Okay, I think that might, from our perspective, we might need to explore that further, because that might not be a legal requirement. It might be an assessment of what could happen, and is that assessment therefore a reasonable assessment of the risk
Absolutely.
to the sector, to you, which then increases the price. Okay,
Absolutely.
thank you.
I'm just going to put one question on notice.
Sure.
All of your organisations call for a lowering of public liability threshold. You say that it's an arbitrary shift from 10 million to 20 million. Can you please go into detail about, when that occurred, what communications you had around that, or lack of communication? I want to understand that.
Yep.
Where is the matter currently? How is it impacting your sector affordability of insurance? Are you sure that your premium is affected by the increase to 20 million, or is that just an assumption?
Yep.
That's allowed the premium increase? Because we have no visibility.
Yeah.
So if you could...
Neither do we.
Okay. Well,
And I can answer that quickly for you if you like.
yeah, and then we'll get further information on that.
Yes, and it tends to be a trend. Like if a land manager requires a 20 million, then every other land manager follows and requires a 20 million.
Yeah.
It is a natural progression that we had no notice of.
Yeah.
The insurers tell us that, they didn't really have much notice of that either. It becomes a procurement issue. And, I made the example just outside the room a little while ago that if my guys go to a careers event and they go to a school to exhibit and say, come and work with us, they require a 20 million cover for that. But yet they take 25 people on an abseil, they also require a $20 million cover.
Okay.
So it's a misunderstanding of actually what the risk is.
Yeah, and we should ask all of the insurance companies and the representatives about why this has become a thing, the Insurance Council, why has this become a thing, and how does it affect pricing? Because I don't think there's any data around that.
No, not that I'm aware of.
Okay, so anything you can provide with us, provide us, any rationale, any cost indications, we appreciate it. Can I thank you for being here today and for the evidence that you've given. If you could provide answers to questions on notice by the 29th of May, that would be much appreciated. And the committee will now break for lunch and return at 1:15. That gets us back on track. Shorter lunch. Representatives from the National Insurance Brokers Association. No. Here we go. I now welcome representatives of the Insurance Council of Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, would you please state your full names and the capacities in which you appear today?
Andrew Hall, CEO, Insurance Council of Australia.
And Alexandra Horton, General Manager of Regulatory and Consumer Policy at the Insurance Council of Australia.
I now invite you to make a short opening statement, and then there will be questions from the members of the committee.
Great, thank you, Chair, and thank you to the committee for the opportunity to be here today. The Insurance Council's members write around 90% of general insurance cover in Australia and provide cover to most of the country's 2.5 million small businesses. We welcome the committee's focus on this issue and we're glad to be part of the hearings here today. Let me start first with the products themselves. Small businesses rely on a range of insurance lines, evidenced by the $14 billion paid out in 2025 across 5 lines of commercial insurance. Public liability and professional indemnity protect against third-party claims. Business pack policies bundle different types of cover into one. Workers' compensation sits separately, but are a cost to business. Those are statutory schemes with rates set by governments. Beyond these, there's business interruption, which covers lost revenue when a business is forced to close because of physical damage, trade credit, which covers part of a loss when a purchaser fails to pay, and industrial special risk for businesses with unique or significant asset risk. And increasingly, cyber insurance covering cyber attacks and data breaches is also included. How small businesses access these products is also distinctive. Most of us buy our home and car policies directly from an insurer. Small businesses are different, with the vast majority going through a broker. As the committee has heard, insurance is a cyclical market for both pricing and profitability. Insurance cycles between what's known as a hard and soft market, reflecting on the availability of capital and risk appetite of underwriters. Australia and indeed the world have endured an extended hardened cycle driven by inflation, geopolitical volatility and extreme weather. On top of that, we're seeing social inflation. That's the claims costs growing faster than the wider economy, driven by changing legal and social expectations rather than ordinary price increases. In terms of small business, we've seen signs of the market softening, but there are still 3 key issues that need to be addressed: civil liability reform, tax and regulatory reform, and investment in extreme weather risk mitigation. Public liability and professional indemnity have what we call long-tail claims. A claim made today may not settle for 5 to 10 years, by which time the legal landscape has often moved. So insurers just aren't pricing for the risk today, they're picking up the legal environment and risks that may exist when the claim eventually settles. The current civil liability framework that governs these settings came out of a crisis. HIH insurance collapsed in 2001 with a shortfall of around $5.3 billion. It remains Australia's largest corporate collapse, and at the time HIH insurance was one of the country's biggest writers of public liability and professional indemnity insurance. After HIH, professional indemnity and public liability cover capacity dried up. Community groups, sporting clubs and small businesses felt it most, particularly in the building, trade and medical professions. The government response in 2002 was a review led by David Ip. It reset civil liability settings across the Commonwealth and brought the market back into balance. Public liability and professional indemnity only work when premiums reflect the real long-term costs of claims. When the legal framework lets these costs drift up, that flows through to premiums and the sustainability of the market. The IP reforms held for nearly 2 decades, but claim costs are now growing significantly faster than CPI, pushed up by rising legal fees, the expansion of psychological injury and worker-to-worker claims, and broader shifts in how courts apportion liability. In insurance, we know this as social inflation. Costs aren't moving the same way across every product. Over the past year, professional indemnity has stabilised and public liability is easing for most businesses. But pressure remains in higher risk sectors like adventure tourism and live entertainment, where small operators face tight conditions and high premiums. The ICA covered a lot of ground in our 6 submissions to this inquiry. In our view, the single most important recommendation the committee could make is a national review of civil liability settings, given it's now nearly 25 years on from the IP review. A second cost pressure on the cost of cover for small business is tax and regulation. State insurance taxes raised $8.9 billion last year. Stamp duty compounds with GST, so small businesses essentially paying a tax on a tax. The Henry Review in 2010 identified these as the most economically inefficient taxes in the country. The ACT abolished stamp duty on insurance with no adverse fiscal impact and moved to a broad-based property tax. Other jurisdictions should follow with the support and guidance from the federal government. Across all lines of insurance, the regulatory burden has climbed to an estimated $3.5 billion a year. This cost ends up on the premium with no benefit to the consumer, and often these requirements are duplicative or out of date. The government should commit to a genuine review and reduction of the regulatory landscape for insurance. And the third pressure, of course, is weather. The economic cost of extreme weather in Australia last year was $8.6 billion in claims. For every $43 we spend in 2025 cleaning up after disasters, we spend just $1 on mitigation and prevention. Mitigation doesn't only protect homes and businesses in harm's way, it protects those small businesses that are the backbone of disaster-exposed communities, particularly in the regions, and it has a material impact on the cost of their cover. So 3 interconnected priorities taken together would put downward pressure on the cost of insurance for small business. None of this is new. I'm sure the committee has heard a lot of this in the hearings and the submissions it's had to date. But we believe this committee is well placed to drive this conversation forward as we get moving. Happy to take questions.
Thank you very much, Mr Hall. And I'll go straight to you, Mr Buchholz.
Thank you, Chair. Thank you very much. Can I just start, Ms Hall, thank you for your opening comments today. They're very informative. A number of points I want to pick up on, and I'll start with the stamp duty component from the states. Have you made representation to the states, and what level of enthusiasm have the states suggested to you that they're keen to abolish the stamp duty component that you addressed in your opening comments?
Well, Mr. Buchholz, I mean, I've been a broken record for years and years and years about stamp duty on insurance products. And I've heard the comments from the Chair and others in the last couple of days about the need for revenue and completely understand that these are not insignificant revenue sources for states. The problem with stamp duty on insurance policies, however, is what in effect it is doing is punishing those that are doing the right thing by taking out an insurance policy. And if you drill down on a fairness perspective even further, because insurance prices risk, those homes or businesses that have the highest level of risk and technical pricing are paying a higher level of stamp duty. When you buy a home, you pay stamp duty once, but when you then insure that home, you pay it every year. So what we see is for example, you know, I've been to Lismore many times now, and you know, I've met people who are on $60,000 a year who are paying $6,000 a year in premium driven by the flood risk for where their property is. Out of that $6,000 premium in New South Wales, $2,500 of that is tax. It could be reduced if the Minns government is able to get through its promised reforms on abolishing the emergency services levy here in New South Wales, and I'm hopeful that there will be some bipartisanship to make that happen within New South Wales. But the outcome of the ESL in New South Wales is that we see homes in New South Wales running at double the rate of underinsurance than homes in Queensland and Victoria. So on the other side of the Tweed River and on the other side of the Murray River, underinsurance is sitting at around 8%. In New South Wales, it's sitting at 13%. And the only thing that is driving that, for what we can work out, is the fact that more of your premium goes in tax, specifically the emergency services levy, than it goes towards funding a total sum insured. So it is a hard conversation, and we'll start with the abolition of the emergency services levy in New South Wales as something important, and we're very resigned to the fact that that will come with price monitoring to make sure the full benefits are passed through. But having done that, even if stamp duty isn't abolished across the country, like the ACT have done, I'd urge the federal government to lead on a conversation with the states to make sure more of that money is going into resilience and mitigation work, because at the moment very little of it is.
I'm going to come to resilience. Just for the record, and I know it was included in 2 of your submissions of the 6, I think, where you spoke about stamp duty reform. How do other states collect the emergency services?
Well, there are only 2 now that do it, New South Wales and Tasmania. The ESL has a very long history. The insurance industry used to run the fire brigade, and when they handed it over to the government then implemented a levy to keep funding it via insurance policies. It's a very old tax that's slowly morphed over many years. It's time for it to be absorbed in a broad-based tax, like other states do. Queensland got rid of their levy 30 years ago.
Yep. Weather payouts, $8.6 billion. You mentioned that $43 for every $43 spent, only $1 has or gets invested into mitigation. During the course of the hearings, we've discussed some towns in regional Australia that have lent in on mitigation, building a weir around their communities. And there's a sense of frustration in those communities from civic leaders, around that they've been promised a reduction in their premiums for leaning in. A flood event, they mitigate. Another flood event, houses are no longer inundated, increases in premiums. Can you just speak to that chain, and what is the signalling to the other communities to go and mitigate if there's no financial benefit?
Well, the first benefit for mitigation, number one, is that homes don't flood. And flood is a very different event to cyclone and bushfire, because when we see cyclones and bushfires, the homes are destroyed and are total losses. When we see a flood, the home is still there in place, and the insurer comes back and rebuilds, and everything goes back into place. So flood is our most costly peril. It's the one that the insurers need to be able to price that home is going to get rebuilt and restored. And we can calculate off the data the frequency, the depth, all the factors in which a flood's going to happen. It's not only a problem in Australia, it's been a problem around the world in all developed insurance markets, and every country has tried a different process to try to deal with it. I think what's happening in southwest Queensland, the councils are doing a very, very good job. They've identified the right risk, and we agree with them 100% on it. In fact, they're probably a great example of where, when you do mitigation, we need to do it right. So if I speak specifically about southwest Queensland, we've had nearly half a dozen meetings with them over the last couple of years. We identified that their flood maps were out of date. The latest was in 2014. They since updated them. They've since identified gaps in that flood mapping. I'm pleased that the Queensland government's put $15 million on the table, and they're now doing extensive flood mapping. And the great thing that the Queensland government is doing in that area is they're going to not only map the flood and the mitigation work, but they're going to provide insurers with floor height data. And in small towns, that's really important, because what tends to happen is when you're mapping the town, you can just assume a whole block of land goes underwater, when in fact the house may be on high and dry and the bottom isn't. If we can get more granular data, it will help for more accurate technical pricing. Roma is an example globally of where insurance had completely left the market in 2012, 2013, after those floods, where they built a levy and it returned to the market. And when we look at the premiums and the policies in force in Roma and compare them to other towns, by and large, they're maybe only $200 or $300 more expensive on average than ones in Brisbane. And that is largely attributable to the higher cost of rebuilding in a regional community like Roma. One of the challenges that regional communities have in Australia, whether it's southwest Queensland or anywhere, to be honest, is you pick a town, like Forbes in New South Wales, in a flood-exposed town, Forbes. Average home, $300,000 to $400,000. If a home is destroyed in Forbes, it costs about $1 million to rebuild it, because there just aren't the builders and labourers available. The local builders are booked out for 2 years in advance. We've got to bring in workforce and all the rest. So what often these towns are seeing is that they feel that I only want to insure my home for $300,000 or $400,000 because that's what my mortgage is. But what the insurer is trying to do, we can't give them advice. So they pick their sum insured. We're not allowed to. But the insurer is trying to price for actually replacing that home. And there are the factors that go into these pricing decisions.
Thank you, Mr. Hall. But can I just bring you back to that $1 of mitigation? So we don't have an over elaborate set of experiences to look at. This community has built a levy bank around it after a flood event.
Which one is that?
Charleville. And I think that was in 2010. There's been a number of flooding events since. And a comment from, again, one of the civic leaders last night, no house inside the mitigation in the town area has had water in it since 2010. What level of granular data are you looking for that community to see a reduction in their premiums?
Yes, Charleville has got a levy that's been built around it. It's an incomplete levy. It relies on the council to put up a temporary levy when they know that a flood's coming. So number one, it relies on adequate warning, and that, you know, that is a factor. And we say to councils, if we're going to build a levy, it needs to be built properly around the town. It also needs to be built to the maximum probable flood height. So what you can see when we look at the premium pricing at Charleville that we've done quite extensively with the Mayor and others out there, and I have to say they've been really great. And we got a great email from the General Manager of the Shire who showed us all the work they're now doing on the data collection there. You can see that insurers are pricing up to those nuisance floods, the ones that have been blocked by the current levy, but it has the capacity to go another metre over that, and for every 10 centimetres over that metre, you can see the price starts to correlate directly onto premium. So, in Australia, there's 242,000 homes that are sitting in a 2.5% chance of flooding every year. By comparison, there's the same number of homes sitting in the UK. The UK have got 60 million people, we've got 26 or 27 million people. We've got a really big problem compared to other developed insurance markets. Out of those homes, we know that insurance penetration rates are sitting now only at 23%. So 3/4 of them don't have insurance at all. And that is that's a terrible protection gap. If insurers can get line of sight to mitigation work getting done, we know there's not necessarily going to be a flood next year, maybe 2 or 3 years away, but there will be a flood. If we can get line of sight and we can work in partnership with government on a scheme, there are ways to bring down the costs of those flood premiums.
My question's still the same question. When would they see a reduction? 2010, the mitigation went in. With 2026, that's 16 years later. For all intents and purposes, during this inquiry, people have been using a 10-year period. This is getting close to, not quite double, but a significant amount of time with no increases. I want to see that $1 mitigation increased, but my point is, why would they?
Well, because they will.
Well, they're not getting a decrease in that.
No, but they will. Well, there are also many cases around Australia where we have seen pricing return to more normal levels once mitigation is completed. Launceston in Tasmania. There's a number of high-profile cases where it occurs. Whenever we see, and this is, I guess, probably getting back to what this inquiry is focused on, small business, wherever there is a very high premium, the one place we always start is we go back to the underwriters and ask them to identify what are the key risks that they're trying to price. And when it comes to flood, building levies hasn't been a very sexy priority, for want of a better description, over a long period of time. We have a flood, everyone gets in and cleans up, and the sun comes out, and the discussion continues. There was a flood in Bundaberg 2.5 months ago. I went up there. There has been a proposal on the table in Bundaberg to complete a flood levy around the CBD that would have stopped that flood impacting 200 homes and 40 businesses that were wiped out only a couple of months ago. In fact, $170 million was put on the table for it to go ahead, and for whatever reason, the council and everyone didn't push it ahead with that flood levy. And again, we go through the same cycle of devastation, rewriting flood maps, data going into systems, and it impacting on premium. We've advocated for a flood defence fund in this country for a number of election cycles now. The insurers have now provided to the federal government all of our peril data that we use for pricing. So the federal government has it through the Hazards Insurance Partnership. There will come a point, I think, in the future where communities like Charleville will say, when they have the major flood that goes over the top of the levee, they'll say, government, you knew about our flood risk. Why wasn't more of the stamp duty or whatever put into building flood levies around our community? And these are all difficult questions, and I think communities should be given the ability to determine how they want to protect themselves, whether it's through a levy or buybacks or house raisings or whatever it is, because every community is different and they've all got views about how they want to do it. I think there's one thing that the committee could consider is a scheme where, with all due respect to our state government colleagues, if the federal government had a bucket of money, which it does at the moment, it's got $200 million a year in the Disaster Ready Fund, if that money was directly allocated to hard infrastructure spending, like flood levies, and you allowed local councils, Taree is another great example. Taree has a proposal on the table to build a flood levy to protect its CBD. It was going to cost them $5 million. It went nowhere because the Mid-Coast Council didn't have the money to do it. And I look at cases like that and the 30-odd businesses in the main street of Taree that went underwater. And I asked the question, why wasn't that put up to the federal government for their Disaster Ready Fund? Because that's a prime example of mitigation that would work. And not only does it have an impact for premiums, it just stops a community getting flooded all the time.
I appreciate all that. I would probably just leave this point on this comment of a community who has mitigated that have not seen any benefit in the reduction of their premiums to date. 16 years, confirmed by the Mayor, who said we haven't had a house get wet since 2010.
Well, they have had homes flooded in Charleville. I can show you the claims. But inside that, the wall they built, they've kept out those most recent floods, that's true, but that's not the maximum probable flood height.
So houses inside the area that's been mitigated?
Yeah, but that's not the levy's not built to the maximum probable flood height, and that's the problem. And we're working with the council on this, and we work with councils everywhere. I had a meeting with Kempsey only a couple of weeks ago. I'm meeting hopefully with the Mid-Coast Council, where I found the latest flood maps that have been done in that area weren't done. The last one was done in 1991, and the amount of population growth that will have happened between Foster and Taree in that time, there are, I think, 400 homes that are not flood mapped in that area.
Can you share for the committee then, if communities did mitigate, how much of a reduction would you expect to see?
So we've got, through the Hazardous Insurance Partnership, which the Albanese government set up, the agreement there is if they decide to put money into building a flood levy, for example, around Bundaberg, helping getting that one completed, or wherever, we will take that information, and we've done a few trials of this confidentially, we'll take that and we'll go back and get a number of our members to run their pricing models with that risk eliminated. And we're able to then get a line of sight to see what benefit that provides that community if the work is done. And the challenge for insurers, what we want to be able to achieve, and this is looking at schemes around the world, if we've got line of sight towards a project getting completed, can we get comfort to reduce premium now even though the project isn't completed? Can we find a way of spreading the costs if the worst was to happen, the way we do with CTP, for example? So if you think about CTP schemes, it in the background redistributes the cost of bad drivers with good drivers amongst all of the insurers. There are ways and means of doing this. It's complicated. It's tied up in competition law, but we are working very hard on this. We're working with Treasury on it.
Did the mitigation in Charleville reduce the risk?
It didn't obliterate the risk. That's
not obliterate. That wasn't the question. Did it reduce it?
It reduced it, but didn't remove it.
Didn't remove it. So did you said you had claims there recently. Was it the same amount of claims before the mitigation went in, before the levy bank went in?
I'd have to check, but I remember when I looked back on the in floods in the last 5 years, and there've been several flood claims out of Charleville, and they could be homes that sit outside of the town. But there have been flood claims in Charleville. It's not that there have been no flood claims in Charleville. We just need to be clear on that.
Thank you, Mr. Hall. Chair.
Thank you very much. I'm going to go to Ms. Jarrett next.
Just on the Disaster Ready Fund and how that's allocated, is there any ability for the insurers to have to put forward projects or to have input into projects? Because that's what it's there for, right? It's disaster mitigation.
No, the way it's been designed, which I think is better, the way the government has designed it, and I think it's smart, is that, number one, we've provided all of the peril data, which is really commercially sensitive for each insurer. It's part of their pricing engines. This has never happened anywhere else in the world. Other governments have had to sue their insurers to get this data. But we've proactively come to the table, and that's been provided into through the NEMA process through the HIP. The next step of this is narrowing down how the DRF is funded, and I'm hopeful that maybe there's some change that can come in the next round, maybe in the budget or afterwards, that says that $200 million, which is significant, if it goes towards hard infrastructure, and there can be a criteria, the same way you decide road funding and all those sorts of things. One of the criteria can be to come to the insurers, as I was saying to Mr. Buckholz, and have us look at what the removal of that risk would look like on premium pricing in an area. Now, it takes out the risk component of that price. It doesn't over time, and I think Southwest Queensland feels the full brunt of inflation. Inflation also drives insurance. Reinsurance costs are also driving insurance. All those things, add up, I guess. But we can work with government on whether a proposal will have the desired effect in terms of premium.
Okay, thank you. Just on my other question actually related to reinsurance, because we haven't had a lot of discussion yet on the inquiry as to the status of the reinsurance market. Are you able to give us an overview of how you see it? Because we do know that their reinsurance has been prohibitive in certain areas, but I'm not clear as to where that is. Is it greater now than what it has been in the past, etc.?
Yeah. There was an adjustment in reinsurance pricing in Australia about 3 or 4 years ago. I recall when the Economics Committee did the inquiry after the 2022 floods, Swiss Re presented evidence there that showed that the changes that occurred in the Australian market to pricing reflected the fact that Australia had been what they called a loss leader for them globally. Australia, if you speak to the reinsurers, will tell you that for many years we were an offset diversification for other bigger events, earthquakes in Japan, typhoons in Florida and the like. That started to shift about 10 years ago, where we saw our population and particularly our property values and the cost of building properties in Australia go up enormously. More people living in riskier areas along the coast, and the cost of claims going up. So there was a readjustment about reinsurance rates jumped in 1 year alone 20 to 30% depending on the reinsurer, which was a very big jump. Mm-hmm. Now, the reinsurance market has softened again a little bit in the last year, which has reflected that globally insurers make money from both the premium collected and reinsurers and from their investment pools. And they have to invest in liquid types of things because they need that, they may need that money quickly. And we've seen better rates return to those investments. So a lot of the profitability return that's happened in insurance in the last couple of years came out of the investment pools rather than premium, for example. But reinsurance is critically important. Australia would never have enough capital to be able to guard against the worst happening here. We and particularly post-HIH, our insurance is a solvency game, unlike banks, which are a capital game, and insurers rely very heavily on the reinsurance markets to be able to be a backstop for those very large events like 2022.
So we have sufficient access, given it's a global reinsurance market that we access. We heard that Lloyd's has 80% or something of the reinsurance of the small business sector. Would that be right?
I'll need to check the reinsurance number, but Lloyd's do reinsurance. But Lloyd's has about 40% of the indemnity and liability markets.
40%.
But Lloyd's is not a single company.
No.
Lloyd's is like an ASX. It's a marketplace of underwriters. Yeah. And so there'll be lots of businesses within Lloyd's that
offer that.
And they specialise. So if the committee members are ever in London, be very happy to organise a tour of the floor in Lloyd's, and you can walk along and you'll see literally, aircraft underwriters, all that sort of thing, and you sit down and you negotiate deals.
Is there any scaffolding underwriters?
There would be. I mean, you pick whatever commercial activity goes on in the world, and Lloyd's will give you a view about what's happening in that space. Yeah.
And if the reinsurance market has softened in the last year, is that going to be has that been reflected in premiums, or it hasn't softened that much?
Well, I think the main thing is that it's being overtaken by inflation, no matter what. Our building.
But their contribution, I guess, to the insurance costs, though, the price that we're paying, businesses are paying.
Well, I think, again, these are all, I don't have a line of sight over the individual treaties that each insurer has with their reinsurers. I understand the last round was still very tough.
Yeah. Okay.
They occur in the middle of the year, so we'll have a better view about this again in September.
Okay.
I think, though, what we do get from reinsurers is more of a step back analysis of risk often, and it is interesting the depth of understanding they will have around a risk that's driving a loss in the Australian market. So I have sat in a reinsurance boardroom in Zurich and had them explain to me verbatim what is going on in Roma. They understand it intimately. And so they will be looking at their insurer customer and saying, what is your exposure to the Bundaberg CBD or the Taree CBD? They'll be going through all of that with their insurer customers and then building up the price with that.
And have you seen them pull out of markets here in Australia? Because we heard earlier testimony that there has been reinsurers unavailable or prohibitive.
I'm not pulling out per se, but I guess the issue is when we talk about markets in insurance, often you hear the word market failure. What's happening is the pricing, and you can insure anything at a price, and someone will offer a price on insurance. At some point, though, the question of affordability becomes the problem.
Yeah.
When it's an availability question, there must be something deeper going on, and in other words, it's impossible to measure the potential risk exposure that you're being transferred. So the appetite of the insurer to offer cover for that disappears. It probably does happen in reinsurance. I'd have to have a look at that, but.
So I think probably the most relevant example would be Far North Queensland and cyclone risk, where there was reinsurance available at a significant cost. And so the development of the cyclone reinsurance pool was designed to address the significant costs for cyclone cover in Northern Australia. That's the most contemporary.
So what I'm hearing is it's not that it's not available per se, it's probably the cost that's making it prohibitive for certain insurers to get that reinsurance.
For certain lines or for certain types of risk, it may be that the reinsurance cost is quite significant, and the insurer would then need to balance where they're allocating capital across their portfolio and how much reinsurance they're willing to purchase for a particular risk.
Okay, thank you. And just one last question, Chair. You said that you go to the reinsurers to understand the risk they're trying to price. That, I think, actually goes to the heart of what we're trying to find out is information on how they do price that risk, or what the price of that risk should be, given the examples that my colleagues have mentioned. So what do you see there? Like, is there a formula? Is there a way of thinking?
We've seen, I guess, in the small business, home and contents is driven by peril risk. That's very obvious. We can talk about that, and we have done already.
And it relates to small business in terms of, they're renting properties, so there's a property dimension there. But let's just get into the small business space now.
Yeah, okay. Through the ICA, one mechanism has been that we've had a business advisory council ever since COVID, where we use state-based small business commissioners, the federal small business ombudsman, members of ACCI, chambers of commerce and the like, and then we go to industry group who will identify that there's an industry that they are aware of that's under pressure. And some examples have been caravan parks, adventure tourism operators, live music venues, Indigenous cultural burning organisations. We then partner with their industry associations, and we then go back to our members to understand, and we also, with the brokers are a big part of this, and you'll talk to them later, but more than 90% of, unlike personal lines of insurance, business is highly, highly brokered and therefore advised and compartmentalised and tailored and all the rest. So we will get all the incoming data we can collect to understand if there is an issue. Now, the ICA has, for a number of years at a board level, held a position that where there is no availability of a product and there seems to be no solution in the market that can be found, we are prepared to look at models like what existed post-HIH to come together on. And there's been a couple of those examples that we've contemplated in the last couple of years. One was with country shows, for example. But eventually what we've done in all of these cases is we've been able to identify where there has been the main risk driver that has been driving the high technical pricing of the risk, and worked largely with that industry body to come up with risk mitigation frameworks that the insurers will accept and that can be used by brokers when you're going to market to prove that a business is doing the right thing, and makes it a lot easier to place their cover. In the country show example, the biggest driver of that was actually councils forcing over insurance on the shows, requiring them to hold $20 million in public liability, even though the show in Carcoar was never going to incur $20 million liability loss. It's been these sort of default settings where we've had to go back and say, let's right size what's being asked for in terms of what's being priced. In the live music, we Consult Australia. We also worked with the consulting industry around professional indemnity. But live music has been another example. Do you want to talk about that?
So we've worked very closely with the Live Music Business Council through our Business Advisory Committee to really understand the specific risks in their space. And then the Live Music Business Council was able to develop an app for their members that allows them to better track and manage risks in their businesses. And that has seen more interest in that market from our insurers in terms of providing capacity into that market. What we do see occasionally, so we always underscore the criticality of businesses engaging with their industry association. That's really important from an information sharing and best practice point of view. And often we'll find that individual businesses that we hear of that have acute challenges either may not be heavily involved in their industry association, so they're trying to grapple with issues that other businesses in the industry have dealt with effectively, or sometimes putting them in touch with the right broker, a broker with deep specialised knowledge in that space.
We heard about specialised brokers earlier today.
And it's really important. We saw this again with Indigenous cultural burning, where we had a number of businesses that were very challenged in terms of accessing insurance, and getting those businesses together with the right broker did see more capacity come back into that market. So while it's not a perfect fix, making sure that there is that engagement with industry associations. And just to that point, we have consistently recommended to governments that there would be an opportunity to provide a small amount of funding to a relevant organisation to work with industries that are particularly affordability challenged or accessibility challenged, and engage with us so that we can roll out those more targeted risk mitigation practices to those industries a bit more effectively.
When you say there would be a small amount of funding, is that being proffered by the Insurance Council on behalf of the sector, or is it a cost to government? Like, what is that funding that you're referring to there?
So we've proposed in budget submissions that the government provide a small amount of funding to, say, the Small Business Ombudsman or another relevant organisation that those small businesses will often be in communication with, so that they can highlight where they're seeing particular areas of challenge.
That's all, thank you. Okay.
It's not much. With I think the live music one could have been fixed with $1 million granted to the industry body.
Mr. Hall?
I think for the good operators, they're finding cover again. I think that there are others that I'd encourage them to talk to their industry association about what the mitigations those that are doing that are getting cover.
Sorry, can I just ask one more question? You mentioned default settings, actually, in a comment that you made earlier. 20 million, and that's the liability piece. When you say default setting, is that literally how the market is operated? As in not your market, the request for insurance is operating. Is that what you're seeing?
So we see standard requests for $20 million liability across most councils and local government areas.
Council, local government?
Yeah, for use of their facilities. So whether that's an oval sporting facilities of some sort, $20 million has been in place for quite some time. We also often see it in government contracts, a request for a certain amount of indemnity or liability before a small business is even able to bid for a contract. So they're having to hold a really significant amount of insurance before they even get the work or even have an opportunity to get the work, which can be really prohibitive for some of those businesses. So to Mr Hall's point, we worked with Consult Australia quite extensively to advocate for much more proportionate insurance requirements and also to encourage governments to consider only requiring insurance once the work has been granted. Another issue we do see in that space is large head contractors pushing liability down the supply chain to those that can perhaps least afford it or least hold that risk. And so that's pushing really significant insurance costs onto the smaller businesses towards the end of the supply chain. There has been some moves to prevent that sort of activity, but it probably needs to be ramped up a little bit to make sure that the liability is sitting in proportion with the risk being borne by the business.
Thank you.
Thank you. I'll go to Mr Sharma now.
Thank you, Chair. And, thanks, Mr Hall and Ms Rawdon. Just the way you were describing the burden of taxation, Mr Hall, before, it struck me the way the stamp duty and the emergency services levy is collected. I mean, it's effectively a regressive form of taxation, isn't it? Because people who pay the highest premiums are often low income or high or lower socioeconomic areas. So Lismore, for instance, if you're paying a very high premium, you're paying a much higher amount of stamp duty than someone who's got a house on the North Shore of Sydney, for instance.
Correct.
There's no progressive element to it. I mean, I'm
No.
not missing something here, am I?
No, and this, the fundamental fairness is that, putting it bluntly, people on low incomes are paying a disproportionate amount of the tax.
Mm.
And
that's for both the ESL and the stamp duty in New South Wales, anyway.
Yeah. And Tasmania, yeah.
Okay. Thank you. Thanks for clearing that up. And then I think you mentioned in your submission as well that in the last financial year, 24-25, state governments collected, I think, $8.9 billion in insurance taxes, which is more than industry profits as measured by APRA. Is that right? So the state government taxes, and that's excluding the GST, which is a federal tax, the state's taking more out of the this insurance market than insurers are as profit. Okay. And that's APRA figures, is that right?
Yeah.
Okay.
Yep.
Okay. We were.
If you were to eliminate the profit margin, and premium would come down about 5%. If you take out taxes, the starting point is 20% reduction.
Yeah. Okay.
I mean, it there is. It feels like it's become out of balance, and I feel like, particularly when it comes to home and contents, if we're serious about climate mitigation in this country, we need to be not punishing people for taking out protection with their properties, and that's our problem.
Yeah, well, and I think the figure you mentioned before, where the prevalence of underinsurance in New South Wales is roughly double that across the border, and the only sort of explicable factor that at work there is the burden that the insurance levy adds on. Thank you for that. I wanted to touch on sort of tort reform and psychological injury claims, because you mentioned it as one of your key recommendations to this committee was to recommend a national review of civil liability settings. What I understood from reading your submissions was that psychological injury claims are firstly significantly more expensive than physical injury claims. I guess this is in a workplace compensation setting, but also perhaps civil liability, and that the prevalence of those claims as the sort of overall share of claims is growing. Is that right?
Yeah.
Have you got figures that you could help provide to illustrate that?
Yeah, so in terms of the workers' compensation schemes, what we see is quite a significant increase in psychological compensation claims flowing through those schemes. And we've seen some jurisdictions have to make amendments to their schemes to address that increase in psychological claims, basically in order to keep the schemes sustainable.
Have we got any numbers around this?
So in terms of the workers' comp, what we see when someone makes a psychological injury claim, their average time off work is about 31 weeks, as opposed to approximately 6 weeks for a physical injury claim. And mental injury claims cost, on average, about 3 times that of a physical injury claim. So they're much more complicated to diagnose and address, and the return to work prospects for people who are off work from a psychological injury claim are much less than for a physical injury claim. So they're much harder to get people back to work and back contributing to the community. So the impact of them is quite significant. We do know that about 22% of Australians experienced a mental disorder in the past year. So this is not unique to workers' compensation schemes. We're seeing an increase in mental ill health across the community, and it does need to be addressed holistically, but it's having an impact on a number of different insurance lines. Yeah.
I think I read a figure that in Victoria it's now 16% of all workers' compensation claims are for psychological injury. Is that
I'd need to double check that that's still accurate. So Victoria made some amendments to their workers' compensation scheme in the last couple of years to try and address that growth in psychological injury claims. But we can certainly take that on notice for a hard number.
But as just a general trend, you're seeing psychological injury claims grow as a share of overall workplace compensation claims.
And we're seeing that in workers' compensation, but you also see that in the life insurance space as well. The number of total permanent disability claims has increased as well from mental causes.
Okay. And then if we were to recommend a national review of civil liability settings, I mean, what would such a review encompass, and how would it help address the affordability of business insurance? What's the chain of causation there?
I mean, I think probably one of the things the review would look to do is how do you, and you know, from a parliamentarian policymaker point of view as well, how do you establish something, a body of some description that can keep in review and keep in check what compensation payments really should look like and what they should be, and make sure that that's an independent process. We already do that. So for traffic accidents in New South Wales, there's a commission here that determines, you know, what you will get paid for whatever terrible injury you get from
loss of limbs. Yeah, exactly.
I mean, there probably needs to be, at the end of the day, boundaries that an independent body can set that I think enables employers in particular and insurers trying to underwrite this, including state government.
Play a role in that? Well, do we play a role in that?
As federal?
Yeah.
So in terms of civil liability settings, they are subject to state jurisdiction. What we saw when the IP review was rolled out was a federal review, and there were some recommendations around harmonisation across the states, and unfortunately that didn't happen.
This is a permanent,
the nature of the federal
issue,
system,
right?
And in insurance, it's across everything. You know, as an Australian, it all depends where you live in terms of your insurance outcomes driven by federation issues.
And workers' comp is very similar. There's different state schemes in each of the states and territories and a couple of federal schemes as well. So there would be value, we believe, in the federal government leading a review of civil liability settings, particularly with a view to ensuring that there's greater harmonisation across the states and territories. So it would obviously need to be done in partnership with those states and territories, but some standard reforms that could be rolled out across all jurisdictions in Australia would be very beneficial.
So, what are the big drivers of growth in civil liability compensation claims that a review would seek to address and stem, and so stem the growth in insurance? I mean, what is it? The psychological injuries claim on putting a quantum or a boundary, as my colleague suggested around
So that's partly it. Partly we've seen, as Mr Hall referred to in his opening statement, the social inflation increase in terms of the amounts that are being paid to people, and the friction costs as well. I think our colleagues from IAG were discussing this earlier, that only a certain proportion of the capital that they're holding to pay future claims is earmarked for the injured party, and there's quite a significant proportion of that amount that they're holding that will go to legal fees and other costs involved in processing and settling a claim. So there's opportunities to put a lid on the costs that are going alongside these, particularly where, you know, occasionally we do see instances where the payment made to the injured party is less than the costs that have gone alongside of getting those payments. So we think there's some opportunities to tighten up there as well.
And have you seen any, this is my last question, Chair, just comparable reviews of civil liability settings in sort of benchmark jurisdictions in the last 10 or 15 years that you think are worth exploring? You know, Canada, New Zealand, the United Kingdom, United States? Or...
I'd have to take that away and have a look at it, Senator, but the one thing I would say is that we've had reinsurers tell us that they view Australia now as the most litigious market in the world. If we think that we're less litigious than the United States, we're wrong.
Okay.
They're measuring that not just through the growth of the cost of claims, but the fact that there's now a very active litigation funding market here. It's an industry unto itself, and you know, they've said to us, Australia needs to get on top of this because you are taking the global crown for uncapped increasing payouts.
Okay, thank you. That's sobering but helpful to hear.
Thank you, Chair. Thank you for your evidence today. So many questions, and we've actually pretty well run out of time. So we've got our next witnesses waiting to come on. I just wanted to indicate that there will be certainly questions on notice from me, and that this is our preliminary set of hearings. We may have further questions and want to get you back later in the process. But can I ask you to consider the data gaps that are in the public place? I'm heartened by the conversations that you're having with the government and the leadership that's there with regard to the hazards insurance and trying to figure out what's going on. And I understand the confidentiality of some of the information, but it's frustrating for us looking at policy making where we can't get data. Like it's not available. It's also not available to small businesses or even the entities that represent small businesses. So there's a lot of opacity really around what's going on, where the contributors are at any point of time, and in that there's potential for, you know, aberrant behaviours to fester and to continue in certain parts of the sector. One of the data points that we don't have is real clarity about the relationship that's been asserted very, very frequently about the rising costs attributable to what you finally just described as overly litigious activity. I mean, litigation's happening because things are going wrong.
Correct.
Right? So there's a down the food chain thing is also a moment in history where we're coming to terms with the fact that mental injury is something we've ignored historically, and we're finding our feet in a new world where we are committed to managing that risk, right? So we've got a couple of historical things going on. Could I ask you to look at the submission from Conrad Liveris, which I think does raise a whole load of questions about implied causality without any evidence base, which is a dangerous way to be making policy, frankly. So if you could address in specific terms the recommendations that are, and more general, the other assertions that are in there, I think it's in the public interest that we get to the heart and the truth about where the drivers are. One question you might be able to answer for me, though, before you go, is you've talked about the inefficiency of the state-based charges and taxes, and we know that there's some change happening in New South Wales, perhaps not in Tasmania, around the emergency services levy. But $8.9 billion. What's the insurance sector's, plan for the replacement of that critical revenue for the proper functioning of our states and territories?
Senator, I completely agree. I've said that I know that the states are cash strapped. I know that this is now a significant revenue source for them, but even understanding the need for revenue, the question's got to be, are we taxing the right people the right way? And I think that that's a political debate for others to have. Some states have gone for more broad-based, property-based style taxes.
Yeah, and you mentioned the ACT.
The
ACT, like you've talked about regional New South Wales a lot in your evidence today, there's no way people out there can have a rate increase and cope.
No.
Right?
And yep.
What work is being done? What capacity has the insurance as part of the whole economy able to play in thinking about how some of those costs might be supported by other parts of industry, not just property owners?
But I also think too, though, my point is that accepting that the nirvana of a low tax world is not going to necessarily be a realistic achievement in a country where we run good schools and hospitals and roads and all that sort of thing. I understand all that. At the very least, and particularly from the Commonwealth Government's perspective, more of that money from the states are getting, they're getting a lot, should be going back into mitigation, and it just hasn't been. Queensland's probably the best because it's had to be 60% of all disasters happen in Queensland. But there are states that are way, way, way behind in doing anything on mitigation. And I think, the industry's preference would be, well, if you can't reduce it or reform it, the bill eventually lands on the Commonwealth's desk. When there's a disaster and it ticks over a certain amount of money, it all comes over to you and you pick up the bill. I'm not an expert in Commonwealth federal fiscal arrangements, and I probably hope never to be, but someone cleverer than me in Treasury should be thinking about there must be ways of levering the states to put more of this money into building a flood levy around Taree, Bundaberg, Kempsey. There, all those towns that keep getting flooded and have very high insurance premiums and are paying a lot in taxes.
I look forward to your responses to questions on notice, particularly the ones that I wanted to ask, but there's so much interest here from the committee. Thank you. We will, if possible, have answers back by the 29th of May to our questions on notice. Thank you.
Thank you.
I now invite representatives of the National Insurance Brokers Association to come forward. Thank you for joining us today. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacities in which you appear today? Let's start with Mr Marchand.
Benjamin Marchand, I'm the Policy and Advocacy Lead at NIBA.
Richard Clippen, CEO of NIBA.
Nicholas Cook, President of NIBA.
Rebecca Wilson, Vice President of NIBA.
Thank you. I now invite you to make some opening remarks. It looks like Mr Clippen with the paper there, you're going to lead off. And following that, there'll be questions from the members and senators.
Thank you, Chair, and good afternoon, everybody. Thanks for the opportunity to appear before the committee today on this important inquiry. As you've heard, my name is Richard Clippen. I'm joined by my colleagues. We'll be your witnesses for the next session. NIBA is the professional body that represents Australia's general insurance broking profession. We serve as the collective voice of more than 380 member firms, over 14,000 individual brokers across big multinational brokers, broker networks, as well as small to medium businesses operating the length and breadth of this country. In financial year 2025, our members advised on approximately $35 billion of gross written premium and this is currently growing at 6% over the last decade, underscoring the central role that brokers play in helping clients and businesses navigate complex insurance markets and products. Our sector research shows the diversity in the sector, with women representing 40% of the broking market and men at 53%. 70% of brokers are aged 50 and under, indicating a stable, diverse and inclusive workforce with a lot of flexible opportunities and engagement across the profession. Insurance brokers are licensed financial services professionals and trusted risk advisors who act on behalf of their clients. Our members operate under the Corps Act, hold Australian financial services licences regulated by ASIC, maintain professional indemnity cover under RG 216 and subscribe to the Insurance Brokers Code of Practice. Recently, NIBA released some research called Ready or Reacting, setting a decisive agenda for the decade ahead. The report identified eight key disruptive forces and their impact. The big three were around technology and automation, picking up the AI themes, regulation and regulatory demands, and the new and complex risk landscape. Australian small businesses and not-for-profits today operating in this kind of environment of rising complexity, cyber threats, intensifying natural catastrophes, evolving global risks and escalating regulatory obligations. Access to professional insurance and risk advice in this environment is essential. The evidence around broker value for clients is loud and clear. NIBA's recent client research surveyed more than 400 businesses across Australia. The key findings would be illustrative for this inquiry are that brokers help clients navigate and advise on complex risk markets and source appropriate products and services. Brokers save their clients time, around 20-odd hours of administrative time and 63% of claims handling time compared to going direct. 95% of broker clients see their broker as critical to their claims resolution issues, and 98% of broker-supported claims are successfully resolved. This is reflective then of the less than 3% of AFCA complaints that over the last 5 years have related to brokers. Finally, the client voice that provides the evidence base for this conversation. This is the evidence. And when small businesses and not-for-profits have access to brokers, they receive better advice, more appropriate coverage, superior claims outcomes and greater confidence in the protection of their assets and their livelihoods. NIBA's submission to the committee sets out 12 recommendations across 3 themes, focused around, number 1, improving access to professional insurance advice, 2, harmonising state-based insurance regulation and taxes, and 3, addressing sector-specific challenges. We welcome this inquiry and commend the committee for engaging with these critical issues, and we look forward to discussing this in a bit more detail and happy to answer any questions.
Thank you very much, Mr Clippin, and thank you for your submission. I'm going to go first to Ms Jarrett for some questions.
Thank you for being here this afternoon. We heard a number of things in terms of the role that the brokers are playing in the insurance industry, and it's all been very positive in the sense that the role of the brokers gives access to clients, whether they be small business in our case, and that seems to be working well. 2 questions though. Specialist brokers has come up, and the importance of specialist brokers, especially where in high-risk sectors where we're seeing either insurance unavailable or insurance costs being extremely high, and the brokers have been, from what we're hearing, have played a positive role in helping the insurers understand the risks and, more importantly, the risk mitigation efforts of the group or the person who wants to be insured. Now, is that a standard practice? Is that an evolving practice?
That's at the heart of what a broker does, acting on behalf of the client. And they may be everything from that newsagent to some of the examples you've heard over the last couple of days, including tattooists, tobacconists, etc. So a broker is the one who will sit with the client, understand where their exposures are, what are they looking to cover by way of an insurance solution, and then start to talk to them about what risk mitigants they could put in place or they have in place, and then go to the markets
to identify a solution that fits those needs. Now, it could be a segment base in respect to a tattoo parlour or a tobacconist, or it could be more broad-based. But the broker is acting on behalf of the client's desire to move that risk off their balance sheet to an insurance solution, and that's really at the heart of what they do, is they will then go to those markets, be they local markets like QBE or IAG, or indeed overseas markets such as Lloyd's, or through another instrument that's been spoken a little bit about over the last couple of days, an underwriting agency.
If you were to look at specialisation though, specifically, you will see there's many different ways that specialisation can look. So you might have an insurance broker that purely does construction insurance. That's all that they want to specialise on. It's technical, it's tricky, and then they may refer the motor fleet that's attached to that business to a general broker. On the flip side, you might have a general insurance broker that will do all the things that Nick just talked about, but may have 40 brokers and 5 that specialise in certain industries or occupations. So you can get a combination of both, or you can have a specialist broker. There's quite a number of specialist brokers, but there's probably more general brokers that have specialised people within their office.
So I'm assuming the broker community knows that. What I'm getting the impression, though, is if I'm a small business and I need a specialist, A, I don't know that there's such a thing, and B, who do I go to? So I see that as a bit of a gap. Is that how does it work? Can they advertise that they're a specialist broker?
They can. A lot of brokers will be in contact with different associations. So for my own business, not that we want to get too anecdotal, we specialise in disability services, not for profit. So we're constantly in contact with NDIS and other associations. So usually the attached association would recommend an insurance broker, but I think to your point, it's very valid that we could do more around promoting specialisation.
Just before you go to expanding on that answer, Mr. Cook, do you pay to advertise in those through those associations, or do they expect some payment from you if you get work through that association? Like, what is there a financial arrangement?
There can be, yes,
Okay.
and it does vary. So
what would it look like, ranges from this to that?
Look, in some cases it could be, especially in not-for-profit disability services, it could be that we will commit to sponsoring your swimming carnival or whatever it may be to assist the organisation back, or it could be that there is what we call a sub-agent pay-away, which means we might have an arrangement with an association or a referral partner. That arrangement doesn't come at an additional cost to the client. That comes at reduced financial remuneration for us as the broker.
Okay, so can you give me like the quantum of a recent one that you've done, just so I get a sense of the scale of this?
So we've got one association where we would pay 20% of the earnings that we make. So it's not adding 20% on to what we make to pay them. We reduce our income to pay the association.
Okay. And the 20% is, what's your relationship with the insurer?
So that can vary as well.
Yep.
So depending on whether the insurer specialises, so you might have a motor trade scheme, and there's probably 5 insurers that do motor trade. There's probably 3 that do it well.
And who are they?
Allianz, 360 Underwriting and Vero.
Okay.
So
you go to them?
We would go to them, but in certain cases. So if I had a diesel mechanic, I go to 360 Underwriting.
Okay.
Because they work on trucks that go underground in the mines. There's an underground mining exclusion on Allianz's policy, on Vero's policy. So we can quantify, do you go underground on the mines? Yes, then it's got to be 360. Do you not go underground in the mines? no, we don't, great, we can go to the markets that we choose. So we've got to understand the policy wording, not just the pricing of what risk the insurer is going to accept.
Okay. And how much would you make out of brokering this arrangement?
Look, it depends. I mean, we could earn, if we're dealing with, like, we've got a large diesel mechanic group of clients, or when I say group of clients, they're 4 mechanics that are related workshops.
Yep.
We would earn $40,000 a year off them, keeping in mind that one's in Tamworth, one's in Goondiwindi, one's in Toowoomba, and one's in Dalby.
Yep.
And they all get a visit from us every year.
Yep.
We attend their board meeting every year, and then we represent their risks. Given the type of work they do have claims.
Yeah.
So we spend a lot of time on their claims as well.
Okay. And the relationship with the insurer, like how much do you pay? How much are they being paid?
With that particular client, $250, $280. I might have to take notice on that, but it'd be around that mark.
Because we've got no visibility of any of the numbers.
Yeah.
Right? So when you're talking in generalities, you already got context in your head. For us, like, we're literally flying blind in terms of the information. So to get the quantum is actually probably really important for us without, disclosing anything that's commercially in confidence.
Oh, absolutely.
But we need some shape and form for the realities of who gets what money, what are relationships happen, what are the fiduciary responsibilities, what are the ethical dispositions that you're required to hold, how does that interact with RG 216, have there been any insurance brokers that have been caught up in the code of practice? We need some detail.
Yeah, sure.
Sense of what's going on there. Back to you. Thanks.
I also was interested to, given that you are talking to insurers all the time, that is your job, where do they start in terms of the risks? So you walk in and are you always starting with the risk up here and you're having to bring them down and show them the risk mitigation activities, or is it always more moderate? I know that's a very general question, but this whole pricing of the risk is something that we can't really get our heads around how it works. But I guess an understanding of the relativity, therefore, in terms of the starting point to where you end up might give us an indication.
So for an uncomplicated SME risk, there is generally an automated solution in place.
Okay.
Now, that automated solution would have the broker, just because of the volume that goes through in SMEs, that automated solution would have the broker putting in a data set, which would be in response to a number of questions the underwriter, insurer, has set. Yep. And then that automated data set would go to a number of insurers, and an automated response, either a quote, a decline, or a quote with conditions, would be returned.
Or a referral.
Yeah, or referral to the underwriter. And based on that, the broker then makes a choice based on the wording, the insurer, their claims paying history and service, and whether that fits the client's actual requirements. And based on that, that's done. But then ratcheting up the complexity, and to your question, it then becomes a more individual conversation then with the insurer, where it's not an automated solution in every case, where it is sitting down with them, describing the client, describing the risk, describing the risk mitigants they've got in place, the occupation they're doing, whether they're exporting to the US, whatever they might be doing. And based on that whole range of criteria, the insurer or underwriter makes a response to that, which would be, once again, quote, decline, or endorsement.
And it probably is an unfair question to ask, but I will ask it. And when you start those discussions, are you starting when you walk in that door and you've got your quote, is the risk up here and you're constantly bringing it down, or is it generally Like, are we talking little differences between what you do, what the brokers do in terms of the cost of that risk, or are we talking big differences at the end of the day?
Broker will always be acting on the client's behalf,
Yep.
and if it's felt that premium or those terms, indeed, to Beck's point around what's in the actual terms and wording, if they're not appropriate, the broker will work with the insurer, but if they can't get to what they feel that is suitable for the client, they'll move to another insurer.
If you were looking at a client, whether it be a small business or a larger business that had complexities to it, so going to your question, say we look at a not-for-profit and we say we want to go and get the liability cover for the not-for-profit, we wouldn't just go with the financial information and ask for the limit of liability and a business description. We may say, here are their safety policies, here are their business hours, here are their opening hours, here's their protections.
So starting off as a discussion.
So you're starting off with
okay.
The whole story.
And then, so you'll bring that together as one, and then inherently, if there are some complexities to the risk, different insurers will ask different questions. They'll have different ways of underwriting. So you might have insurer A here say, I want the addendum to that safety policy. Insurer B may say, I want addendum C to the privacy policy. So you do have a lot of backwards and forwards with the client. And that's very similar with the technology platforms that Nick was talking about. When we get, whilst they're technology generated, they also come back with different endorsements, so changes to the cover or exclusions by insurer. So we have to look at the conditions as well.
Mm-hmm.
Another important conversation that we'd have with the client, putting in simple terms, if insurer A's premium came back at $1,000 and insurer B's premium came back at $1,030, insurer B, his claims performance is so much better than insurer A. We try and get insurer B to get down, but if we can't, we would still say to the client, here's your option, but this one's performing.
And in the small business sector, how many are fully automated? How many claims would go through fully automated, do you think?
Not so much the claims.
Oh, not claims, sorry, the policy, sorry, the policy, my mistake,
I would say in micro SME, like mums and dads style of business, 95%.
95%, so we're
That's
talking...
ever increasing.
Yep, okay.
As technology gets better.
Okay. In interest of time, I'll move on, let you move on.
Thank you very much. Could I just ask, from the broker's frontline experience, how well is the current insurance market actually working for small businesses day to day, rather than in theory? And if in that answer, could you respond to the market hotspots that I've been restating over the course of the last couple of days from Finity Consulting, which include worker-to-worker, US exposures, PFAS, music venues, parks, active recreation, religious and educational, agricultural, chemicals, scaffolding and trade contracting.
Beck, we can both speak to that, I think.
Yeah. Start with worker to worker.
Yeah, absolutely.
So worker to worker is a major issue in the labour hire sector, because if it's a labour hire employee, they go back, lodge a workers' comp claim because they're employed by the labour hire company. Then the workers' comp insurer says to the company that's hired the labour, you are liable for this, we're going to recover our workers' comp costs out of your liability policy. So there's now issues with worker to worker in the sense of either the insurers they'll exclude it, so they won't insure worker to worker, or they will put a very large worker to worker excess on the policy. And that could be 50,000, 100,000, 150,000. I think the highest I've seen is 200,000.
And in what sector is that?
That's predominantly in a lot of the time, and I don't like to use this term, but just to be more holistic, more the blue collar style sector. So it could be construction sector, or not necessarily trades, but boilermaker. Or
okay. So we've got a boilermaker who is directly employed.
Yep.
And then we've got a boilermaker who's coming in as a labour hire boilermaker.
Mm-hmm.
What's the insurance for the one who's directly hired? Are there any problems in that market?
No. Because they're protected under the workers' comp of their own employer.
Yep.
so it doesn't connect to the liability policy.
So what's going on in the worker-to-worker area with this particular problem you've just described is a cost-shifting event.
Absolutely.
It's a recovery event.
It's a cost recovery.
Yeah.
And it's pretty outrageous, really. And the reality is that company is banking a saving, and people are paying literally with their life or a significant injury, and then the cost of all that, instead of being borne by the person who created the context of risk, is being borne on the public purse. So this is another reason why labour hire is a very significant problem for this country.
Very much so.
Right. Okay, well, thank you for making that clear. Is there any appetite to cover this off?
There is, but at a cost and the excess.
Okay.
It was a bit like what Andrew said before. We can insure pretty much anything, but it's at a price.
Yes, that's right.
Okay. If you could give me any further information on the other areas that I've mentioned, that would be great. But moving along, because we haven't got a whole lot of time, NABER distinguishes between insurance that's available and insurance that's unaffordable. How widespread is the issue of cover being technically available but functionally unusable by small business? Is this a big or a small problem?
Richard?
Yeah, can you be a bit more specific, Senator?
Well, I guess it's got an extension of what we're just discussing.
Yeah.
So technically, cover's available. Practically, it's unaffordable. What's the scale of this problem?
I don't think it's a large-scale problem.
Okay.
I don't think it's a large-scale problem. The affordability and availability piece is usually around the occupation.
Okay.
So if you were to look at it right now, like across the country, I can still insure a tobacconist, but I'm not insuring it in Australia. I'm insuring it in London, and the minimum premium is $30,000. So,
bouncing off that to tattooists, perhaps you heard yesterday's. So the evidence, if I can summarise it, so we might be in agreement about what's being discussed, is conditions in 2012, perhaps somewhat similar to the challenges in the tobacconist market now, have dissipated over that period of time. There's been regulatory change, there's been changes to practice. Now at 2026, the pricing is still reflecting the risk assessed in 2012 and hasn't caught up to the current situation. And there's complications with regard to strata title and the impacts in that space. What's going on with tattooists, and why isn't there a market response to that based on the evidence we received yesterday? Like, it's a burgeoning response, but 14 years, it's pretty slow.
I couldn't I don't have any tattooists as clients, not for any reason. We just don't have any. But what I would think could be a problem is the types of cover they're looking for. So if they had a liability policy that is pure liability, there could be a treatment risk cover that goes with it, and that could be for infectious contagious diseases or anything that goes outside of, hey, I tripped over in your store, to the actual treatment that's, when I say treatment, the actioning that's occurred. There may be policies that would cover one part of it but not the other, but I would think it's probably, I don't think tattooists would have such a reputational issue like they may have previously, but it's more the activity of what they're doing on people's bodies, essentially.
Hearing the proceedings yesterday, I did my own little piece of research. I could find across our business there are at least 8 of our member brokers who are specialising or had solutions for the tattoo industry.
Okay. And how much business of the sector are they writing?
Oh, I didn't go that far.
Yeah.
It was more just whether there was any sign of market failure, and certainly when I saw at least 8 options, it's certainly not to our network or our business.
Okay. Any further information?
Yeah, we're absolutely
that'd be
happy
interesting.
to.
Wonderful.
Senator, I think just to Ms. Jarrett's question, I mean, I think there's pretty much a product available, and we heard earlier, or you heard earlier from Mr. Hill, There's depth in markets, there's competition, there's availability, there's a lot of innovation going on. The question that we as a sector need to answer is, so how do small businesses actually access brokers who can actually find the cover that they want? Because for a lot of small businesses, if you're opening up your first little shop or your first business, you jump online and you go, I need insurance. You can either go and deal direct with insurers, or you can find your way to a broker, and then your question is, so which is the right one, and who's a specialist in my particular area? And I think there's some work across the sector that we need to do, because the evidence is clear. When you use a broker, you will find cover and you will find the right market, and there will be someone who will ask you the sort of questions that Nick and Beck have asked in terms of how complex are the needs and what are the risks here, and then they'll go find a solution.
Can I just take you to theme 2 of your summary of recommendations? Recs 2, 3 and 4. You suggest a regulatory impact review specific to general insurance broking to right-size compliance obligations, and assert the current framework was designed for investment advice and imposes disproportionate costs on broking clients without commensurate consumer benefit. What's happening in that space, and why does that?
I might ask you to take that one.
The Corporations Act sets the regulatory requirements around when you provide a recommendation on a financial product.
Yes.
And general insurance products are obviously financial products.
Yep.
And those settings have been increased over the last 25 years following everything that's happened in the financial advice sector.
Yep.
To significantly increase the regulatory burden on brokers providing advice around general insurance. From the perspective around the complexity of the products, the financial risk around those products versus the benefit you get from being insured, those regulatory settings don't feel that they're at the right level of balance for general insurance brokers.
Can you, on notice, provide an example of what it would need to look like in a way that doesn't actually reduce protections from dodgy operators who exist in every sector, right? So you're all lovely people, and I'm sure most brokers are fantastic, but there will always be the scammer, there will always be the dodgy one, and that is why we end up with the regulations we end up, because, somebody starts it, another one sees it, another one goes, oh, there's a bit of profit being made. We've just been talking about the labour hire, right? People are talking about these atrocious business models. They don't care about the consequences, just about the money. So what would a fit-for-purpose regulatory setting to improve access to insurance, to engender a little more competition, etc., look in a way that would prevent a fraudulent and unethical, not fit for business operation person to work properly for the country?
Yeah, absolutely. And I think that is a big question, and something that we might need to do a bit of work on, given the notice period. So
yeah, look, if you need an extension to do some sort of research work there, I'm sure that we can accommodate that.
But what I would point to is the number of disclosure documents that need to be provided to a small business owner around the services the broker is providing, the policies, the PDSs, the statements of advice. There is a large amount of paperwork that needs to go to the small business client who just wants the right level.
And they won't read it.
And they,
I mean, I just know this. They're not going to read it. Most of them are not going to read it.
And so is that fit for purpose?
Yeah.
That's adding a lot of cost and red tape to the process that the brokers are going through. And
but the protections that it was created to resolve need to remain in place. So what does a fit-for-purpose 2025 to 2040 version, or maybe 2030 is more realistic, because things are changing so quickly. What does it look like? Thank you.
Just to contextualise that, the current regulatory documents that we leave with a client, an SME, would run to 30 to 40 pages, and the standard business insurance policy, or PDS, that we would leave with the client that runs to around 160 pages. So we're actually...
In plain English, so it's easy to understand.
We're leaving our clients behind rather than bringing them on the journey with us.
Yeah, okay. So the problem was fixed that way.
Yeah.
You're saying it's not fit for purpose. How does the problem? How is the problem addressed in a way that is fit for purpose, that engenders more competition and better clarity and more protection, not less protection? Number 3, requiring impact assessments for advice access reforms before any reform affecting insurance distribution. Policy changes have to be evaluated for their effect on consumer access to professional advice, not just their administrative intent. I guess it's kind of in the same space.
Yeah.
So, you know,
there's no. I mean, we are very strong believers in strong consumer regulations and outcome. We represent the consumer in the transaction, but the pragmatics of how do you actually get a system to work effectively and efficiently? Because in the end, what these layers end up is just cost, and in the end, that cost gets borne ultimately by consumers. So, yeah, less friction, more effective, and easier for customers to understand is kind of where we're heading, and that plain English piece, Senator, is spot
in Break
on.
for us the same sort of thing, isn't it? Yeah. Okay. All right. Now, I love Christmas, and I still believe in Santa, but I'm not sure I believe in national harmonisation as a task that can easily be delivered as much as it's been requested here. In the absence of national harmonisation, what needs to happen to reduce the costs to small business of accessing insurance?
So the harmonisation conversation is broad, but specifically around workers' comp, because obviously we're in a lot of different jurisdictions. Everyone's got their own game plan. We spend a lot of time talking to colleagues in Western Australia, really effective, high-functioning scheme. That's not the case all over the country, and we're trying to work with local, for example, in New South Wales, local jurisdiction to try and make sure that it actually is fit for purpose and works. Beck's got a great example. That's part of her core business is working in the workers' comp space. So the harmonisation piece is we kind of get that we're in a state environment. Maybe it is wanting Santa to come early, but we totally want to ensure that the sort of things that brokers will face day in, day out. Imagine a business that operates right across the country. Well, they're operating in multi-jurisdictions for the same policy, for the same employees on the same rate, but you can see the complexity that would play into that. So that's kind of the framing that we were coming from.
Okay.
Sorry, Chair.
Okay, I was trying to figure out where that noise was coming from, Mr. Marchand.
You noted before the 8.9 billion in state taxes. There is a variation across borders if you're a small business operating on one side of the border versus the other of taxes that range from 9 to 40%, depending on which side you're getting the policy. So those state taxes are having variability depending on which state you insure in. Case in point, the New South Wales ESL, one of our members, shared feedback with us that getting a policy in one state versus New South Wales, there was a 70% price difference for the same policy just based on the taxes and stamp duties.
Can I just go to the tort reform options that keep getting put forward, and state once again that the assertion about causal links is constantly being put, but I don't know if I've seen any detailed figures. What's happening in the broker sector? Are there really significant increases in litigation and payouts that are impacting on your business?
Yeah, that is reflected generally following on from Mr. Hall in the previous testimony. Brokers, their clients are obviously experiencing that they're the ones that are being exposed to this litigation. That's having an impost on their liability, their casualty policies, and the cost therefore goes up.
How much of it is mental health challenges, or is it a range?
Increasing number.
Okay. And what are you recommending to the different sectors in terms of mitigation of that risk? Because, the claims are being made because injury is being done. They're being awarded because injury has been noted. Right, the quantum might be an issue, but that's also supposed to serve as a disincentive. So I'm kind of not going to let it just all be all bad. It's all about this litigation, right? There's a reason it's happening. What needs to change in the ecosystem to make it both affordable, operate in a sort of preventative way?
It's a really difficult one to answer. So within the workers' comp space, and I know we're talking about liability, but if you compare the two, in the workers' comp space in New South Wales, it's very much managed at a no-fault system. So if you say you've broken your fingernail at work, you've broken your fingernail at work. And why I say that is you could be someone that's a 10-year-old, 15-year-old that has had anxiety, and you can get to the age of 30, you're being performance managed at work, and that causes your anxiety to flare up.
Yep.
So in the workers' comp space, they say, I've got anxiety because I've been performance managed, and that's not fair. And it's automatically accepted in the workers' comp space. But the same scenario can apply with mental health claims in the casualty space. And I don't want to sound callous or non-caring when I say this, but there's so much argument between what caused a mental health issue, whether it be workers' comp or a liability claim that's caused a mental health issue, that the insurers are saying, well, I'm not just going to settle it. And the plaintiff's saying, well, you've caused a psychological injury. Where do we get to the point where it's either a claim that's accepted or a claim that's denied? Now, the point with the legal panel side of things is that they have panel rates. The insurers have panel rates. They're not paying the same hourly rate to a lawyer that you or I would pay, but there is still more claims going through because they're either being denied and challenged, or they're paying for a mediator to begin with to find out what happened. And they're looking at investigation costs, they're looking at medical costs, they're looking at legal costs. It's all inflammatory. It all keeps going with the claim. And
these are the friction costs that you've been referring to?
Yeah. Or indeed being settled before going to court, just to get it out of the way. But it's a claims cost all the same.
Mm. So what would need to happen to make that work better? Can I leave that with you as a question on notice? And what brokers have got to say about that? Some examples would be good to sort of flesh out what's going on there. Can I also ask you, as I've asked a number of others, to have a look at the Conrad Liveris submission? They make a number of recommendations. I'd like you to give your response to those, but more generally also to the submission itself, which hopefully will start to shine a little bit of light and we can get some facts on the record rather than the finger pointing of it's not me, it's them, it's the state, it's this, etc. You know, brokers are making too much money. Like, we need to get some data, and if I can just ask, where would data need to go to allow proper policy observance and policy making going forward? Because, you know, we can't rely on committees like this to be stood up to clean up messes over years. I mean, like, we're at this point, there's something not working right for small businesses. If we were to prevent problems festering, and to improve productivity and profitability for our small businesses, who needs to hold what information, what powers do they need to have, and, you know, is the current structure right? How do we get data that we need without further regulatory burden?
Understood.
Small questions.
Yeah.
Yeah. One final question, Chair.
Yes, please.
Just very quickly, one of the previous witnesses mentioned something along the lines of a broker being providing a quote but was unable to set the business, so it went through another broker and another broker. I think there was an example of it touched 3 different brokers' hands. And I was left the opinion that everyone clicked the ticket. Does that happen? there's only one commission paid, isn't there? Or how does?
Yeah, yes, that's correct. I'm not familiar with that.
No,
Scenario.
it was back at an earlier evidence,
But,
and I just thought you guys would be the body I could check it with.
That could be if we're going to.
Might have been the tobacco,
so like with the
tattoo.
tobacconist.
Yeah, tobacco or the tattoos.
So we would send the tobacconist over to our London counterparts. Let's say, for argument's sake, they get 15% commission. They may say, we're going to take 10 and we're going to give you
So it's the
5.
same rate.
So it's the same rate. It's just the way that it's dispersed.
Yeah, thank you.
And that would be the same from a generalist to broker to a specialist broker, one rate dispersed.
Yeah,
absolutely.
Okay, thank you.
Do you remember what it was, Senator? What that issue was? Who raised that issue with us? Doesn't matter. Anyway, you've answered the question.
Yeah.
You've answered the
Yes,
question.
I think it was.
One
It was
they
the
can
outdoor
cut it any way they want.
Yeah, Miss Laurie Mode.
Yeah.
It wouldn't be grossing up as it goes through.
Okay, yeah, no. One commission, cut it whichever way you want. Good. Copy.
Great. Thank you very much. Appreciate your evidence. And if you could provide responses to questions I noticed by Friday, the 29th of May, that'd be great. But negotiate extensions with the Secretariat for any further work that you're doing as a result of your visiting to the inquiry today. Thank you. Thank you. That concludes this session, and the committee will suspend until, let's say, 3:10. Enough time for everybody to have a little break. Australian Lawyers Alliance. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full names and the capacities in which you appear today?
Ian Murray, it's my privilege to be the National President of the Australian Lawyers Alliance.
Michelle Margalit, National President-elect of the Australian Lawyers Alliance.
I'm Andrew Stone. I'm a barrister from Sydney. I'm a former National President.
Wonderful. And we have a couple of witnesses on the telephone line. Two plates. Mr. Conrad Liveris.
Yes, my name's Conrad Liveris, and I'm here as an economist that was engaged by ALA for their submission.
Thank you very much. I now invite you to make a short opening statement, and the conclusion of your remarks, I will invite members and senators to ask questions.
Thank you, Chair.
Mr. Murray.
Chair and members of the committee, thank you for the opportunity to appear today. I'd like to start by acknowledging the Gadigal people of the Eora Nation, to the traditional custodians of this land. I pay my respects to their elders, both past and present, and also to all Aboriginal and Torres Strait Islander peoples here today or listening online. The Australian Lawyers Alliance represents more than 1,500 legal practitioners, academics and students nationwide who act every day for injured Australians and their families. Through that work, we see firsthand how insurance markets and compensation systems operate not just in theory but in practice. We see how policy settings affect real people, often at the most difficult time of their lives. We strongly support the objective of this inquiry to ensure that small businesses, not-for-profits and community organisations can obtain insurance that is genuinely affordable and appropriate. We recognise the cost pressures facing small businesses, and we understand the concerns being raised. Insurance plays a vital role in supporting a resilient and vibrant business community sector by helping organisations manage their financial liabilities. It also promotes responsible business practices by encouraging strong risk management and good corporate behaviour. Insurance is not just another business cost. It is a critical mechanism that protects injured people, underpins community activity, and prevents the cost of negligence being shifted onto families and governments. Our central message today is one of caution. There is no evidence on the public record to support claims that litigation or compensation costs are the primary drivers of insurance premium rises. The evidence instead points to a far more complex picture. Global reinsurance markets, insurer capital settings, market concentration, climate risk modelling and inflationary pressures all play a substantial role in insurance pricing and availability. Previous waves of civil liability reform shifted costs away from insurers and onto injured people, their families, Medicare, the NDIS and Centrelink. Once rights are removed, those consequences are difficult to reverse. We do not argue that the current system is perfect. It can and should be improved. However, better information on the true drivers of costs is required before making changes to insurance settings. This means better data transparency and regulator-verified breakdowns of premium movements. The Australian Lawyers Alliance supports sensible reform to claims handling and pre-litigation processes that speed up outcomes and reduce costs for all parties. Lengthy claims processes are not beneficial to injured people or their lawyers. Reforms should target real costs and delays without weakening accountability or access to justice. Before considering any changes to insurance, the committee should insist on clear evidence of cause, effect and cost shifting. Regardless of where costs ultimately sit on balance sheets, there remains an injured person who still requires care, support and deserves dignity, and those needs do not disappear when legal rights are curtailed or diminished. Thank you, and we welcome your questions.
Thank you very much, Mr. Murray. Did you want to add anything, Mr. Liveris?
No.
Thank you very much. I'm assuming that you might have been listening into a little bit of the evidence, and certainly you were in the room for some of the previous witnesses' testimony.
Yeah, that's right. I've listened to some of the evidence, and I think my colleagues have too.
Excellent. So you will know then that a lot of the evidence that's been put to the committee is that the rise of insurance costs is partly the fault of social inflation, with more suits and claims on public liability and workers' compensation. Does the ALA buy this claim, and do you see a need for tort reform, particularly noting that you've already indicated that the system's not perfect?
No, the system's not perfect, but we think that by and large it works well. The law of tort, common law rights have evolved over a substantial period of time, not just in this country and elsewhere. They play a vital role in our social contract and the rule of law and our democracy. And no, we don't feel like substantial reform is required in circumstances where, you know, we haven't heard any evidence, real evidence of a causal link between people bringing claims in tort and rising insurance costs.
I think the frequency of claims or the amount of claims is an interesting, I suppose, allegation to have been made. I just happen to have received a paper this week from 2 barristers of the Victorian Bar, and it sets out how many awards of general damages have been made each year in the courts, the Victorian courts, and it does not reflect a rise in claims. So in 2023, there were three assessments of general damages, but judgment was made for the defendant in one of those matters, so it was actually only 2 awards of damages. In 2024, damages were assessed, general damages were assessed 7 times, but that's really only 5 because one was overturned on appeal and another one, there was liability found for the defendant. Then in 2025, it was 3 times general damages were assessed, and in 2026, to date, it's only been 2. So you'd think that if claims were rising, it would also be reflected by the number of awards of general damages in the courts.
Okay, so look, it's very helpful to actually get some information on the record, and that is for the jurisdiction of Victoria. Do you have access to data for New South Wales, Queensland, and the other jurisdictions that, you know, make up the country?
So I haven't brought that data with me today, but similarly, I'm sure that there's an ability to assess, as these barristers have done, awards of damages in those jurisdictions. Would you agree, Ian?
Yeah, I think that the courts themselves, certainly in the jurisdictions with which I'm familiar, which is Western Australia and New South Wales, keep data on the numbers of claims and the broad, certainly in Western Australia, the broad type of claim in terms of which writs are filed, you know, actions in medical negligence or MVAs. And I think that data is probably readily available to the court system, yeah.
Yeah. Look, if there's any way you could curate that and provide it to the committee, that would be of assistance to us, because at this point of time, the assertions are that the sector that you represent is being pointed to as the most significant factor, if I can put it that way, in the rising costs of insurance for small and medium enterprises.
Chair, would I be able to just comment on that briefly?
Please, Mr. Liveris.
Is that in the vast swath of public data that...
Sorry, Mr. Liveris. I really want to hear what you have to say. Can I just ask, are you speaking into the phone or to a speaker?
Sorry, I had my headphones in.
Okay, I can hear you much better now. So let's see if this works. Please give us your thoughts.
Sorry about that. Is that, you know, in the vast swaths of public data that I was going through in preparation for this, which considered multiple jurisdictions and regulators, it wasn't clear that there was an increase in litigation recently, or that was somehow driving the insurance costs themselves or public liability premiums. So while it seems to be a bit of a hypothesis or an assumption that's there, but it's not actually being backed up in the data. And I guess that's kind of one of the things that was almost frustrating me writing this, is that, you know, you can hear these anecdotes and everyone's got lots of people have stories, and that's fine. But there's an insufficient level of data that's available. And so when I've been listening to previous people speaking at this inquiry, I have kind of been sitting there going, okay, but the data isn't reflecting that. And maybe it's an issue with the data that's been gathered more than anything else.
Okay, one thing that is apparent, I think that there's a data poverty in terms of public policy making around so many of these points of friction in the whole ecosystem with insurance for small businesses, and a lack of insight for both the small businesses and for public policy makers about what's going on. You might have noted, Mr. Leveris, that I've asked a number of the insurers to read your recommendations and respond to your assertions, which are at odds with theirs. Can I just go back to the evidence you've given us, Ms. Margaret? The number of cases that you're talking about there, it seems incredibly small. Is the problem that we're having described to us a consequence of the amount of payout in those limited number of cases? Is that where the rubber hits the road in this issue?
I don't think so.
Okay, so what are we talking about in terms of numbers? Let's just do the...
Sure. So I've tried to make some sense or some order of the figures I have in front of me. The greatest award of damages is higher than the threshold of the cap. And so if it's higher than the cap, the funds that are paid out are actually reduced to the cap. So the highest award was in relation to a sexual assault of a child, and that was the awarded damages. And now this is just general damages. It doesn't address economic loss. That's not provided for in this table. But the general damages awarded was $850,000, which would have been reduced to something in about the 700s. I don't have the 2024 cap, but the cap currently is about 760,000 in Victoria. The next award of general damages after that was 550,000, and again, it was sexual abuse of a child by a priest. The third highest in this table is 400,000 in relation to a motor vehicle accident where there was a knee, one of the injuries was a knee injury with 3 surgeries. The next one after that was 300,000, and that's a worker at a construction site who had injuries to his spine, neck and psychological. I can go through all of the awards, but most of them are on the lower end. There's $5,000 for somebody who had injuries to their low back, knees, left shoulder, wrists, hand, and psychological injury. There was $150,000 in relation to a plane crash victim. There's $40,000 in relation to somebody who was battered by police, and that was both psychiatric and physical. So you can see that it's very rare that someone will achieve the statutory maximum. It almost never happens.
Okay, that's really interesting. The other issue is you mentioned a couple of psychological claims amongst those. What is it? 1, 2, 3, 4, 5, 6, 7 items that you gave us. You mentioned 2 of them with psych injuries, but that is, if I can say, that they're riffing on the theme of psychological injury is the new escalator of costs in this whole sector, but that doesn't seem to be borne out by the evidence you've just given me.
No, if numbers is not my strong suit, but I believe that only 4 of the 15 here are psychiatric-only claims.
Okay.
If I can step in, it
Mr. Stone.
Might be that we're looking at different ends of the telescope. We've been talking about what ends up in judgments in the Victorian courts. The insurers have been talking to you about, by and large, blowout and workers' compensation claims, a large majority of which don't see the courts. So I accept that numbers there are on the rise. We are not necessarily embarrassed about the fact that mental health claims are on the rise in workers' compensation systems. In some ways, that is a good thing and a sign of our success of the last 30 years of let's stop shoving mental health under the bed and pretending it doesn't exist. Your employer is entitled to a solid day's work from you. Your employer is entitled to your best efforts. You are entitled, in return, to a fair day's pay for a fair day's work and to go home uninjured at the end of it. That is what you are entitled to in exchange. You are not selling your future health to your employer. And if you're engaged in work as a police officer, reviewing weeks, months and years of child pornography in order to try and catch people, If you're a firey who has to pull people out of car wrecks and deal with burns, if you're involved in nursing or hospital and are constantly surrounded by death and destruction, it can, in some instances, have an effect upon your mental health. And we have finally started recognising that and compensating people for the damage that their employment is doing to them, that leaves them at times unable to keep working. And if we're getting better at doing that, that is not a bad thing. You know, the whole, well, it's dreadful, mental health claims are going up. Let's view that as a positive if, in fact, employment is causing damage to people's health and we're doing something about it. Because hopefully in response to increasing claim numbers, employers will start taking the mental health of their workers more seriously in an effort to bring those numbers back down.
Which leads to mitigation in the same way that we have physical mitigation for risk that we've come accustomed to, and once upon a time that wasn't practiced either. And this is a point that we have made over the course of the inquiry, but that's quite helpful to get the shape of the workers' compensation dimension of what they're talking about, noting that they are state schemes as well, right?
Indeed.
Okay.
Well,
Mr. Murray.
The Commonwealth has one as well, but yes.
Well, just to underline that, I think that the common law, when it works properly, acts as an incentive for good behaviour and a disincentive for poor behaviour. People can only bring a psychological injury claim in most states and territories if they meet certain criteria, that they have a recognised psychiatric illness, that they're a close family member of the person who, you know, if they're bringing a pure mental harm claim, a close family member of the person who was killed or injured by the wrongdoing. So the guardrails are there to ensure that spurious claims aren't brought. And to have a recognised psychiatric illness, you need to prove that through medical evidence from a psychiatrist. And obviously there's a good deal of what I'd say is ideological scepticism with respect to psychiatric injury that we've heard evidence from others at this inquiry. But it's always open for an insurer, an employer who is a defendant in a civil claim to have the plaintiff assessed by their own expert, and they can and do that. And so if the claim is spurious, then it should be defended, and they have every right and business in doing that.
One of your recommendations for the ICA, ALA and state and territory law societies is to work together to establish pre-litigation protocols. Can you go into detail on this and how it may lower costs for all, especially small businesses?
Absolutely. So, look, the costs when a claim is resolved, generally through if through a court process, there are a whole heap of fees that are that come along with engaging in a court process: filing fees, hearing fees, barristers' fees. There's a whole heap of costs associated with accessing the courts. That's how the courts are generally funded. If a claim is settled outside of the court process, it's done quicker, it's done between the parties, and it means that those costs are reduced.
And what would such a set of pre-litigation protocols look like? Is there one established?
I think Michelle can speak to the TAC protocols.
There's a wide variety of them.
There are.
Each state has its own, and indeed within each state you might have a different regime for motor accidents, workers' compensation, and then the broad public liability. So there's different pre-filing requirements across all of those schemes and across all of the states. So we would have better than 20 different pre-filing requirements around the country.
And is that good or bad?
It is what it is. Harmonisation, given the need to get that many people to the table, I think you earlier, I'll put my own words on it, Herculean task. Certainly, if there could be less of them, that would no doubt make life easier for everybody.
So some productivity and efficiency in a bit of harmonisation around that.
We are all in favour of trying to resolve cases early. We don't get paid till the case is over. It's not in our interest to run the case for 4 years, because during that time we're not charging our clients because they can't afford it. It has to be we wait until the end of the case to get paid. And I'm very keen to settle cases, because the longer the case goes, the more I know I'm taking more out of it and the less my client gets. And I don't like doing that.
And the more injured they seem to be.
And certainly the strain on the process on them is enormous. So we are all in favour of trying to get there. But the difficulty is that in some sectors of the insurance industry, you get good early responses. In New South Wales, where there's a regulator looking over motor accident cases, there's a good program of early settlement by and large. Move into public liability where there's no regulator and every insurer does as they please, and some of them are interested in early settlements. In other spheres, they won't talk to you until you've filed a statement of claim.
Okay. So what would an appropriate regulator in that space look like?
We might take that one on notice. Let's take that one on notice, if we might.
And what data points need to come into the public place for more transparency? Who would they rest with? And how could they be interrogated by small business and others interested in public policy making? I'll let you just think about
that one. I think is on notice because that's a complex policy question.
Yeah, and we're keen because of objective experience. We're very keen to get your sense of what a solution looks like, in addition to, the problem description, which is part of what we're trying to do here as well.
And part of it is adequately resourcing it, and part of it is having consequences for outcomes. So by resourcing, I mean there is a material difference in the outcome between, for example, having an informal settlement conference where two parties get together versus having a mediator or a mediation where there's somebody who comes in and referees the fight. Now, they don't have any power to decide it, but they've at least got the power to say, you be more sensible, and to try and help bring people together. But that comes at a cost because mediations are more expensive. You're paying for a third person in the room. There are consequences if, by consequences I mean if parties don't approach settlement reasonably, then what are the rules in terms of what was your last offer, who was the more reasonable, and why are we still having this dispute 2 years later in terms of imposing penalties for unsuccessful early outcomes?
How much work would a researcher have to do to find out which insurance companies are responding in a more timely way and others operate the practice you just said until you file, nothing occurs? Is that common knowledge across the sector? Or
I think
so. Can you provide us with that information?
Sorry, Andrew. I think for instance, the New South Wales, the health districts, when we bring in a medical negligence claim against them, we might say, here's our evidence, here's what we're going to say. We'd like to meet you to resolve this quickly and cheaply. And we'll have a response from the lawyers that says, well, our policy is that we don't talk to you until you filed a statement of claim. And so then you've incurred more court costs, more time, then you're in the court process and it drags the matter out.
And what's
over
the
a number
impact
of
of
years.
that on small businesses?
Well, on small, I guess
it's reflected in overall insurance premiums.
Yeah.
It just drives the market up across the board.
Okay. If you could, on notice, provide us with, the top of the list in terms of the easiest insurance companies to deal with, down to the ones where there's problem. Is that going to be difficult?
That's variable across their clients. It's variable across the states, and it's variable across their insurance product categories. There is good data because there's heavy regulation in the statutory schemes, workers' compensation and CTP. Regulators know what's going on in those schemes. To be blunt, public liability and medical negligence is the Wild West. You have some who are self-insured, you have some who are insured offshore, and there is nobody who collects comprehensive data about their performance, as far as I'm aware.
And also, we're not always aware of who the insurer is because we always deal with a panel firm of solicitors, and so they have no obligation to reveal to us who their insurer is.
Yeah, and sometimes they will actively refuse to provide that information. Sometimes we're required to provide information to Medicare Australia as to who is the compensation payer, and sometimes lawyers and insurers refuse to reveal who it is that's funding and instructing on the matter.
Well, that's all very, very interesting. I might have many more questions, but I'll just go to my colleagues. Mr. Buchholz.
Thank you. Earlier we heard that from the Insurance Council that Australia was becoming a litigious environment more so than America. Did I hear you right in your opening comment? You had a different opinion?
Yes, I think that's right. I think our opinion would completely reject that assertion.
When you collect your data, just so I'm comparing apples to apples, is it through the court system, through the claims payment? Does it capture the out of settlements and arbitration that we spoke about just earlier on. That we heard about earlier.
We don't collect data ourselves from our members.
Sorry.
So the
data you
paper
had.
that I referred to is it's used for the purposes of education to understand what likely outcomes could be expected in court. So it isn't, I suppose, formed for the purpose of collecting data as such.
Okay.
To give you some idea of how misshapen the data can be, a large number of the public liability claims that you bring, if you reach a settlement, the settlement will be on the basis that you enter a verdict in the insurer's favour in the court proceedings and then sign a deed under which they pay you the money. And they like that because it then allows them to turn up to the Woolies AGM and say, well, we haven't been successfully sued this year because, of course, they've taken the court proceedings and taken a verdict in those. They've just paid you the money on the side so they can say we haven't been successfully sued. That's the sort of distortions in the data we get.
Yeah. So as a committee,
they care about that stuff. Now, I can understand why doctors might care about it, reputationally. They certainly care, and they almost never want a verdict against them. They want a private settlement and no public verdict. But that's spread to where you've now got councils and supermarkets not wanting to actually have a verdict entered against them. But they'll sign a deed on the side to pay the money if you've got them dead bang to rights.
As a committee, we need to understand what's fact and what's fiction, and we'll go back to the insurers and ask them to give us their history of claims to substantiate whether or not there's an upward going trend that supports the earlier evidence from the Insurance Council, or a downward set of trends, which is to the point that you guys are suggesting. I just had a quick look at an article in Lawyers Weekly, which is a document from the 30th of April, so it's quite recent. And the headline is Australia's litigation boom, why the nation is seeing more claims than ever. While Australia may be a relatively small nation, it's rapidly ascending in the ranks as one of the world's most litigious jurisdictions, a shift showing no signs of slowing, and one of the demands business, courts and lawyers alike remain increasingly proactive in navigating this evolving landscape. You also mentioned that there was no impact on premiums. The lady who was interviewed in this, Clark, highlighted that growing litigation is pushing up public liability cost, premiums for businesses, with risk once largely confined to the construction sector now increasingly spreading across a broader range of industries. And Australian workforce becomes more flexible. Can I just ask you to comment to that?
Can I first give this comment that, as anyone who comes from a regional area would know, with small papers and trade papers, you occasionally have the phenomenon of the entire press release appearing as print without necessarily a lot of journalistic work going into it.
Yeah.
I don't know the article you're referring to, but my first question would be, is that somebody's press release that's been put out whole, or is it actually a piece of work of journalism? But then
it seems to interview
Jane
a law
Clark, partner at Clyde and Clough, but hardly a regional area.
But that's not necessarily exclusive. I've seen plenty of press releases that incorporate within them, just as I'm sure each of your officers have issued press releases in which you're quoted and that you've then seen appear straight in print. I can't speak for the article itself. I just give that word of caution around it.
Yeah.
In terms of
it aligns with
yes.
the very sentiment of what the Insurance Council say. It's virtually a mirror image.
I think in all of our jurisdictions we have thresholds that you have to meet in order to be able to bring a claim. So it's not an unfettered system of compensation. So for instance, in the public liability sphere in Victoria, you need to have a significant injury, and it's a very hard threshold to reach. And we do see a lot of people fall through the cracks and not be able to bring their claim. Similarly, in relation to the workers' compensation area, we heard evidence directly before us in relation to the person who has childhood anxiety and brings a claim in the workplace. The thresholds or restrictions within workers' compensation is that the injury must arise predominantly from work. Mental injuries that are from reasonable management action are excluded, and stress and burnout claims are also excluded. So it's not an unfettered system. It's very hard to actually be successful in a compensation claim in Australia.
There have been no landmark decisions in the last 10 years that have opened up new areas of claim or heads of damage. There certainly has been a growth in the abuse work, because we've finally cottoned on to the fact that a whole lot of our citizens have been destroyed by childhood abuse, and that those wrongs need to be made right and whole. So that certainly has been an increasing area of claim. And again, I stand proudly, and we all stand proudly, saying thank goodness, and thank goodness that various state parliaments have stepped up and removed limitation periods and done a variety of other steps to start holding some of the people responsible for what they or their organisations have done. So yes, that's an area of growth, but I don't think there are other burgeoning areas of growth. I don't think there's any greater generosity appearing out of the courts. And bear in mind, we all act on a speculative basis in every case we do. I know there are those who choose to sneer at that. I'm not one of them. If we don't act on a speculative basis, people don't get to bring their claims. But that's an important filter, because we have no interest in bringing unmeritorious claims. Insurers don't throw go-away money at you to get the case to go away. That's not a way to make a living. We make a living by running meritorious claims.
Yeah, and I could just add to that, Andrew. So in terms of the amount of people we take on, we actually act as a filter to filter out bad claims. I'd say that we turn down probably about 85 to 90% of the people who contact us wanting to inquire about bringing in a claim. So our take-on rate's about 10-15% of the people who call us, because we assess that their claim's got reasonable prospects of success. Moreover, we're heavily regulated. We can't bring claims at the court that we don't think have reasonable prospects of success. We have to sign a certification that it has reasonable prospects of success, and that can be professional misconduct if we made misrepresentations on those documents. So,
if I could just add the comment further on the article here, to your point about the courts not shifting their limit. One of the clearest indicators of this shift, she noted, is the expansion of the court's jurisdictional limits, which have effectively raised the ceiling on the value of claims that can be brought before the certain courts. This is reflected in New South Wales District Court increasing its judicial limit in 2022 from 750,000 to 1.2 million, and in Queensland set to follow suit in the year 2027 from 750,000 to 150 million. Are those claims incorrect?
Those are factually accurate.
Can we just ask Mr. Buchholz, maybe you could table?
Yes, I'm happy to.
Those are factually accurate statements that the courts from time to time increase their jurisdictional limits consistent with inflation. You want...
But isn't that in contrast to what you just said earlier in your comment?
No, that's purely a mechanism of which is the correct court in which to bring your claim. You want small claims being dealt with on a very low documented, low evidentiary basis by the small claims division of the local court, which has got a jurisdictional limit 5, 10, 15, 20,000. That's cheap and easy to run. You want small claims there. You then move on to the regular jurisdiction of the district court. You then move on to the local court. You then move on to the district court, and you then move on to the Supreme Court. And with inflation over time, in order to keep the same proportion of cases in the district court, because wages are going up, medical bills are going up, so you adjust the jurisdictional limits periodically to keep the same ratio of claims in each of those courts. Because Supreme Court litigation, their judges are paid more, their time's more valuable, they're more expensive to run. You want the district courts or county courts to handle the majority of personal injury litigation, and a very small, and you want fender benders involving car crashes and property damage to be dealt with cheaply by the local court. So the mere fact that they're adjusting the court limits doesn't mean we get to claim anymore. That's not increasing the amount of damages available. It's just which court hears which, given that medical bills and wages are going up over time. That's a complete non sequitur to link those two things. Okay. Nobody gets $1 more whether I litigate in the district court or the Supreme Court, but and indeed the district court in New South Wales has got unlimited jurisdiction in motor accident cases. I do $4 million motor accident cases in the district court, but it's got a limit of $1 million, currently I think $250,000 in relation to public liability and medical negligence. So if medical negligence puts you in a wheelchair, my advice to you will be we're bringing your case in the Supreme Court because it's worth more than $1.25 million. But the fact, whichever court I'm in, your case is worth what it's worth. The fact that I'm in either court doesn't make a difference to the amount of money you get to recover.
Is Australia becoming a more litigious environment?
I think people are somewhat better aware of their rights. Certainly, I think with what we said earlier about mental health, yes, we have less police officers bottling it up and just going quietly mad and beating their partner at home and seeking help and going off work. Now, if you view that as a more litigious society, I disagree with what your definition of a litigious society is.
Well, I'm here to investigate the insurance industry,
Yeah,
and I just want to calculate whether or not the litigious activity has any bearing on the cost of an insurance premium. You're suggesting in your opening evidence that that's not the case. The other witnesses that have appeared before us have a completely different view, and that's what we're here to establish. We will go and fact check that with the insurers to establish what their claim payouts have and whether or not they've been upward trending or down. I would love to invite you to return once we have that evidence.
There's a lot of fear around bringing claims. People are really scared to litigate. They don't want to be that person. It takes a lot of harm and a lot of wrongdoing for people to be actually willing to go ahead with putting their name to a case, and particularly given that costs can be ordered against them. So most people will not do it. They only do it where they really have been harmed in the majority of cases.
Can I just go to Mr. Liveris to
I just want to
give us your perspective on this, because you're the economist, and the question is about economic activity for us. So if you want to speak to the matters that have been traversed, Mr. Liveris, we'll give you a few minutes now.
Yes, thank you for that. The immediate thought that was going through my mind is that it might be one of definition. And what I mean by that is I think it was the prudential regulator yesterday was talking about not having a definition around what small business meant in this context. And so what I kind of mean in all of this is that there could be overall consistency in or no peaks in litigation or claims or anything like that, but there might be movements within that figure. So, for example, as we've all just kind of been speaking about, which is, workers' compensation, child sex abuse sort of claims and things like that, there seems to have been an increase over the past decade or so in that, because as the Australian Lawyers Alliance were talking about, is that more people are just aware of their rights in that sort of area. But that doesn't necessarily translate to an overall increase in claims generally. And so it could just be a shifting about where things go. There was no evidence that suggested to me or pointed to me in the data that there was an increase in litigation generally. But it's just natural in any sort of market that over the course of 5, 10, 15, 20 years that there is movement about the composition.
Is that reflective of increasing population or other demographic changes?
That could be part of it. It's hard for me to comment definitively on that, but I think one of the things that I think it was Mr. Rogers who was speaking about this was about people being more aware of their rights and being aware of what is available to them. And then also, one of the other things is that insurers might be coming out with new products as well. And so to be able to assist organisations in different ways, that would be a very reasonable thing to begin to assume. But the insurers would have the best idea of the level of the amounts of litigation that's occurring across different products. So it might be worthwhile for the committee to specify areas and ask over the course of, say, 5, 10, 15, 20 years again, to be like, has there been a change in these areas and where does that come from, sort of thing? And can that be traced to a particular legislative change or something like that?
Can I ask Mr. Liveris to prepare a set of questions that you think would provide us with the right information from insurance companies that we can put to them to get some data that will make clear to the committee exactly the scale of what is driving increases in costs in small businesses seeking insurances? Thank you. Did you have a question?
I do, yeah.
Mr. Sharma?
If I could, yeah, thank you.
Ms. Jarrett, to bring us home.
Thank you, and thanks for your appearance and your submissions before. Are you familiar with the APRA report? I just want to make sure I get the name correct. The National Claims and Policies Database Analysis Report of May 2023. So this is the report's the review of claims, trends and affordability of public liability and professional indemnity insurance in Australia.
No, I'm not personally aware of that.
Okay. So, I mean, I would refer it to you because they're due to update it, but I think they make quite clear in the data in that report that public liability claims costs have been increasing at sort of above inflation averages over the last 12 to 15 years, which has resulted, and they assert has resulted in an increase in public liability insurance premiums. But I understand from your evidence, Mr. Murray, that you refute any causal link there.
Well, I just don't think that the evidence is really there, and I think in terms of the.
But hang on, so you disagree with the APRA analysis?
Well, I
think they present the evidence. So you're saying the evidence is not there.
Well, I'm not aware of that report, but obviously I will review it.
Yeah, perhaps if you could take that on notice.
Yeah.
See whether you agree with the assertions in there, or you disagree with it, because it could be. I'm a little unclear on your position because I think Mr. Stone makes some valid points that claims may well be increasing because workers are more cognizant of their rights because conditions and symptoms that were previously unrecognised or undiagnosed are now being dealt with.
Mental health literacy.
Yeah, that could well be a good thing, and if that's we're not here to examine that. It could be a good thing, but it might also be resulting in increased insurance premiums. But we might decide as a society
I think
that's something we're worth paying. But I'm not because your testimony, Mr. Murray, seemed to say there's nothing going on here. There's no link.
No,
there hasn't been an increase in claims,
think
and there hasn't been an increase in costs.
So,
whereas Mr. Stone's evidence seemed to acknowledge that there has been, but for good public policy reasons. So I'm not clear what your position is.
I think the assertion was that we are a more litigious society than the United States, and that's the assertion that I rejected.
Well, I think that was a question put to you by Mr. Buckholz, but I believe in your opening statement you said there was no evidence linking an increase in claims to an increase in premiums, or you said it lacked an evidentiary base. I think that was.
I think that is the position informed by the report that we commissioned from Mr. Liveris.
Okay. I also saw in your submission that I don't know if I'm characterising it right, but you didn't agree that the IP review, so the last major review of public liability law and tort law, had improved the situation of insurance affordability 25 years ago. So what is your position? Because you've got about 7 paragraphs in there on the IP review. You don't seem to say it's had any improvement. You've cautioned against doing something similar. So is it your view that the IP review did not improve the insurance market at all in Australia?
I think it's our position that the attribution of civil liability claims to failed insurance companies in the early 2000s was, perhaps an error. I think, and obviously the 2002 turn of the century scenario in Australia is a little bit before my time, but looking back at the historical sort of evidence, I understand that the insurance company HIH, there were a number of investigations into the governance of that insurer, and there might have been some malfeasance involved, and it's not necessarily the case that this insurance company was overwhelmed with people bringing public liability or other claims of negligence that caused its demise. I think before that we also witnessed the September 11th attacks in New York, which would have had a significant impact, I would suggest, on global insurance and other products.
Mr. Stone, I presume you were practising at that time when the review...
I'm somewhat older. I can remember Larry Adler, and he took a tin pot insurance company in FAI and HIH, expanded them enormously by writing premiums well below everybody else, and the chickens came home to roost because he'd undercut the market and just about destroyed the market in doing it. And it took a long time to get equilibrium back after that, and the IP report was in many parts the overreaction to that. We can't speak to the underwriting side of it. That's really not our area of expertise. Consequent to that report, a variety of state governments to differing levels took an axe to entitlements and put entitlements restrictions, restricted the damages you could recover, and also put a series of liability reducing measures in. So, for example, greater protection for councils, greater protection for rescuers. There was a variety. So there was both a liability restriction and a damages restriction put in place. That's not an easily repeatable exercise because it's been done. There's, now we think aspects of those reforms went too far in some states, and we can give you examples of that where there are parts of it that just don't make sense and that have led to perverse outcomes. But it certainly was, as Ian was alluding to, a conflux of events. And certainly, you could also argue a more liberal attitude by Australian courts, from the 80s running into the 90s, that the judgments were being given in the early 2000s. That combined with the shock of 9/11 and the running into the ground of HIH and FAI all combined to create a fairly perfect storm.
But what's been your experience as a practitioner of what the era tort reforms have changed? Because I presume you're practising in this area of law.
Do it every day.
Prior to it. So what's your qualitative but non-empirical analysis of what changed as a result of the era tort reforms?
That a series of smaller claims have been pushed out of the system, in particular in public liability. The necessity to get over a certain level of percentage impairment before you recover anything for pain and suffering has been relatively effective in getting small claims out of the system. There are restrictions on costs in smaller claims. We've had a period where that had to settle in, and by and large, I don't think the courts are clogged up with $50,000, $100,000 cases. But there are still people out there with serious injuries, most of whom still are able to pursue their claims, but a number of whom, because of odd things around the periphery of some of those reforms, we say, no, you don't have a claim, and we send them on their way.
I'd just like to briefly comment on the IP reforms. There is some complexity around it, as Mr. Stone and Mr. Murray have just kind of been talking about. But there's no causal link from the IP review to any sort of the IP reforms to any. There's no causal link to affordability there. There does seem to be around that time some improvement in affordability that's going on, but over the course of time, that trajectory doesn't particularly change. So you see it in the first few years, but it's not necessarily a long-term trend that occurs. This all kind of adds to the complexity of it, though.
I just point out we're in the social sciences, so proving causality is almost impossible. We'd have to deal with the realm of correlation, not causation. Thank you, Chair.
Thank you. If I can go now to Ms. Jarrett for just two quick questions, because we are over time.
So we're talking potential increase in claims and cost of claims being a contributor to the price of insurance, but I think we have to be a little careful and make sure we're comparing apples with apples. So the data that you gave us, Ms. Margalit, was general damages. I think when the insurers are looking at it, they're looking at it in terms of civil payouts, in terms of civil liabilities and other sorts of payments that they have to make as part of their payouts. But in the court process, if there is a court proceeding, it gets started, right? And even if it's settled before it goes to trial, if it's settled through a mediator, isn't that documented in the court documents somewhere? And if so, how do we get that information? Is that through AG's departments?
It's not recorded in the court if the insurer insisted as a term of the settlement that you discontinue the court proceedings and then sign a private deed with them as to what they're going to pay
with the court?
No, you give the court a document saying we're all going away. We don't seek a formal judgment against... Sorry, normally when you win a case, you get a judgment against the defendant and the defendant pays you. The way in which a lot of public liability insurers want to take that resolution is say, you discontinue your court proceedings so we can say we weren't sued, choosing their words very carefully, come and sign this deed where we'll pay you $100,000 or $1 million
But that's
what
not
we've agreed your
document. The
English
court
word.
doesn't say it's private settlement reached or anything.
The court would be aware only of a discontinuance.
The court has a notice of discontinuance rather than terms of settlement with a figure in them.
Okay, so
and it then becomes a private deed between you and the insurer.
So there's no point in us really looking at that because it's not
the
going
court
to give us
data will not capture the full data set.
All right, I'm just making sure. So
If
it'll be
that explains.
discontinuance versus the data, and we need the data.
And that, of course, doesn't even pick up anything that's settled pre-litigation.
Okay.
Which we'd like to happen more often.
We would. And I think what I'd like to say about claims costs as put to you by other witnesses includes the costs that they pay their own lawyers.
Yeah.
And we're not in control of how those lawyers conduct litigation. Our experience of litigating generally is that there is a scepticism about all claims. That's fair enough. We feel like the tactics employed by many defendant insurance lawyers is deny, delay, defend, and this drags out legal processes for all parties and increases costs. What we're saying with our suggestions in relation to pre-action protocol procedures where each party puts its cards on the table earlier is to try and reduce the delay, defend, deny aspect of the process that we're putting plaintiffs through.
Okay. Question on notice then, given the time, but it goes to, you talked about a pre-litigious or process. We had a mention earlier today, I think by ICA, about how good the no-fault approach is, particularly in terms of psychological claims, and saying that if you go, the other flip side of that is there's always an argument as to whether or not the claim shouldn't be accepted. That adds a whole lot of extra costs to that. Can you please comment on how on what actually works in practice in through a question on notice? Because their suggestion was workers' comp has no fault. It's much easier to follow that route than anything else.
We'll give you the evidence and ask you to provide a response on notice.
Thank you. Absolutely.
Yes, thank you.
Can I make the general comment that, and where I think we might have some degree of cross purposes, is not to treat aggregate data as necessarily being representative. So, for example, is there any blowout in the frequency of people suing supermarkets and shopping centres for slip and falls? I don't think any of us have seen that. Is there any blowout in doctors being sued for medical malpractice? No, I don't think there's any blowout in that. Is there any rapid increase in councils being sued for trip and falls on pavements? I'd suspect those numbers post-HIP are well down. On the other hand, if you're talking about what's happening with the Boy Scouts and certain church organisations and certain schooling organisations, absolutely there's a blowout. You know, if you're talking about people who, if you're asking to compare your exposure to asbestos compared to 30 years ago compared to now as some chickens come home to roost. So there are certainly some market sectors that are becoming a lot more litigious. In terms of, you know, we've finally realised the damage that historically asbestos does to people and are compensating those who are dying for it. The next wave of that will be silicosis, and there will be a blowout in costs associated with anybody who's been near working with stone. You know, there are some market sectors that, yes, because we're injuring people and we're finally recognising that we're injuring people. And certainly for some small businesses and in particular charitable organisations, if they have been badly run and have had abusive histories, then yes, their premiums are still facing some hammering to come as historical wrongs are righted. And good-o is all I can say about that.
Thank you. We appreciate your submissions and thank you for attending today. There are questions on notice, so if you could respond by the 29th of May, the committee would appreciate that. And I now invite the Small Business Commissioner from New South Wales to come forward.
Thank you.
Thank you.
Thank you. Thank you.
Thank you. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. The Senate has resolved that an officer of a department or of the Commonwealth or of a state shall not be asked to give opinions on matters of policy and shall be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not preclude questions asking for explanations of policies or factual questions about when and how policies were adopted. Commonwealth officers appearing here today are also reminded of the Senate order specifying the processes by which a claim of public interest immunity could be raised. A copy of the order is available from the Secretariat. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Thank you. My name is Catherine Ellis. My role is Acting New South Wales Small Business Commissioner.
I now invite you to make a short opening statement and then there will be questions from the committee.
Thank you. Thank you to the committee and good afternoon. Thank you for the opportunity to appear as part of this inquiry into small business insurance. The New South Wales Small Business Commission is an independent statutory authority. We provide advocacy, advice and dispute resolution services and engage directly with small businesses across New South Wales. Our advocacy work involves representing the interests of individual small businesses on matters that relate to their own business and circumstances, and also representing the perspective and interests of all New South Wales small businesses in policy issues such as the questions being examined through this inquiry into small business insurance. The Commission was pleased to provide a written submission for the committee's consideration, and I'm pleased to support the committee's work by providing evidence today. In New South Wales, there are almost 900,000 small businesses, and we generally define them as businesses that have up to 20 FTE or full-time equivalent employees and up to 10 million in turnover. On the numbers, the state's small businesses comprise 97% of all operating businesses in New South Wales. They employ 1.7 million people, which equates to about 40% of the state's private sector workforce.
Sorry, what was that number again?
1.7 million people employed in New South Wales small businesses and equating to around 40% of the state's private sector workforce. They pay $77.4 billion in annual wages and salaries to this workforce. They generate $550.3 billion in annual sales and service income. 29% are based outside of metropolitan Sydney. The largest sectors in our small business sector are construction at 17%, professional, scientific and technical services at 14%, rental, hiring and real estate at 12%, transport, postal and warehousing at 8%, and healthcare and social assistance again at 8%. Small businesses make a critically important contribution to the economy and the community. Their ability to access affordable and fit-for-purpose insurance is essential to their ability to operate sustainably and to continue to make this economic and community contribution. In our engagement with small businesses and stakeholders who support the small business sector, in the Commission we consistently hear that the objective of accessing insurance that is both affordable and fit for purpose is becoming increasingly challenging. As we've set out in our written submission, I would like to highlight three key points. Firstly, affordability and availability remain central challenges. Many small businesses are experiencing significant premium increases, difficulty obtaining cover, or policies with reduced scope of cover, including more exclusions and lower levels of protection. When we surveyed the sector earlier this year to support our submission, 61% of respondents reported a significant increase in insurance costs over the past 3 years, with a further 32% reporting a slight increase. The most common reason for not holding insurance was that premiums were unaffordable. Secondly, for most small businesses, insurance is not optional. Core products such as public liability and workers' compensation are often mandatory or essential to operate, including for participation in government procurement. Consistent with this, 72% of respondents to our survey indicated they hold insurance because it is required by law or regulation. Third, these challenges affect business viability, competition and the ability of communities to access services, particularly in regional areas and high-risk sectors. In smaller and regional markets, feedback from small businesses tells us that there are often fewer insurers and less competition, which can limit both availability and choice. Our survey found that 13% of regional respondents reported that available insurance did not meet their needs, compared with 7% in Greater Sydney. The committee's terms of reference identify pressures in industries such as construction, tourism and live music. At the Commission, we have aligned our analysis through the survey to the closest corresponding industry groups in our survey data. This shows that pressures are particularly acute in these sectors. For example, 86% of respondents in the accommodation and food services sector, 78% in construction and 53% of small businesses in arts and recreation services reported significant increases in insurance costs. Finally, natural disasters present a structural challenge to insurance access. In high-risk areas, coverage may be unavailable, heavily restricted or priced beyond commercial viability. Stakeholders have also raised concerns about the limitations of current payout models, including the build back as before requirements, which can reduce the ability of businesses to relocate or rebuild more resilient in a more resilient way following repeated disruptive events or natural disasters. Thank you for allowing me to deliver this opening address. I welcome any questions from the committee.
Thank you very much, Ms Ellis, and I'm going straight to Senator Sharma for the first block of questions.
Thanks, Ms Ellis, and thank you for your appearance and your opening statement and your submission. You mentioned in your submission, and thank you for the survey you undertook to inform your submission to this inquiry. That's quite helpful, particularly I think the findings about the reasons that certain businesses do not have insurance high amongst, I think the highest amongst is which is affordability. But you mentioned there was you made 12 recommendations following a review you did in 2022. So I wasn't familiar with that report, but are you able just to kind of give a flavour of those recommendations and what has been acted on and whether they've had an impact or not?
Certainly. So thank you, Senator. I must say that report was before my time at the Commission. However, my understanding is that really the recommendations were concentrated on measures to encourage greater coordination at the Commonwealth level and between Commonwealth and states insofar as the settings that affect small business insurance are a combination of those things or set at a combination of those jurisdictions. There was also recommendations made around, particularly with respect to small business insurance requirements in procurement. So, for example, and this change has been made in New South Wales. So instead of when a small business is bidding for work from the government, instead of saying you must hold this policy in order to be eligible to even bid for the work, the change has been made to say, okay, once you win it, if you win it, that's when the point at which you need to obtain it, because they may not need it for any other aspect of their work, and that has been implemented. Also, I understand there's been some changes implemented in relation to thresholds of government work at which point insurance is required. And they're the two recommendations that I'm aware that have been acted on at this stage.
Okay, thank you. Did you make any recommendations about stamp duty or the emergency services levy? Obviously, I'm conscious you're part of the New South Wales government and they are doing a review of this, but I was wondering if that has been canvassed or if that has been a feedback that you had from small business when you surveyed them about the relative contribution of taxes and levies to the overall cost of insurance.
Yeah, so the two areas that I think we hear from most, particularly from New South Wales small businesses, do relate to the ESL or Emergency Services Levy and the fact that that's baked into premiums that are paid by small businesses. And as you point out, Senator, there is reforms underway at the moment in relation to that. The other area that we've heard consistent and loud feedback with respect to New South Wales relates to the workers' compensation system, which is also in the process of being reformed. Small businesses will generally provide feedback around not only the quantum of premiums that apply, but also the system that sits alongside it in terms of things like not understanding how their premium is arrived at, not understanding how not understanding how, in the event that a claim is made by an employee, how that then might affect their premium in the years ahead. And then the third thing we hear about quite often is small business concerns about, that not being a contestable market, as in, there's one provider in effect.
ICARE, right?
Yes.
Okay, yeah. Yeah, I have heard from a lot of small businesses in New South Wales about, they've raised, particularly when you talk to them about insurance, they raise the growing cost of workers' compensation insurance, as opposed to, say, public liability or standard property. Is that what you've been hearing from businesses as well, that it's that part of their insurance portfolio in particular that is seeing higher costs?
Certainly, there's been, I think there was an 8% increase on average in the previous financial year, and I know that those concerns have been noted because they're now subject to the reforms. But certainly, I think there's a threshold there in New South Wales where if a business makes a claim and their premium is under the business's premium is under $30,000, then it doesn't affect the premium in future years. Whereas businesses whose premiums are above that, they're going to be the ones that are employing more people.
Yeah.
And there's that disconnect there around, okay, a claim might be made, it may or may not be an approved claim, and I don't understand how that then flows into my premiums in future years.
Okay. And just is your sense, I don't know if you have data on this or you only have a sort of a qualitative sense, but that the level of underinsurance, if you like, amongst the small business community in New South Wales is growing? You do have some figures about the reasons that common reasons for not holding insurance product, the most common one being they're unaffordable. But is your sense that the number of businesses not holding insurance products that they might have previously has grown? Do you have any data on it?
I don't know that I could give you reliable data on that today, but I'm happy to take it on notice. What I would say is that the evidence that we set out in our submission indicates that for pretty obvious reasons, the premiums that businesses hold first are the ones that they have to hold, typically through it being a legislative requirement or through it being connected to, say, a trade registration or something that is really critical to the earning of that income. I think what we're seeing, where we're seeing a particular vulnerability, is in relation to natural disasters and disruptive events. So if I can just draw your attention to two that we've supported these small businesses with, particularly over the last 6 months, is the tragic terror attack in Bondi in December, and which is obviously not anticipated, and then also the current circumstances around the closure of the Great Western Highway, and that posing challenges for businesses who ability to operate is impacted by the diversion in the roads there in that part of the world, and to the extent that businesses are obviously prioritising the insurance policies that they must hold, it then leaves them vulnerable in circumstances where there's an unpredictable event like that, and they may not have been able to just simply find the money to take out those kinds of policies. And then obviously some of those events can be quite catastrophic for them when it comes to ongoing viability. And in the current context, the Commission undertakes a monthly survey of small business confidence, and that tells us, and we ask businesses about their key concerns. Over 85% of businesses tell us that the cost of business inputs is their number one concern, and so they are struggling in many instances just to find the cash flow to afford those kind of additional policies that would, of course, provide them with protection or some degree of protection in the event of an unpredictable event like that. But some of them are struggling to find the cash flow to fund those premiums, and that's where we're seeing a particularly vulnerability.
I noticed in your submission you describe several small businesses who, if they can afford the insurance, they're citing a limited capacity to expand or hire additional staff because of the cost pressures in insurance, which is affecting their growth and sustainability. So you've been hearing that from small business as well, that there's the affordability component, can they afford it or not, but even if they can afford it, it lessens their ability to do other things, invest in capital, grow the business, expand to a new site.
That's right. They'll need to make informed judgments around to what extent they might expand and grow, and to some extent where that might involve a speculative decision or a level of risk taking, then that, of course, that influences how they feel about that and whether they feel they're in a position to do that. And sometimes, as with other types of costs in a business that will really represent a material number for them, they may think twice about whether or not that's something they can do. And of course, then that affects their turnover, their operating circumstances, and of course has downstream effects for the economy.
Yeah, of course. All right. Thank you, Ms. Ellis. Thank you, Chair.
Thank you.
Can I just
Mr.
ask, when you're surveying your wonderful members, are they reporting any extra litigious activity in the workplace? And I understand if you don't capture that level of granular activity.
We haven't asked them directly about that, but what we do here, obviously we have conversations with small businesses every day. That's our bread and butter, that's our role. And we have conversations with all of them, so we don't have particular industries that we talk to and not. We talk to anyone that needs assistance, or we represent all businesses, all small businesses. I think the two things there that have come across in our feedback from small businesses is really that there's been a noticeable increase in legal activity in relation to the accommodation the hospitality and nighttime industry sector. So pubs and clubs in simple terms, and that does obviously affect premiums in that sector, and therefore their viability, which is also affected, by cost of living at the moment, because to some extent those things are a discretionary expenditure item.
Yeah.
So that industry is one where we hear that the insurance premiums have a marked increase, and some of that is around that activity. The second one will take you back to workers' compensation, where we hear that there's small businesses are challenged by some of the claims, particularly the psychological claims, psychological injury claims that are made. And I must say, in the same breath, that I think small businesses, by and large, are very appreciative and supportive of their staff. They find them hard to get, particularly, or good ones hard to get, particularly in regional New South Wales. And so they're highly valuing their staff and their skilled people, but it is challenging in circumstances where those sorts of claims may be made and may not be supported.
So that was an interesting comment you made earlier on about the up to $30,000 doesn't affect your workers' cover claim. It was touched on earlier on by another witness about trying to curb that behaviour and putting guardrails or some caps or something in place. Does the Small Business Council or New South Wales have a position or recommendation on what that could look like as we consider our recommendations for the committee's findings?
I think what we would say on that is often, I talked before about how a small business is defined, so, up to 20 FTE or 10 million in turnover. In practice in New South Wales, 63% of small businesses are actually what we call single-person enterprises or non-employing businesses. So, in other words, there's one individual in that business, and sometimes that's a deliberate choice. That's how they're operating. Sometimes it's the industry that they're in, and sometimes it's just because they've chosen to stay that way. And then going upwards from there, I think it's 89% of small businesses in New South Wales are up to 5 FTE. So really, we're talking about single-person enterprises or very small businesses in the vast majority of cases. I think, and that number in New South Wales is growing. So I think back in 2021, it was 57% of businesses were non-employing. It's now ticked up every year up to 63%. So what we often see then is that the small business or the SME sector is sort of treated as one, and really the small businesses are worth defining separately, because not suggesting that, you know, the medium-sized business with 100 staff or 150 staff or 200 staff, of course, they've got their own concerns and challenges, but generally they're of a different scale and they've got some more internal capability and some more backing financially to be able to withstand premium rises and other other financial impediments, whereas the very small businesses, I would say, are worth considering as a separate entity and population when it comes to those sorts of policy settings.
Thank you. Thanks, Chair.
Thank you very much. If I could just thank you for being here and just ask a couple of questions. Your survey under complexity of policy terms showed essentially the 3 in 4 small businesses struggle to understand their policy terms and exclusions. Is it the Commission's view that in practice this complexity reduces the ability of small businesses to question pricing, to change providers or negotiate better outcomes?
I think I'd take you to my previous answer, which is that you know, around the limited resources available to many small businesses, they're, you know, single person enterprise in many cases, their ability to get across the complexity, whether it's, you know, banking or insurance products or any other thing, you know, has its limits, and some are fortunate enough to have professional advisors who will help them navigate these things, but again, in a cash flow constrained environment, they'll make choices too about when they access that advice.
Brokers were here just talking about, you know, 100-page plus EDS statements, etc., designed for a particular purpose, making sure that people aren't being ripped off, but not fit for purpose really at the moment. Is that part of the problem that we need to start to address in terms of literacy around insurance, better communications?
I think that's right. We do everything we can in the Commission to assist that in terms of proactive guides for businesses taking out insurance policies or in fact making an insurance claim, and we work with individual small businesses and advocate for their needs when it comes to if they are striking difficulties in having a claim considered or approved. But certainly just the volume of technical information that small businesses need to come to grips with, and that's not a reflection on their ability, it's a reflection on their bandwidth and their time. Certainly anything that can simplify those terms and conditions and make it clearer to small businesses when they're taking out policies would be welcomed, and I would say also would actually increase confidence in the insurance market, because small businesses would feel that they you know, are in a better position to understand, or they've got more surety around what is and isn't covered.
Could I ask one final question before we conclude? If the committee were to prioritise one area for action that would most quickly improve outcomes for small business based on this New South Wales experience, what would you recommend?
I think I'd recommend policy settings that take that small business sector and treat it as a defined population, and try and have some particular settings in place to limit their exposure to increasing premiums, and also increase their ability to obtain insurance to assist them in the event of those disruptive events such as natural disasters, transport disruptions, those sorts of events.
That's a big ask. Yeah. Can I get the sense from you that given that it's 89% are only employing up to 5, that the communication needs to be of a very particular, succinct style to that cohort. And often the materials that are provided are based on assumptions that there's a large organisation in small business, which just doesn't meet the reality.
That's right.
Okay, so alert insurers to the reality they're dealing with single individual entities.
That's right.
Change how you communicate.
And find ways to effectively reach them. I think often there's an assumption too that they're represented by an industry body or someone who
but they're not
do that, translate for them, but they're not always.
Yeah.
And depending on their industry and you know what sort of representation they have, they may or may not have access to that sort of person or advice that can really level with them in terms of what their policy provides.
Okay, well, look, can I thank you very much for, as Senator Sharma said, undertaking the research, the insights that you've given, and, you know, the data points are actually quite interesting. And we seem to have a bit of data poverty around what's actually happening across the entire insurance sector, but at least we've got some clarity about what's happening here in New South Wales from you. Can I thank you for taking the time to give evidence today? If you have any additional information or response to questions on notice, could you do that by Friday the 29th of May? And that concludes today's hearing. Thank you to all the witnesses who appeared. Thank you to Hansard Broadcasting for their assistance, to our fabulous Secretariat, and to my colleagues from both the Senate and the House. This has been two, I think, pretty good days of evidence gathering with much for us to think about. The committee stands adjourned.